greater pass-through, I think inflation in India could start trending up. Overall, if I move beyond the PMI indicators, a lot of the other activity indicators have actually held on to their momentum over the last 3 or 4 months. So at least on the growth front, I think things still continue to broadly hold up.
Yeah, but of course, it's those price pressures that India's policymakers over at the RBI need to focus on, right? So RBI minutes, what are they beginning to show us about the outlook amongst those who are in the business of rate setting, particularly where we see this? So, you talked about the other economic numbers. We've got this PMI, but then we also had the CPI and PPI in the previous week.
Right. No, absolutely. So, the RBI minutes that came out recently actually showed something very interesting, where there were, members within the MPC that suggested that, look, if inflationary pressures start becoming more durable in nature, either because of the second round effects that I spoke about, or because of any disruptions that happen because of an uneven monsoon, I think there is a case to be made for a recalibration of the policy path ahead, which essentially signals that, the central bank could look at, increasing the policy rate over the coming months if we find that inflation starts surprising on the upside. So I would say that the minutes were actually slightly on the hawkish side, especially if you compare that to the monetary policy decision that came out in the beginning of August, which, market perceived broadly as being, dovish and reading it as, the RBI not really ready at this point to hike rates. But I think the minutes are more telling in nature, where the central bank clearly is concerned about the future trajectory of inflation. And our in-house view is that, we could end up seeing an upside surprise on inflation in the second half of the year, both from a headline as well as core inflation perspective. And therefore, we are estimating one rate hike by the central bank, likely at the beginning of the first quarter of 2027.
Yeah, I mean, it's very interesting. I was looking at one of the quotes that came from the minutes, and this was from Ram Singh, an external member on the panel, who said of the minutes, if external shocks worsen or the second round price effects spread widely, we should be able to swiftly adjust policy to protect macroeconomic stability. But it is this reference to external shocks. I found that particularly interesting. And I think that you mentioned the West Asia situation. How much of it is playing into these conversations now?
Right. Let's just take a step back and see how the West Asia conflict actually impacts India's domestic, inflation. One is the direct impact, where a rise in oil prices, then translates into higher pump prices. But, the impact there has been fairly limited so far, because the government did come in and, provide cut excise duties, etc. So the pass-through hasn't been complete. The second effect is clearly with input, costs going up. So it is not just oil, but it is a host of commodities that India, imports and is affected by. Look at chemicals, fertilizers, steel. I think these broader input cost pressures are now, kind of putting greater pressure. And I think this is visible in the data. If you look at the PPI numbers for the month of, over the recent months, that's close to almost, 10%. So I think that, over the next quarter, we anticipate that you should start seeing producers kind of pass on some of these cost pressures at the retail level, which should push up your inflation print. The interesting thing is that, this time around, consumption also has been kind of holding up since last year, especially second half of last year after we had the GST rate cut. So I think that producers will find themselves, in a situation that is more comfortable or conducive for them to also pass on some of these cost increases.
Yeah, I mean, again, just looking at some quotes coming from these minutes, and this is from the RBI chief, Sanjay Malhotra. So he says about being watchful about the risks of higher food, fuel and other input prices translating into this broad-based increase in inflation. Now, the reason I want to pick up on that is because obviously we've had these shots across the bow, as so to speak, and this talk of D-Day economic sanctions. against Iran by the U.S. Treasury Secretary Scott Bessent. He's put a rather lengthy sort of statement out there. The question then immediately for India becomes, and this is what people want to understand, is how important that relationship with Iran is and whether or not this could have any material impact for India. Now, we know that India would fall in the top 10 of countries that have some significant business with Iran. So what do you make of all of this? And this is a question a lot of people are waking up to this morning, because we're going to get this announcement of what these measures are going to be, these sanctions, later on today.
Right, you're right. I mean, this is another risk that gets added, to the host of headwinds that we are seeing on the external front. We'll have to wait and watch what the details of, what, Bessent announces today. But clearly from India's overall, growth perspective, of course, Iran is an important, trade partner. And to the extent if these, sanctions are put on, countries doing trade with Iran, etc., it could have some impact, for India's, export, import outlook as well. But I would still say that, my sense is that given the size of our trade relationship with Iran vis-a-vis the size of the economy, and we have a greater, of course, trade relationship in terms of volumes with other regions. I mean, top trading partners for us include U.S, China, Europe, etc. So at the macro level, I don't think that this would add a significant, drag to at least the growth projections or how we are thinking about, broader economic momentum for the coming months on the domestic side. But yes, I mean, there will be sector-specific, perhaps, headwinds that would kind of come forth. We'll have to, of course, wait and see, what is the nature of these, sanctions that are announced.
Yeah, absolutely. And whatever comes of this, I think it is prompting a lot of, and we've already heard this today on the show, it's prompting some new ideas about energy mix. So let's just talk about that for India, for example. The US has become a top supplier of LNG and LPG to India. And so there is all of this mounting pressure on India to cut back on crude exports from Russia and instead buying more US and Venezuelan crude. So the question is, how does all of that impact India's trade balance and finances, especially if this war continues, and then the supplies from the Middle East remain unavailable?
Right. So, going into this year, and this war started, in the month of March, I think there was a lot of anxiety domestically around India's, trade balance and, current account deficit for this year. Consequently, financing of that current account deficit also became an issue. And that's why the RBI came in and announced a couple of measures to attract dollar flows into the country. But as things stand today, I think that, looking at the data that has come in over the last 4 months, on the trade side, I think there are some silver linings that are, clearly standing out. One is that if you look at, our overall export growth, beyond the oil, petroleum exports, because India also has petroleum exports, I think non-oil petroleum exports have actually been doing very well. India has a couple of FTAs, that are coming into force. That is also expected to add another, positive tailwind to the trade data. On the import side, yes, of course, I mean, I think the continuation of this war and elevated, oil prices remains a risk, for our import bill. But on the balance, I think we are getting support. There are offsetting factors. Look, so you are getting support from your services trade. You are getting support from higher remittances. So at the aggregate level, your current account deficit is likely to, we are estimating it to be closer to, about 1.2% of GDP this year, assuming that oil averages somewhere around 80-85. So I think that, it remains looks like a relatively manageable number. I think if we see this conflict continuing and oil prices, average above $90 per barrel, then I think there is, of course, a clear, pressure point on the current account. But from a financing perspective, I think we have sorted that issue out, at least for the time being, with the amount of flows that have come in through the various windows that the RBI announced. I mean, the latest number is close to, $72 billion.
Yep.
So I think that should be sufficient in terms of financing.
Okay, last question, briefly, of course. We're going to get India growth numbers August 31st, I believe. I can't believe the month is almost over. But what are your projections across the board? I mean, I'm getting the sense from you, from what I'm hearing, is a sign of resilience. But what is it that you've got on the slate?
Yeah, I mean, you're absolutely right. So we are looking at a 7.5% growth for the first quarter. I wouldn't be surprised if the actual number ends up coming in higher than 7.5%. I think if you look at a host of indicators that we've been tracking, be it on, exports, be it domestic auto sales, you look at other consumption indicators, overall manufacturing growth or services growth. I mean, we've seen, volume sales pick up in the first quarter. That's reflected in earnings growth as well. So I think we are likely to see, we are estimating 7.5% growth, which should be a very good number given the amount of headwinds that we've seen in the first quarter.
Absolutely. All right, we'll leave it there. Thanks so much. Sakshi Gupta from HDFC Bank. It's a pleasure to see you. Meanwhile, in China, the World Humanoid Robot Games is underway. More on that after a short break. Stay with us.
Don't miss the highlights of the PGA Tour. Catch the action from the PGA. The biggest hits and misses. Join us on the green. Saturday and Sunday afternoons, only on CNBC. Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Line, streaming on CNBC+.
Welcome back. Over in China, the country's robotics ambitions are on full display this week. The second World Humanoid Robot Games, drawing more than 2,000 machines from 16 countries. Our China reporter Elaine Yu has been keeping tabs, and I'm sure that the footage is remarkable, Elaine.
Indeed, Manisha, and robots have proven to be very good athletes, beating the best of humans. A robot developed by the Beijing Humanoid Robot Innovation Center called Tiangong Ultra won a preliminary race on Saturday at the World Humanoid Robot Games in Beijing, the second edition this year. So it ran 100 meters in 9.39 seconds, and that is faster than Usain Bolt's record, the world record at 9.5 5'8", that was set 17 years ago. And this robot also overtook an earlier robot champion made by Honor, but that second place robot also finished the race at 9.47, so faster than Bolt as well. But I have to say the two robots slammed straight into the mat after the race instead of slowing down in time to miss that. So perhaps they do need to work on not crashing and slowing down after their victory. But a range of robot skills were also tested at the World Robot Conference in China. And we've seen them running and boxing, doing high jumps and playing ping pong with humans. And a year ago, people were marveling at all these performances. But the focus this year is so much on how well they can perform practical household or even factory tasks. And we did see them sorting packages, for example, or using tweezers to pick out beans, which does test their dexterity. And one was loading up a washing machine as well. And another was reportedly trying to fold a shirt, but struggled for a few minutes before giving up. So we're also seeing these humanoid actually taking many different forms. Some may not even have 10 fingers or may not need both arms. And cutting all of these things could save cost as well. But this footage that we've been seeing, a lot of them do show that they're still quite far off until they can reach a human's level of efficiency and dexterity. And we've seen some robot stocks down as well as investors question how long they will be before they can be commercially deployed. Back to you.
Elaine, thank you so much. I see that it's still very far off having a robot to do my household cleaning. It's such a shame, but thank you. All right, we're going to take a short break here on Inside India, but we're back in 2. Stay right there.
Ambition doesn't always look like you think it might look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. I want to democratize access to that high-level information and help explain to every single person out there watching why what's happening in these complex markets matters for their lives today and in the future. That's what drives me. I love being part of this.
Fast Money is America's post-game show.
Basically near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked, I get it. People say they overpaid, I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
Welcome back. You're watching Inside India. Here are some of the stories that we're keeping tabs on. A search and rescue operation is underway off India's eastern coast after a Panama-flagged cargo ship went down with 24 crew on board. 2 Chinese seafarers have been rescued. 22 remain missing. The ship has left India's Paradeep port, carrying iron ore to China. Rising floodwaters in Kendrapara, Odisha, have completely cut off access to food and essential supplies. That's leaving families struggling to secure basic meals. In Odisha's northern Gonda district, the deluge has wiped out critical crops and cattle fodder, leaving vast areas of farmland swamped, threatening the livelihoods of local farmers. The Indian Weather Office has just issued urgent warnings for continued heavy rainfall across Odisha, following intense downpours over the past 24 hours. And in space exploration, India is working to establish its own space station by 2035. The chairman of the Indian Space Research Organisation, V. Narayanan, said on Sunday the first module of the planned space station had already been approved. He announced during the National Space Day celebrations, where he also highlighted India's growing capabilities in space tech. Last year, India became the world's fourth nation to achieve the feat of space docking, underscoring its ambitions to expand its share of rapidly growing global space market. And with the mention of a market, let's have a look at how markets are performing across Asia right now. So it's a mix of busy going nowhere or just moving to the downside. We've got the Nikkei off just over 0.5% or so. 0.5% or so. The Kospi actually extending its gains and extending its losses, in the last half an hour or so, down 3.3% or so. TAIEX also losing ground, but not as much as the Kospi this session. And the Hang Seng Index down more than 2%. This as oil prices stabilize, in fact falling in the overnight session and stabilizing for both WTI and Brent crude. And all of this as we have on the back burner the D-Day economic sanctions that have been threatened upon Iran and Iran's allies by U.S. Treasury Secretary Scott Bessent. And we will get more on what that actually means later in the session. He talked about dawn. We don't know if that will mean a dawn for the United States, so we'll get it early in the US session, but do watch the headlines for what's next. Now let's zoom in on Alibaba. This after the Chinese tech giant launched a $10 billion share sale to fund its AI expansion. The China Connection anchor Emily Tan has the story. What's happening?
Hi there, Manisha. And we've heard from Alibaba just last week that its capex jumped 75% to $10 billion, and it's now in need of more money as it is funding its AI development. And this is how it's playing out in the market. The stock was down as much as 10% as the company raised $10.2 billion after pricing this share placement at $112.70. So it is now trading weaker than that. This is the largest ever primary follow-on offering by a Hong Kong-listed company and becomes the third largest this year after Alphabet and Intel. This will allow Alibaba to invest in its full-stack AI capabilities, everything from its chips, we know that as Zhenwu, infrastructure development and deployment of AI through its model Qwen. Eddie Wu, the CEO at Alibaba, at the earnings release last week was talking about being able to capture future growth, and they only can do that by making these capex investments to build out necessary compute capacity. The placement, though, was not registered under U.S. securities law, so what that means is American investors are not part of this investment exercise. Now, we speak of American investors and Michael Burry we know him from The Big Short and also Scion Capital Management, and he has moved his entire Alibaba stake, its position now, to JD.com. Alibaba, he says, will have to fall in half for him to be interested, and he says that Baba is making serious inroads in the commodity low-cost LLM bloodbath in the United States. It is impressive as a disruptive force, and I believe this will continue. He says, I cannot bless share issuances. This is the new paradigm for Baba, and its ROIC, return on invested capital, will continue to fall. And that it is indeed happening today. Alibaba shares down 9.5% as we speak, 111 and change last traded. Manisha, it's back to you.
Okay, thanks very much for that, Emily. All right, we are counting down to the market open in India. This is how things are shaping up right now. So the indication is for a positive start to the session, but this against a backdrop, of course, of stabilizing oil prices, and we have yet to see whether or not that will remain the case. Oil prices actually shifting lower in the overnight session, and this oil price inflation has been something that has come up in conversations around the Indian growth outlook and whether or not it's actually having a material impact on the overall scene and affecting investors' appetites for stocks. But the other big issue issue that has been playing into markets across the board, especially more broadly in Asia, has been these yields on global bonds. They continue to be elevated, even though U.S. Treasury Secretary Scott Bessent last week announced action, and then it did happen that we saw yields actually falling, but then moving up again in the next session. So this is all about the U.S. and their bond buyback program, particularly at the 10 and the 30-year, the long end of the curve. All of that remains to be discussed. But this, after not such a great session in the last week or so, the Nifty eking out a small gain on Friday, but it actually wasn't enough to stem a second straight week of declines. So if you look at the IT sub-index, that was down a sharper 2.6% for the week. With that in mind, CLSA has recently turned cautious on India's IT heavyweights and has warned that artificial intelligence could squeeze their traditional business lines. The brokerage has cut TCS, Infosys and Tech Mahindra to hold, and it's gone further on Wipro and Emphasis, downgrading both to underperform, and that's based on structural concerns. So let's talk a little bit more about this. Sumit Jain is a senior research analyst at CLSA. He can give us a bit more give us a bit more on those bare bones of the report. Sumit, thank you so much for joining us on the show. The thing that struck me straight away was some of these names in the IT sector were the darlings of India's tech IT boom. And it seems remarkable now that you're looking at, you've gone so far on the likes of Infosys and even further on the likes of Wipro. Before we get into the individual names or what is actually happening here in more detail, overall, what is this telling us about where we are in India's outlook right now?
Yeah, no, thanks for having me on your show. And I think, whenever we have seen there's a major technology change, and that happens typically once every decade, there is a major deflation which happens in the IT services sector globally. We saw that cycle playing out a decade back when cloud was introduced. The major enterprises globally adopted cloud technology, and that led to a major deflation in the infra management services of all the IT service companies globally. Now with AI, coding has been automated in a very big way through Claude and various tools. And which is where, if you look at the software development life cycle, which is the major part of the work of these Indian IT companies, that has seen a good amount of deflation. We have seen Claude tools have got advanced quite materially in the last 6 to 12 months. And that is having its fair share in terms of the revenue compression for these IT companies. Yes, they are working on the deployment of AI tools, but the base business of these companies has to face this deflation first. And this deflation started, I would say, in the last 1 to 2 years. And we have generally seen most of the large contracts of these IT companies are in a duration of 3 to 5 years. And which is where we believe the deflation will continue over the next 2 to 4 years. And there will be a long gestation time before the revenue growth of these companies will come back to mid to high single digits. And hence, we have downgraded these stocks to hold, having a cautious stance in the near term, where even macro, as you know, has not been quite positive for them, given what has happened on the geopolitics front, as well as the crude oil, the discretionary demand has been muted. So yeah, that's why we have a hold rating on all these large cap stocks.
Yeah, you've talked about, and this is where, so you've put Wipro and Emphasis, you've downgraded both to underperform on structural concerns. But structural concerns, can I understand what you mean by that a bit more closely? So is that related to those specific companies, and there may be others as well, or is this a more broad-based thing? In which case one would ask, well, then why wouldn't that apply to others? So just explain what that really means.
Yeah, so Wipro and Emphasis we have put to underperform mostly because of the company-specific factors where they are somewhat losing market share within their cohort sets, where Wipro, for the last 20-25 years have been losing market share. Whereas in case of Emphasis, we believe that their potential is far higher compared to what they have delivered compared to the rest of the mid-cap Indian IT peers. So that's why we believe these two stocks have structural concerns, where apart from the broader AI deflation, which is hitting the entire system integrator as well as the software market as well. But in case of Wipro and Emphasis, we believe there are a few structural concerns as well, where these companies need to correct those factors and come out with a much better growth and margin profile.
Okay, so then the big question becomes, what's going to keep on, if at all, what's going to keep international capital coming back to this sector? Because we've seen, like, what was it? The IT sector, if you look at the stocks as a part of the Nifty, I mean, it's really underperforming on a broad-based level and for the reasons that you cite. But what needs to happen? What would be the changes that would need to be happen to keep that international capital invested in them?
Yeah, no, it's a great question, and which is where I believe their aggression about passing on the AI deflation benefit to the clients and hence gaining more wallet share in their tech budgets and eventually market share gain. I guess the capital market will reward those companies. And which is why we believe, in the large cap space globally, if you look at companies like Cognizant, Accenture, Tech Mahindra, we can see these companies being far more aggressive. And you can see the operating parameters of these companies in terms of the order book is pretty resilient, the revenue per employee is moving up, and EBIT margins are also expanding. And all these three operating parameter improvements shows that these companies are infusing AI and passing on the benefits and hence gaining more wallet share. So I guess every tech cycle comes up with winners and losers, and which is where we need to identify the winners of this cycle. And I guess the capital markets will realize that these winners eventually will come out as the companies with a much better revenue growth, profitability, as well as the market cap. Also in India, I believe the mid-tier IT companies like Coforge, Persistent continues to do very well. We have seen actually earnings upgrade for these stocks in the last 12 to 18 months, despite the AI deflation. And these companies, in order to offset the AI deflation, are actually winning more volume. And that's why you are seeing the earnings upgrade. So I guess it's not a doomsday for everyone out there, but it's a market where you need to be aggressive and gain market share for your clients.
Yeah, that's really interesting because you just mentioned Coforge and Persistent. Actually, you're talking about these mid-tier players, and I know that there is a sort of a difference between the mid-tier and then the darlings of the industry and the behemoths. Just explain that with a bit more detail for us, because those mid-tier players, are those the ones that could win those complex Gen AI integration contracts, that sort of thing, over the large caps? Because structurally, are they more agile? Are they more able to do it?
Yeah, no, actually, you hit the nail. These companies are more agile. They are far more nimble. And, even these companies have to face AI deflation in their managed service programs. It is just that the managed service programs are slightly smaller as a percentage of their revenue. They have more of product engineering, software development, or project implementation kind of work, where probably the deflation is slightly lower than the legacy managed service programs. Secondly, they can pass on the deflation quickly and get more volumes instantaneously. And thirdly, these companies have a very strong ESOP policy, and that incentivizes the entire sales and marketing and delivery engine to make sure that the volumes are far more than the deflation, and hence the revenue growth and margins see an uptick. So I guess that is the kind of aggression we need in the IT service companies or even the software companies right now globally. So I guess it's more of a construct by which these companies are built. And I will not put all the mid-tier IT companies into that bucket. It's only specific ones which are executing well.
Yeah, let's broaden it out a little bit, because we know that the Indian IT sector has always been somewhat connected to the cyclical health of the US market, right? And I was curious about how these client budgets are actually responding to the US macroeconomic picture and tech spending patterns. And I guess that affects probably the bigger players more than the mid-cap ones. But what is that looking like right now?
Yeah. No, actually, the tech budgets we have seen are actually getting allocated more towards hardware, and in the software side, more towards the frontier models like Anthropic, OpenAI, the Chinese models. And to an extent, that is getting funded by the rest of the software and the services industry. So within the tech value chain, we can clearly see preference of hardware and frontier models. So that's one. Secondly, if you look at the discretionary demand globally, that is pretty subdued for the last 2 years. I mean, last year we had tariff impact impacting your manufacturing vertical, and this year, we had the geopolitical crisis impacting your crude oil prices, increase in inflation, and hence the discretionary demand has been pretty muted. And that is where, if you look at the vertical-wise growth of these companies, probably banking and financial services is the only vertical doing well. But rest, all the verticals are showing a pretty subdued growth. So I guess apart from the AI deflation hitting their revenue growth, it's also the muted discretionary demand which has been hurting, where we believe September is seasonally the strongest quarter for the industry. So we believe the QOQ growth, the sequential growth for the sector in September quarter should be better than June. And going into midterm elections, who knows? I mean, US macro might see some improvement. So we have a slight hope of recovery in terms of the sentiments. But yes, the AI deflation will continue for the next 2 to 4 years. And that's why we have a cautious stance on the sector at a broad level.
Yeah, I mean, I do just want to ask you something about something that you said roughly a year ago. So, well, just under a year ago. So this was around November 2025. You were speaking to our colleagues over at TV18, CNBC TV18, and you talked about how you didn't believe that Gen AI would impact the IT sector. Now, that's just a headline. What I'm curious is a lot has happened since then. And I'm curious how your views have changed and why your views may have changed.
Yeah, so actually very interesting question. And, we were of the view that the volume opportunity for system integrators and IT service companies will be before the deflation, or maybe the both of them will simultaneously coexist. And which is where we were expecting that with the improvement in macro that was expected at the beginning of this year, or maybe November, December last year, because the tariff impact was in the base. And, this geopolitical crisis was not in our calculations at all. So I guess the market has deteriorated in terms of both the deflation being more than the volume opportunity. And that's why you can see the guidance by all the IT service companies this year has been pretty muted. And secondly, the macro, which can improve next year, but for this year at least, it has been worse than our expectation. So I guess these two factors, the deflation being more than the volume opportunity and the macro deteriorating, has been the primary factor for our downgrades. And I think the far bigger point is the growth of these large cap companies is still 2 to 4%. And for a 2 to 4% dollar revenue growth or earning growth, these companies cannot fetch a 15 to 20 times PE multiple, where even the US markets are trading at 20 times for a mid-teens dollar earning growth. So I guess the earning growth is pretty muted for the valuations to get re-rated.
Yeah, absolutely. I feel like we've talked a lot about the downsides, but you do have some stars that maybe you're quite excited about. How about we finish on that? Because there have been some breakthroughs, there are some outperformers, and I think really it's going to be about that. What is working right now that you have seen in this sector?
Yeah. So I see, I'm tracking 3 key operating parameters for all the companies out there to judge whether they are taking the right steps. So I guess if your revenues are deflating for a right strategy, that's absolutely fine, because when technology changes, you need to be more proactive and follow your clients. So I guess if your net new order book is growing well, that's a sign that you have a high AI relevance, even though your revenue growth might not be very strong because you are passing on the AI deflation benefit to the clients. Secondly, your revenue per employee should keep improving because AI is a big efficiency lever. And if revenue per employee is improving, that's a sign that you are infusing AI into your solutions. And thirdly, your EBIT margin should also expand. One, you are signing a lot of outcome-based contracts, wherein the token cost is a sort of input in your overall outcome. And you need to make sure that your gross margins are expanding more than the token cost in your P&L. So which is where we believe net new order book, revenue per employee, and operating margin, these 3 are the best parameters to track the performance of these companies. And which is where I believe, in the mid-tier space, Coforge, Persistent are doing very well. And in the large cap space, Cognizant, Accenture, and Tech Mahindra in India, these 3 companies are.
All right, we're going to have to wrap it up there, but thank you so much, Sumit Jain from CLSA. Thank you.
Thank you.
All right, well, the market is open in Mumbai, so we'll be back in 2 to check it out.
Listen to CNBC on the move with the CNBC app.
What a strong number this morning.
Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe. Welcome to the China Connection. Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Don't miss the highlights of the PGA Tour. Catch the action from the PGA. The biggest hits and misses. Join us on the green. Saturday and Sunday afternoons, only on CNBC.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell, weekdays streaming on CNBC Plus.
Markets are now online. The Nifty is having a little bit of a pop at the open, up 0.2% or so right now. And also the rupee opening pretty much unchanged again, and this has been quite consistent over the last week or so. Traders telling Reuters that the Indian Central Bank is likely selling US dollars to support the rupee, that around 95.65. But like you can see, just pretty much around the unchanged mark as those markets come online. Let's look at some of the movers in Indian markets today, though. Shares of Gas Authority of India are moving. This after regulators approved the building of nearly 2,000 kilometers of new LPG infrastructure to boost its energy supply resilience. The pipeline will run through 6 states and boost in India's LPG network by around 20%. There is a market debut to watch in Mumbai today. Horizon Industrial Parks, which is listing on the Indian exchanges in the next hour. The Blackstone-backed logistics platform has raised about $270 million, with the offer subscribed 1.45 times. Institutions bid nearly twice their allotment. Retail fell just short of full subscription, though. Expectations for the debut are modest. The grey market pointing modest gains of about 2% at the open, above its 60 rupee issue price. All right, we're going to turn now to Japan. The economy there may be slowing, but tourism is still a bright spot. Our travel and transport reporter, Monica Petrelli, is at the desk with more. And I have to say, I'm wondering if this has got something to do with the currency, but I guess you're going to tell us.
The currency definitely is attracting people to go there, but costs are rising, and I can explain more here. But one thing that's not rising is the international arrivals. In fact, from Jan to July, arrivals to Japan dropped about 1.7%. Now, that's not much considering the fact that one of its major source markets, China, is down about 56%. Everybody else, though, is going in more and more higher levels. So that said, and interestingly, India arrivals are up 22% this year. But so that said, I was really wondering, well, how is this affecting the travel market and the tourism companies there? And what I'm seeing is record revenue for many companies, but not necessarily translating down at the profit level. And that really depends upon the cost. And I think nowhere is as clear than with the airlines. JAL, ANA, double-digit jumps in revenue for April to June of this year, but of course, huge hits on costs because of jet fuel. But But we can isolate that. We can look at Japan Airport Terminal, which operates the terminals at Haneda. There we can see operating profit up 41% because they're not having to deal with that jet fuel issue. And that's really on the back of retail sales, namely in the international terminals. Now, revenue also up at the major rail services in Japan as well, 3% at JR Central, 8% and a record level over at JR East. Both companies, though, talking about rising costs for personnel and maintenance of the rail services. But only JR East is the one that saw the big operating profit boost, up 10%. And again, here we see costs going up. The company put across-the-board fare revisions up in March, and retail sales, again, from the stations. If you know, you know. A lot of people call those railway stations like a food paradise. But one company that I looked at has a record operating profit, and that was Oriental Land. This operates Tokyo Disney Sea, celebrating its 25th anniversary this year. So many people are coming, spending more as well. And what are they spending on? Merchandise, food, and Premier Access. Don't want to wait in the lines.
Wow, good stuff. I can say I've had some amazing udon noodles at a train station in Japan. That's all we have time for. That was Inside India. Stay with us on CNBC.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
This is not just good content, this is good business. It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
I'm with Becky. This is the greatest show on earth.
Squawk Box, streaming on CNBC Plus.
All right, let me tell you about ambition. Too much is not enough. Don't just waste this life. Set the goal really high and go all out. And then you create another vision, and another vision, another vision. So that's being ambitious. This is what it's all about.
I think if I knew how complex was trucking, I think I would have thought again. So the unknown was very helpful.
Gaurav Biswas thought he had landed on a simple idea. Uber, but for trucks. There was just one problem. He had never moved a truck in his life. Then one day at dinner with friends, he saw a problem he had never thought much about.
He was constantly having to walk out of the restaurant, and we could see that he's arguing or shouting with somebody. I was like, hey, is everything okay? He's like, oh, I have 7 containers that have to go on the same vessel tomorrow. Then I said, hey, you should have an Uber of trucks.
That idea became Trucker, a digital freight platform that connects companies that need to move cargo with the truck owners and transporters that carry it.
Trucking is extremely important as a sector because whatever you touch and feel, consume, it's all touch the truck. Whether it's a seaport or an airport or a factory, the trucking is that connector.
Streaming on CNBC Plus.
Good Monday morning. Welcome to Access Middle East. I'm Dan Murphy here in Abu Dhabi. Straight to your top stories this hour. First today, Economic D-Day. Treasury Secretary Scott Bessent set to unveil what he calls the toughest sanctions in Iran's history. vowing to use the full might of the United States to force the regime into submission. Plus, tit for tat, Iran claps back, claiming it will shut all oil exports from the Gulf and target countries that join U.S. sanctions efforts. And oil prices attempting to navigate the headlines as the war nears the 6-month milestone. Crude is lower today, coming off 2 straight weeks of gains. Welcome to the program this Monday morning. It's just past 8 a.m. here in Abu Dhabi, and pretty extraordinary to think that we are nearing that 6-month milestone for the Iran war, which we will mark on Friday of this week. Okay, let's dive straight in. Here's a live look at how markets are doing across Asia. Traders looking to recover from a losing week last week as global bond yields surged. The 30-year US yield topping 5.3%, its highest in nearly 2 decades. Rates in Japan, France and Germany also hitting multi-year highs. So investors may be fearing a prolonged US-Iran war that will keep oil prices and inflation elevated. That seems to be playing out across Asia this morning. You can see the Hang Seng down by more than 2%, the Kospi down by more than 3%. Losses in Japan as well, with the Nikkei 225 down by around 0.6%. Oil prices also pulling back this morning. Prices cooling off, but we could get a pop as Washington outlines its sanctions against Iran. Crude staying hot due to elevated supply risks in the Strait of Hormuz. At the moment, Brent trading around 93 USD. We're off by around 1.4% this morning. WTI at 85.63, also 1.6% weaker. To our top story now, and Washington is preparing its toughest ever sanctions campaign against Iran, what Treasury Secretary Scott Bessent is calling economic D-Day. In an op-ed for the Financial Times, Bessent invokes the Allied planning for the Normandy landings. He writes, quote, "At dawn begins an economic D-Day, the single greatest financial offensive ever marshaled against an adversary." Bessent says the US is now entering the end game and that the objective is to, quote, "sever every economic lifeline that sustains the tyrannical regime until Tehran stands alone." Bessent also makes clear that Washington is putting everything and everyone in the crosshairs. He writes, "Any remaining tie to Tehran will hasten the economic ostracism of countries and entities, whether that tie be purposeful or willfully ignored." Iran is answering that threat with a threat of its own to the world's oil supply. The Secretary of Iran's Supreme National Security Council, Mohsen Rezai, said on social media that, quote, "Not a single drop of oil will be exported from the Strait of Hormuz or from anywhere in the Persian Gulf." He also said any country supporting America's economic war will be treated as an act of war.
We will first negotiate with them. We will hold talks and tell them to step aside and distance themselves from the United States. But if they do not act, we will strike. We will target that country's interests.
Iran's Foreign Minister Abbas Araghchi also dismissing America's threats as a sign of desperation when he spoke to press on Sunday.
They must understand that there is no option other than respectful dialogue with the Iranian people and a solution based on justice and dignity. They should put all of these aside and return to a path that has been tried before. Iran's nation will respond respectfully to the language of dignity.
We have so much to unpack this hour with my first guest. Neel McBurney is here. She is Head of Analysis and Director, MENA at Control Risks. Neel, welcome into the program. Great to have you on this morning. First and foremost, you've just heard there, Bessent calling this economic D-Day. What do you think could make this campaign different from the sanctions that we already have imposed on Iran? Good morning.
Good morning. It's good to join you and your viewers this morning. Well, I mean, that is the major question. The administration has, over the last 18 months, since President Trump came back into office, added layers and layers of new sanctions, and there have been some in the last several weeks since the waiver was lifted, that was agreed as part of the MOU. The question for me and fellow analysts now is, how is this going to be any different from the maximum pressure 2.0 campaign that President Trump announced at the beginning of his second administration. At the time, a lot of us pointed out that there was an inherent flaw in the White House's policy that ironically, that in order to enact the kind of maximum pressure that Trump and Bessent and others said they would like to impose, that would require a blockade. And now, 18 months later, we have those circumstances. What's very difficult to see is how much Iranian crude oil and maybe some refined products are being exported out of Iran. We don't have any reliable data. Both the US, whether CENTCOM, in publicizing how many ships it's prevented from moving out of the Strait of Hormuz from Iranian waters, or Iranian themselves. Neither of them have an interest in being open in how much is actually moving through. So it's very difficult to see how much Iranian crude is getting through the market. I suspect there is some. What we do know is that the Chinese are exporting in the region of 300,000 barrels of oil a day by train. And as this economic pressure intensifies, presumably from today, the Iranians and their partners such as China will find other ways in which to move goods, not just crude oil, but others. So the question is how much more of a physical blockade is the US willing to impose on Iran? It's our assessment that the current deployment of personnel and material in the region is really at the limit of what the White House is willing to accept, that ultimately President Trump wouldn't like to see any more American fatalities than we have already in this conflict. So to be honest, it's really an open question as to how much more the administration can do. The major thing will be secondary sanctions on third countries. And to be honest, the wording in the Financial Times op-ed this morning is implicitly incredibly robust, that this is the path the administration is willing to take. But it is an open question as to which countries they're looking to target, what costs the White House is willing to bear because of the impact on those relationships. And of course, we have to remember here the president's upcoming visit to China in just 4 weeks. So there's a series of tensions and kind of challenges in the policy itself. So we really wait and see what will actually be imposed and what will be announced, but also how it will be imposed. I suspect there will be probably a significant gap there, like we have seen in the past.
Neel, to your point as well, one of the key questions here is, which of Iran's remaining economic lifelines is Washington most likely to target first? And the answer to that question right now, at least, is that we simply don't know. We know that these measures are going to be quite extensive. The Treasury Secretary has made that clear in the FT piece this morning, but exactly what this looks like remains to be seen. The other interesting element to this is that the Treasury Secretary has said Washington is entering the end game as well. Neel, to your mind, what is the end game?
That is an excellent question, because the administration's endgame has been different things at different times in this war. On the first day of the war, on the 28th of February, it was in order to unseat the Islamic Republic governing system. By just about 2 weeks ago, according to J.D. Vance, it was in order to keep American energy prices low and also to ensure that Iran never attains a nuclear weapon, which, depending on your interpretation of a current Iranian policy, which is that it hasn't and won't, as it stands, has already technically been achieved, the second of those 2 points. I suspect the end game right now is to create conditions in which to extract the administration from this war. That may take a long time, and the administration may have an appetite for this to continue for some time in this kind of slightly uncomfortable stasis and equilibrium, if we can call it that, over the next couple of months. But I do think that is the primary end game. We still haven't seen over the last 2 weeks any more willingness by either the Iran or the US through any leaked comments to the press or any that I and the fellow analysts who watch this closely are aware of any progress on the substantive points that remain barriers to progress in moving on to the nuclear negotiations. By that, we're thinking of making sure that both sides agree on the status of the Strait of Hormuz, and on the conditions surrounding that, including the release of oil revenue funds to Iran. So in that kind of lack of diplomatic progress, although both Qatar and Pakistan, their diplomats are very much working hard to try and create common ground for both the US and Iran to come back to the table on that front. In the absence of that progress, that the US ultimately will need to create the conditions in which to extract itself. So although we could be looking at months, because ultimately, the administration would like to do that in a way that doesn't look like it is, exiting the war without being able to declare victory. I suspect that is the ultimate end game at this stage.
Right. And Neel, as well, you mentioned China. I think China is going to be absolutely critical to watch here, not just the measures that are likely to be leveled against China, but also China's response in anticipation of that meeting between Presidents Trump and Xi. China, of course, remains the top buyer of Iranian crude. It is Iran's most important remaining economic partner. Do you think Washington is actually prepared to sanction major Chinese institutions to make this campaign work? And as an extension to that, what about here in the Gulf? How exposed are the Gulf trading hubs and other regional economies here to some of the measures that Bessent has described?
So I think, despite the incredibly strong language in, the Treasury Secretary's op-ed this morning, I do think that there is some reluctance in the administration to take a very aggressive stance against large Chinese institutions. I mean, to do that in merely weeks before the president goes to visit President Xi and to try and rebuild the personal relationship, to smooth over the economic challenges and political challenges that there are in the relationship, would be quite unusual, I would say, and would be fairly self-defeating. So I suspect there is a limit to what the administration is actually willing to pursue against Chinese institutions. It may look to target some of the kind of mid-sized teapot refineries, those that it hasn't already, but those are relatively small fry in terms of targets of and the amount of money that they are trading with or engaging with Iran as individual partners, so not at an institutional level, large banks and so forth. But when it comes to the wider Gulf, I'll be honest, that was one of the things that really struck me was the Treasury Secretary's language. It made very clear that countries in the Gulf that do engage in trade with Iran, the UAE, Oman, would implicitly be included. If you look at how he lists what the administration now considers unacceptable engagement with Iran, everything from accepting flights coming from Iran to trading goods. There are countries in the Gulf region that are undertaking those actions right now, despite maybe some kind of public statements that suggest otherwise. So I think there's going to be some serious consideration within Gulf governments, how they navigate this over the next couple of weeks and months. I'm sure there's very, very kind of significant communications between regional capitals and Washington to make sure that they're not unintentionally or even, frankly, even intentionally caught in the line of fire. But it is going to be a difficult moment for the Gulf countries. Their relationships with the Trump administration are going to be key here. Using their relationships, their leverage, their ability to influence either individuals or institutions within within the administration to make sure that they are not as acutely affected, and ideally that the administration looks to target other countries elsewhere. Although that would also have its costs: Turkey, Pakistan, China, among others. So yeah, it's going to be a challenging moment, I think, for the Gulf states over the next couple of months, those that trade with Iran.
Indeed. So watching and waiting to see exactly how this region responds. More broadly, though, let's talk about the impact inside Iran as well. Local Iranian media reporting that the dollar was trading at 2 million reals at the open market on Sunday. Obviously, huge economic consequences already as a result of this conflict inside that country. And the people who hurt the most are your average everyday Iranians, not necessarily the regime, not necessarily the private sector or big business. It's the people on the ground who suffer the most when these economic measures really start to bite. So I'm curious to know, how quickly could this tougher US campaign translate into more visible economic pain inside Iran? And does this pressure have any effect to weaken the Iranian leadership at all? Will it eventually result in maybe some kind of change inside the country, to acquiesce here, to return to the negotiation table? Or inside Iran, does this country still have the capability to put up a front here and put up a fight against what could be these really tough new measures inbound?
It's an incredibly important point, and I mean, to your question, I mean, Iranians this morning, ordinary Iranians will be feeling the more acute effects of the situation because of the devaluation of the rial just over the last couple of days. That is an extraordinary weakness that it now has. And so, I mean, just briefly coming back to the kind of transnational relationships that Iran has, my point about the physical blockade that the US is willing to bring to bear is that Iran borders a great number of regional countries with which it has many trading relationships that can be expanded. There are limits to what the US can do. There will be means the government has and companies linked to the government to import goods that will soften the blow. And my understanding is that has increased significantly over the last couple of months. The data is very, very poor to give us the kind of solid evidence for that. But my understanding is that has been the case. So that will help. But the overall driving up the prices is going to be a real challenge. I think what's important for us to all remember is that economically prompted or driven political revolutions take years. Historically, they are not fast, they are extremely complicated, and they often have, if they are in some way managed to create a political aim, they're very, very difficult to guarantee the end game, which is why I think ultimately this effort is probably going to be unsuccessful, and we're looking at a more short-term end game goal for the administration.
Okay, Neel, we'll watch and wait to see what comes of that announcement from the Treasury. Thanks so much for your analysis today. That is Neel McBurney there from Control Risks, live with us out of Dubai this morning. Thanks again, Neel. And trade tensions back in focus after U.S. Canada talks collapsed in the 11th hour. The U.S. has now imposed 50% tariffs on a range of key Canadian sectors, including wine, dairy and autos, covering around $20 billion worth of Canadian exports to the U.S. In response, Canada's Prime Minister Mark Carney pledging retaliation.
Canada will match Washington's new tariffs dollar for dollar in order to protect Canadian workers, farmers, families, and businesses. Our response will be concentrated in sectors such as steel, dairy, appliances, agricultural equipment, pulp and paper, and electronics. Also include products that are currently subject to unjustified Section 232 and 338 tariffs. This is a focused response to protect and defend our industries and allow them to compete with U.S. products in the Canadian market.
America's new tariffs also include products that were previously shielded by the North American Trade Pact. Carney there explaining he was concerned about tariffs on medium and heavy-duty commercial vehicles. He also suggested the U.S. wanted to bar Canada from further trade deals. Meanwhile, the US insists that Canada had received the best possible offer. Here's the US Secretary of Transportation, Sean Duffy, speaking on Fox News.
We're great trading partners, right? But Canada gets the benefit of trading with the U.S. way more than the U.S. gets the benefit of trading with Canada. It's a country that doesn't have a military. We want fairness for the American worker. And some of our best friends are the worst offenders that treat us the worst. And the fact that we provide their security for them and they take advantage of us, I think President Trump was the first one to go, you know what? That's not the kind of relationship that friends should have. And so the president's calling them out. I think you're going to see Mark Carney come to the table very, very quickly because it's going to be devastating for his country.
Of course, it's becoming a big political issue in the United States as well. The California Governor Gavin Newsom actually posting on X over the weekend. He said, "Our closest ally, our critical trading partner, and Trump is hitting Canada with 50% tariffs. What the actual are we doing?" All right, moving on now. Middle East markets closed mostly higher over the weekend. Saudi Arabia's Tadawul leading gains up more than 1%, and Kuwait up almost 0.8%. Abu Dhabi, the only market to close lower, down 0.7%. You're live on CNBC. Stay with us this morning. Access Middle East is back in 2 minutes.
Abu Dhabi has now been branded as the capital of capital. There really are few places in the world where the concentration of sovereign wealth funds and smart investors.
It's a great place to work and live. I mean, living in Abu Dhabi, it's a very safe, secure city.
I love it so much, I don't think I'll ever leave.
Any company that's looking to grow and expand can really look at the Hub 71 Accelerator Program, the ADGM ecosystem. We couldn't have found a better home.
Everything is there for you to succeed here.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC Plus.
Welcome back to the program. Well, all eyes on NVIDIA this week. We have eyes on NVIDIA every week, but all eyes on NVIDIA this week in particular. It is the last of the Mag 7 stocks to release its report card, earnings due on Wednesday. In terms of key economic events to watch, the Kansas City Fed hosts the annual Jackson Hole Symposium from Thursday this week. New Fed Chair Kevin Warsh set to speak for the first time. CNBC's Steve Leisman has a preview of what to expect.
Markets seem likely to get some of what they're after from new Fed Chairman Kevin Warsh in his speech in Jackson Hole. That is, more on rates and his views on the economy. Meanwhile, the new chairman faces new challenges from higher bond market rates. Expectations for the new Fed chairman's first keynote at the conference include more detail on his economic views and the outlook for rates, updates on his 5 task forces, and clear statements on how he will react to higher inflation, that is, dispelling any notion that he's unwilling to hike interest rates. It would make sense of Warsh to make a distinction between how much detail he gives about his outlook after a press conference, that is, when he speaks for the committee, and how much he gives when he's speaking for himself. Many in the market are hoping for more.
I just think we need to know the reaction function. I just think we need to know, what are you looking at? What is important to you today? Is it more inflation? Is it more employment? Are you looking at, by the way, there's a series of indicators in employment. Are you looking at demand, supply? Are you looking at a whole series of different indicators? To get some clarity on that, then markets can do their job in interpreting it and putting a price on it.
John Hartley, policy fellow at Hoover and economics professor at UT Austin, telling me, my guess is that Jackson Hole will tilt toward being a hawkish event as the FOMC is moving towards trying to tee up rate hikes in late 26 and 2027. The conference this year focuses on financial innovation and its effects on banking, monetary policy, and the global financial system. But the unofficial agenda will likely include the Treasury's attempts to tamp down high bond yields and how that might or might not end up involving the Fed. Our full coverage, including newsmaking interviews, starts Wednesday with a special edition of the CNBC Fed Survey, all of it live from Jackson Hole.
And speaking of central banks, the Bank of Japan reportedly considering a faster pace of rate hikes ahead of the September meeting. Our East Asia reporter Lisa Kim joining us live now with all of the details on what to expect. Lisa, this is going to be important to watch, particularly given the movement that we've seen in yields over the last week.
Absolutely, Dan. So BOJ is considering hiking rates more aggressively from the current pace of roughly once every 6 months. That's according to a recent Nikkei report. It echoes other media reports that we've heard over the past week, including one from Reuters. And that's because BOJ is really concerned about falling behind the curve or letting inflation get ahead and the BOJ having to play catch up, which some analysts say that the BOJ is already playing and that the BOJ has already fallen behind the curve. The BOJ last hiked rates in June, and they will be meeting next month, which is the earliest time frame that the BOJ can hike. Japan's core consumer inflation over the past couple of months have boosted the case for a rate hike, plus the joint intervention by Japanese and American authorities in late July to strengthen the yen has undone almost half of the gains, which makes another case for a rate hike. Treasury Secretary Scott Bessent told CNBC earlier this month that he was, quote, highly confident that Japan's policy would follow up with the intervention. Some key events to watch this week is on Thursday, BOJ Deputy Governor Himino is expected to speak at an event, and so investors will be keeping tabs to see if he offers any hints about BOJ's rate hike trajectory, as markets price in an 80% chance of a hike happening in September. Also, Governor Ueda might attend the Jackson Hole Symposium this week, and we will hear from Japanese financial authorities who are set to attend the G20 meeting slated to happen over in the States next week.
Lisa, appreciate it. Thanks again for the update. We're off for another quick break here on the program, but stay with us. We're back in 2.
Asia trading day begins. Join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region covering what you need to know from here and around the world that would shape the business day.
We know there's 2 winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have 2 small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
Still wheels cry.
Welcome back to the program. It's just gone 8:30 a.m. here in Abu Dhabi. Let's recap our top story this morning. Washington now preparing its toughest ever sanctions campaign against Iran, what the Treasury Secretary Scott Bessent is calling an economic D-Day. We've been talking about this op-ed that he has written in the Financial Times, Bessent invoking the Allied planning for the Normandy landings in that piece. He also writes, and I quote here, "At dawn begins an economic D-Day, the single greatest financial offensive ever marshaled against an adversary." Bessent says the US is now entering the end game and that the objective is to, quote, "sever every economic lifeline that sustains the tyrannical regime until Tehran stands alone." Bessent also makes clear in this piece that Washington is basically putting everything and everyone in the crosshairs. He writes, and I quote, "Any remaining tie to Tehran will hasten the economic ostracism of countries and entities, whether that tie be purposefully or willfully ignored." Now, in terms of the market reaction so far, we are seeing oil prices pulling back just a little this morning. Both benchmarks, of course, rose 4 to 5% last week. I flagged earlier that we could possibly get a pop when the Treasury Secretary stands up later today to detail some of these sanctions. But so far, the market has been selling the news. You can see WTI down by around 1.7% this morning. 85.60 is where we stand. Brent holding on to that 93 USD handle, down by 1.4%. Let's get a take on what could happen next. Sarah Bakshuri is here. She is founder, president of SVB Energy International. She joins me live this morning. Sarah, welcome back to the program. Great to see you as always. First and foremost, let's talk about what I was just explaining. The Treasury Secretary Scott Bessent now preparing to unveil some of the harshest measures against Iran in history, he says. What do you think is in store for markets when the Treasury Secretary speaks later today?
Thank you, Dan. It's always a pleasure to be back in your program. So if you look at it from the global markets perspective, something that is very important to consider is that how is going to impact on the flow of energy molecules from Strait of Hormuz and also physical barrels of Iran. Iran has already been under the maximum economic and energy export pressure, and its physical barrels, the export of its barrels have been already reduced due to the U.S. blockade. So Iran's response in terms of retaliation could have consequences on the flow of energy if you want to look at it from global perspective. Otherwise, this would just be another headline. It's not going to have huge impact. So Iran's response is important, but also it's important to know what is this maximum economic pressure, because Iran is already under maximum pressure.
Indeed. So the question is, how effective will these measures actually be in bringing this regime to its knees, as the US stated goal and objective is? The other interesting thing we haven't necessarily discussed yet is Iran's reply as well. When Iran says not a single drop of oil will leave the Persian Gulf, should we interpret that as a threat to its own exports or everybody's exports in the region?
So something that is important to consider is that since the beginning of the war, because multiple layers of Iranian leadership have been eliminated, and according to President Trump himself, it's very hard to understand whom to negotiate with. So it seems that President Trump's maximum economic pressure is aiming to somehow bring whoever is in charge back on the negotiation table in the terms that U.S. is requiring. On the Iranian side, they would definitely follow a dual track of having a threatening and aggressive rhetoric, but also pursuing diplomatic solutions, the same method that they have been following since the beginning. But again, we've seen that Iran has actually retaliated. So depending on how they are going to choking off Iran's economy and export, we could expect that Iran could retaliate. So single drop of oil, yes, we could see retaliation, but again, what is U.S. response? And Iranian actually perceiving these sanctions as Iranian, the Ministry of Foreign Affairs said, kind of a desperation, being in a state of desperate from the U.S.
Right. And Sarah, let's also talk about the market reaction here. I flagged just before, prices have come down a little here. We're looking at WTI back to 85, Brent at 93. What do you think's happening with the market at the moment? And are traders necessarily taking the Treasury Secretary's threats seriously? Or is the market underpricing the risk that we could see a significant escalation here, at least economically?
So the market, somehow is getting accustomed, perhaps, to the multiple contradicting headlines, both aggressive and threatening, and then the headlines that are kind of on the other side of the spectrum, the peace, positive and negative swing of the headlines. So definitely what is important is that how these sanctions are going to impact the physical barrels and export from the Strait of Hormuz, which it seems that Iran is already under the sanctions, and U.S. blockade have been more already impactful on the reduction of its oil export. Nevertheless, Dan, I'm talking with you from Tokyo. I've been here more than 10 days talking to multiple stakeholders here, and this the impact of the war on global economy is asymmetric. Countries like Japan and Asian countries that are major importer of energy from this region are hitting so hard, and they're significantly exposed both to the access of the energy but also the prices. So we've seen that countries like, again, Japan, in all the discussions we had, they're looking into multi-track strategies to both increase their resilience domestically, find alternative sources, but also cooperate with countries in the region, GCC countries, to expand alternative routes and also increase the capacity, particularly storage capacity, outside of the region.
Expand on that for me, Sarah, because that's an interesting point as well. You mentioned you've been in Japan speaking in real time to partners on the ground. What type of reaction are they having to these developments, and what alternatives do they have, particularly those large Asian buyers of Gulf and Middle Eastern energy, to the Strait of Hormuz and these crippled choke points across the region?
It's extremely hard for them to look at alternative. Definitely United States and oil from Western Hemisphere has been the major alternative for them, but the government is looking at multiple solutions. The one most important thing is to find substitution for the energy supplies of the Middle East. And the discussion is that how to make these imports and import diversification in terms of source of import prolonged within the medium to long term. The second factor is that how they can reduce their demand and dependency on the energy sources, particularly oil. And they are looking at multiple ways, including the innovating technologies like hydrogen. How could they substitute some of those demand? And the third factor is the alternative routes. So there are a lot, unfortunately, it seems that while we are not seeing a lot of appetite for investing in Middle East, but the investment in alternative routes and also expanding the capacity for storage of energy resources, particularly oil and product outside of the region, is pretty high in their agenda.
And Sarah, what do you think the long-term implications of this conflict are going to be in global energy investment? I think as a result of us coming up on this 6-month milestone on Friday of this week, there's a lot of conversations, a lot of questions happening now about the implications for this region when it comes to capital and investability, when it comes to energy and flows of crude and products into the future. How do you see the global energy system being reshaped by what has unfolded over the last 6 months?
This is very important, Dan, because clearly the world, and especially the major importers like Asia and Japan that now I'm here, is very different than before. So definitely the global energy system landscape has been changed. Even if we had a scenario that everything would go back to the pre-war, which many people don't really expect it anymore. So definitely alternative routes are in the agenda, but as the other alternative routes to the Strait of Hormuz being targeted also and being prone to attacks, we see that a lot of changes and a lot of precautions are being taught to increase that resilience. And what we think is that this is going to create a huge investment opportunity in the region. Why is that a lot of these countries might think that instead of importing the molecules from the region, they could reuse them and utilize them domestically within the region to basically bring their demand within the region. So there's going to be a lot of interesting changes regarding the export routes, but also do we need to export all these molecules outside of the region versus using them domestically? And the third factor is there's going to have impact on the demand. In Asia, particularly Japan, there is a lot of investors and companies are significantly looking into some of those innovating solutions that they had, and they did not look economic as a potential way that is going to have a good market now to invest and somehow change the behavior and change the demand from one source to other sources.
And Sarah, before I let you go, let's talk about the elephant in the room here, which is China. It's very likely today that when the Treasury Secretary speaks, China is going to be in the crosshairs. It buys most of Iran's exported oil. What happens if Washington directly threatens things like Chinese refiners once again, or even Chinese banks with losing access to the US financial system? What could the fallout potentially be here? And as an extension to that, when you look at the US-China relationship coming into the meeting between Presidents Trump and Xi, how concerned should global investors be about what could be yet another fracture in this very fragile partnership?
This is very important, Dan. There is a lot of concern that this hard, tough economic sanctions that has been mentioned by U.S. administration on Iran is not necessary to target Iran, but on secondary countries, on those countries that are importing from Iran, which China definitely is the elephant in the room, as you mentioned. So are these sanctions going to directly impact China or targeting China? That's a question to be asked. But also another question that China has been posing to the market is that since the beginning of the war, what has been proved to the market is that China is now a swing consumer. The sheer amount of reduction in China's import and also consumption has created all these questions that what is China's capacity to swing this volatility of its import and consumption? So these are two big questions to be answered. But definitely what is clear is that higher energy prices is going to be taxed on consumers and make the global inflation more complicated, with a special note that all of these impacts on global energy security and economic security is asymmetric and has different impact. The countries that are significant importers of energy, especially from the region, are going to be hit harder. They are highly exposed, and on the other side, the countries that are major exporters, let's say United States, are definitely less impacted by this conflict.
Sarah, always appreciate your analysis. It's always great to have you on the program. Thank you so much for taking the time to speak with me this morning. That's Sarah Kashkari there from SVB Energy International. Looking forward to catching up soon. And a couple of earnings we are watching in the energy space as well. Sinopec out of China reporting a 19% increase in first half net profit to $3.8 billion. That is despite volatile oil prices and weak domestic fuel demand. This is the world's largest refiner and relies on the Middle East for half of its crude oil needs. It processed 5.6% less crude in the first half compared to a year ago, but refining operating profit surged more than 380%, helped by sourcing more crude outside of the Middle East and optimizing its product mix. Sinopec saying it expects crude throughput in the second half to be largely flat compared to the amount processed in the first half. Sinopec also setting aside 16 billion yuan in asset impairment provisions. Staying in energy, and shares of Ampol are up over 3% in Sydney today. Australia's top fuel retailer also getting a boost from higher refining margins, and reported first half underlying net profit surged nearly fivefold to a record high. Ampol runs one of Australia's 2 refineries where profit margins more than tripled in the first half to $28.26 per barrel following supply disruptions in the region. Earnings from its fuel and infrastructure business also rose more than ninefold, helping to drive what was a record result. And shares of PLS surging 7% in Sydney as well, the lithium miner posting record annual production and sales, with revenue surging over 150%, net profit after tax surging a whopping 369%. The company also reinstating its dividend after a 3-year hiatus. CEO Dale Henderson spoke to Squawk Box Asia in a First on CNBC interview earlier this morning about his outlook for lithium pricing and demand. Take a listen.
The lithium industry has got some really exciting tailwinds. The demand vectors are broadening and deepening. And as you say, battery storage is one of the emerging subsets. And just to give you a couple of numbers, year to date and year on year growth, it's been very, very strong. So in Europe, 96% on the prior year. And in Asia, excluding China, a huge 258% growth on the prior year. And the rest of world category, as they call it, 93%. So this is all in the category of energy storage, which is separate from EVs, e-mobility and the like. So the results speak for itself. And when you look at what's being invested across AI and data centers, well, more of that is yet to be built. So lithium will be a benefactor of that energy storage being deployed. So a fantastic place to be as a scale producer.
So which part of the price path for lithium felt structural to you, or how much of it was really perhaps a sentiment driven to a degree, or inventory driven? You know, sitting where you're sitting from your vantage point at a major producer, how much of it was really structural?
Sure. Well, I think probably the place to start is lithium industry outright. It's a relatively young industry growing from a small base. And so there's been sort of two dynamics at play. One has been related to the fundamentals of supply versus demand. And we've been seeing that sort of play out. And as I mentioned, the demand side incredibly strong, and supply has ebbed and flowed depending where we're at in the market. So there's been that element. But the second element that you touched on has been sentiment. As a function of a relatively immature market, what we've seen is pricing has had a way of running sometimes ahead and sometimes in both directions at odds with the fundamentals. Now, that cuts in both directions. So historically, we've seen pricing run very, very high, and we've also seen it run very low, well below sort of the cost of production of many of the low producers. So as I say, that's a function of an immature market. In time, we see that improving, and as the industry gets more scale and more price discovery mechanisms come to bear, I think that will come out. But in the meanwhile, I think it will remain volatile.
And stay with us here on the program. We're off for another break. We are back in 2 minutes.
Abu Dhabi has now been branded as the capital of capital. There really are few places in the world where the concentration of sovereign wealth funds and smart investors.
It's a great place to work and live. I mean, living in Abu Dhabi, it's a very safe, secure city.
I love it so much, I don't think I'll ever leave.
Any company that's looking to grow and expand, really look at the Hub 71 Accelerator Program, the ADGM ecosystem. We couldn't have found a better home.
Everything is there for you to succeed here.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Syria and Israel have held high-level talks in Jordan aimed at reducing tensions following recent Israeli strikes on Syrian territory. Syria's state news agency says the US-mediated meeting focused on halting strikes, arrests and targeted operations while reviving negotiations towards a security agreement. Damascus says it wants Israel to withdraw to positions held before the fall of former President Bashar al-Assad in December of 2024 and to fully restore the 1974 disengagement agreement. The talks mark a resumption of contacts that were suspended during the Iran war as Washington continues efforts to broker a security deal between the two longtime adversaries. Meanwhile, the UAE and Russia's trade in services and investment agreement has entered into effect, aiming to expand market access, strengthen investor protections, and boost private sector collaboration across high-growth services sector. Signed in August last year during President Sheikh Mohammed's visit to Russia, the deal covers sectors including fintech, healthcare, transport, and logistics. Russia remains a major economic partner for the UAE, with bilateral non-oil trade reaching over $20 billion last year, almost a 78% increase compared with 2024. The deal with Russia is part of the UAE's broader foreign trade agenda, which aims to increase non-oil trade to $1.1 trillion by 2031. The UAE and Egypt are looking to deepen energy ties. The CEO of ADNOC Drilling, Altaya Al-Masabi, met the Egyptian Minister of Petroleum and Mineral Resources on Sunday to discuss ADNOC's participation in Egypt's drilling program. Egypt has expanded its onshore and offshore well drilling as part of its 5-year plan to boost local crude and natural gas production and aims to team up with more international companies to tap into their expertise. And the Formula One chief executive, Stefano Domenicali, says the sport remains on track to stage its 2026 season finale in Abu Dhabi, dismissing speculation the race could be moved because of regional security concerns. Speaking at the Dutch Grand Prix, Domenicali said the calendar is confirmed and preparations for the December 6th event are advancing as planned, with ticket sales continuing. Formula One cancelled its Bahrain and Saudi Arabia races early this year as the war in the Middle East raised security concerns, prompting discussions about possible alternative venues in Europe. But he also said Formula One is focused on delivering the schedule it announced at the start of the season, while Abu Dhabi officials say they look forward to hosting the championship decider for a 17th year. Saudi Arabia's Crown Prince Mohammed bin Salman is in Paris for a 2-day visit. The Crown Prince attended the closing ceremony of the Esports World Cup on Sunday, the first time the competition has been hosted outside of the kingdom. MBS will also be attending the French-Saudi Business Forum and will be having bilateral meetings with French President Emmanuel Macron today. The two leaders are expected to sign off on several agreements on health, transport, and energy. And staying with sports, the annual humanoid robot games have been underway in China. Our China reporter Elaine Yu joins us live now. She's been keeping tabs on all of the key developments. Elaine, walk us through it. What do we know?
Yeah, the World Robot Conference has just wrapped up and a range of robot skills were being put to the test. They were seen running, boxing, playing ping pong with humans, doing high jumps, and people have marveled at these performances in the past year, but this year's focus is very much on how well these robots can perform practical tasks, especially in light of Unitree's blockbuster listing last week, where investors have questioned how long until these robots can be commercially deployed. But we did see a robot using tweezers to pick out beans, which take dexterous hands, which are notoriously hard to engineer, and one was also loading up a washing machine. But the footage shows that it's still pretty far off until they can reach a human's level of efficiency and dexterity, and that explains why a lot of the revenue that these Chinese humanoid companies have are still from government orders. But these robots are also proving to be serious athletes, even beating humans at their own game. A robot called Tiangong Ultra, developed by the Beijing Humanoid Robot Innovation Center, won a preliminary heat in Beijing on Saturday, beating Usain Bolt's world record last set 17 years ago. But the robot also slammed straight into a man after finishing. So next year they'll have to learn to slow down before and not crash. Back to you.
Maybe something that Usain Bolt wouldn't do. Interesting to watch. Okay, Liam, we'll leave it there. Thanks again for joining us today. Turning now to Japan, and the economy may be slowing, but tourism is still a bright spot. Our travel and transport reporter, Monica Petrelli, joining us live now with more on the story. Hey, Mon, what are you tracking today?
Yeah, good morning, Dan. Well, tourism in Japan still red hot, and that's despite a slight decrease in international arrivals this year, because that is related only to one market, and that's the continued issues with China. Every other country that is being gauged by JNTO shows increases from elsewhere, including the Middle East, where arrivals are up 15%. So in many cases, we're seeing this translate to record revenues for many of the companies that are related to tourism in Japan, but that's not necessarily translating to record profits. And I think this is nowhere truer than with the airlines that are dealing with jet fuel costs. Some of the rail companies are doing quite well, but I'll say the one that stands out from the rest, Oriental Land. This is the company that operates Tokyo Disney, celebrating its 25th anniversary this year. Shares for this company up 13% on the month. It's back to you.
Mon, thank you. Stay with us. Europe Early Edition is up next.
Never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change in the immediate future. I think our historic destiny is to be back in the European Union.
The world is taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
Streaming on CNBC Plus.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Welcome to Europe Early Edition with me, Ritika Gupta. Let's get into your headlines. Economic D-Day, U.S. Treasury Secretary Scott Bessent vows to impose tough sanctions on Iran and target any enabling countries ahead of a closely watched press conference later today. Investors continue to gauge the impact of the Treasury's bond buyback after longer-dated yields close off the week higher once again, as attention turns to this week's Jackson Hole Symposium and Kevin Warsh's bid to temper market jitters. And European powers rally behind Ukraine with a series of financial and military support measures as the war-torn country marks its Independence Day. Andy Burnham will travel to Kyiv today, his first international trip as UK Prime Minister. Good morning and welcome to the show. Let's get into our top story. The U.S. is set to unveil fresh sanctions on Iran today in what Washington has framed as Economic D-Day. The Secretary of Iran's Supreme National Security Council threatening to halt oil exports from the Gulf in response. In a Financial Times op-ed, U.S. Treasury Secretary Scott Bessent cautioned countries against appeasing Tehran, warning, quote, any nation that serves as a financial artery of a withering regime should expect to share in its isolation. So Dan Murphy joins us now for more. Dan, Scott Bessent, he has described what's going to be Economic D-Day in his words. I mean, the thing with these sanctions, though, the big question is around how they're going to be different to the sanctions that are already in place, because they already have sanctions on oil, shipping, to the financial industry. And again, also, Dan, the overarching question really is whether economic pressure alone is going to work.
They're the two primary questions we're asking this morning, Ritika. As we count down to the Treasury Secretary's address later today, Washington said to be preparing its toughest ever sanctions campaign against Iran, what the Treasury Secretary Scott Bessent is calling Economic D-Day. And in this op-ed for the Financial Times, which we've been talking about this morning, Bessent writes, and I quote here, "At dawn, Economic D-Day begins, the single greatest financial offensive ever marshaled against an adversary." Bessent saying the US is now entering the end game and that the objective is to, quote, sever every economic lifeline that sustains the tyrannical regime until Tehran stands alone. Now, this campaign is not necessarily aimed at Iran alone. It's also directed at the countries, the banks, and the companies that keep Iran connected to the global economy. In this FT piece, Bessent also wrote, Iran's enablers purchase and transport its petroleum. They facilitate the flow of its finances through exchange houses and free trade zones. They welcome Iran's flights and maintain registries on its behalf. They turn a blind eye to seaborne fuel transfers and the illicit use of their banks, all while concealing the extent of their complicity. Now, that language provides some clues about what Treasury could potentially announce later today. We could see new sanctions against foreign buyers and transporters of Iranian oil, along with banks and exchange houses, free trade zone operators, shipping registries, for example, also companies accused of facilitating ship-to-ship fuel transfers as well. And Treasury could also make much wider use of secondary sanctions too, basically threatening foreign institutions with the loss of access to the US financial system if they continue doing business with Iran. That would basically force governments and banks to make a really blunt choice, which would be either you trade with Iran or retain access to the US markets and global dollar finance. You won't be able to have both. So we're watching and waiting to see exactly what's going to be announced, but Bessent has really made clear that Washington may not distinguish between countries deliberately helping Tehran and those claiming not to know what is happening inside their jurisdictions. In fact, he writes, any remaining tie to Tehran will hasten the economic ostracism of countries and entities, whether that tie be purposeful purposefully constructed or willfully ignored. That is from the FT piece. Now, that warning also aimed squarely at Iran's remaining trading partners. On top of the list here is China, and of course other countries that provide Tehran with commercial or financial links. Now, interestingly, we've also had quite a strong response from Iran here in anticipation of this. Iran answering that threat from Bessent and the US with a threat of its own to the world's oil supply. The Secretary of Iran's Supreme National Security Council, Mohsen Rezai, says, and I quote again here, "If the economic war continues, not a single drop of oil will be exported, neither through the Strait of Hormuz nor from anywhere in the Persian Gulf. Iran will regard any country's participation in or support for America's economic war against the Iranian people as an act of war." Now, that language is deliberately broad. It could mean Iran perhaps halting its own exports, but it could also be read as a threat to disrupt oil shipments from across the region. Perhaps that means more kinetic strikes. Perhaps that also means the ongoing dual blockade that is being claimed on both sides inside the Strait of Hormuz. But what we're seeing here is Washington really threatening to punish countries that continue trading with Iran. Iran also threatening countries that help Washington to isolate it. As I mentioned, all eyes are going to be on what the Treasury Secretary has to say later on this afternoon and just exactly how far these measures will go. It's back over to you.
All right, thank you, Dan. And oil prices down about 1.5% as investors await details of those further sanctions. Thank you, Dan Murphy. Now, Canada has vowed to retaliate against the US dollar for dollar after Washington imposed a 50% tariff on $20 billion worth of Canadian imports on Saturday, with the new duties hitting a range of products including wine, dairy, cement, clothing and hockey sticks. The tit-for-tat response came after days of intense negotiations between the two countries broke down on Friday, with the Canadian Prime Minister Mark Carney recalling his negotiators back to Ottawa, describing the US demands as unacceptable. Speaking on Saturday, Carney said the retaliation was taken in the best interest of Canada.
We cannot accept what they've offered, and we will not give what they've asked. Let me be clear. We take this step reluctantly. Reluctantly because we recognize that some of these measures will raise costs and reduce choice for Canadians. Reluctantly because we recognize that some U.S. companies and some U.S. states are innocent bystanders in a dispute that they did not want. Reluctantly because this trade dispute is preventing Canada and America from doing so much good that we could do together. But at the same time, we take this step confident that it is in the best interest of Canada.
Our US colleagues will discuss with United States Trade Representative Jameson Greer just past 1 p.m. London time. And coming up on the show, all eyes on Kevin Warsh's Jackson Hole speech as Trump suggests military action amid rising bond yields.
My ambition is just to be the best that we can possibly be. If you're watching CNBC, it's because you want to get an edge. You want to get ahead. It's our job to deliver that. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
Welcome back, everyone. Let's get a quick check of your markets over here in Europe. We're seeing Stocks 50 futures pointing to a negative start to the trading day, but pretty much flat, no major drama there. You can see FTSE inching ever so slightly into the green. Let's take a look at how Asian markets are trading, though, where you're seeing red across your screen, some steeper losses there. The Nikkei 225 index is seeing down some 0.4%, but the bigger losses really in the Hang Seng index, off some 2%. We are seeing that AI trade coming under pressure ahead of earnings this week. Alibaba shares in focus. They're seeing their worst day in actually 16 months. This is after announcing a $10.2 billion share sale, and the Kospi also off about 2.7%. Samsung shares weighing on that index. Let's see how the US or Wall Street gets set to open. When we look at futures, they're also trending to the downside. This is following what was a losing week over in Wall Street as markets remain pressured by those higher Treasury yields. And in terms of what to watch, I mean, it might be August, but it's still a busy news week. Later today, Ukrainian President Volodymyr Zelensky will address the nation to mark the country's Independence Day. Tomorrow, we'll get the latest IFO data out of Germany. On Wednesday, it's the biggest corporate story of the week. NVIDIA posting its earnings amid a flurry of concern over the sustainability of data center financing. On Thursday, we'll get a rate decision from the Bank of Korea, as well as results from Pernod Ricard, and all of this before the macro highlight of the week, Fed President Kevin Warsh's debut and keynote address at the Jackson Hole Symposium in Wyoming. Don't miss our comprehensive coverage of that conference starting Wednesday. Kevin Warsh's speech at Jackson Hole will be closely watched for clues on the Fed's interest rate path going forward. And it comes at a key time as Trump suggests military intervention on the bond market and Scott Bessent buys more and more long-dated U.S. Treasuries. America's national debt is only growing from the $40 trillion milestone it hit last week. To add to the country's fiscal difficulties, it has now launched what Canadian President Mark Carney calls a war against its northern neighbour with the imposition of 50% tariffs, while President Trump threatens what he calls economic D-Day against Iran as the war America and Israel started against Iran is about to enter its 7th month, continuing to drive oil prices and inflation higher. With eyes on Jackson Hole and investors digesting last week's turbulent bond market moves and its spillover into equities, I'm delighted to introduce a panel to break down what it means. Shreya Samarth, the EMEA head of rates at StoneX Group, and Rebecca McLean, investment director at Aberdeen, both join me now. Both of you, thank you so much for joining us. I mean, it's definitely been a busy couple of weeks and a lot to look ahead to. Shreya, I want to start off with you. Of course, the big story has been the bond market sell-off despite the government intervention. We've seen that 30-year Treasury yield pushing back above 5.3%. What is the bond market telling us, first of all, and in terms of the concerns, whether it's inflation or the debt picture?
Yeah, I guess let's start by talking about that twist. Scott Bessent doubled the U.S. Treasury buyback to $4 billion in a throwback to 2011's Operation Twist, where the Fed lowered long-end rates by selling Treasury bills. It was a twist flattener by intention, not so much net cash, by deploying liquidity where and when it was most needed on the curve. Off-the-run illiquid securities in a slow summer lull. But this was not yield curve control. It's not QE. It's just a love letter to the long end. That's all it is. So yields are very much trading off of their original sentiment, which is a concern over confidence in leadership and credibility.
So Shreya, does that suggest, though, that what we've seen with the reversal of from after his announcement, that this isn't really going to work in terms of solving, I guess, the underlying issue when it comes to the bond markets and the signals of what it's telling us? I mean, how much of difference can these measures that Scott Bessent could be taking, how much of a difference can they really make to a Treasury market this size?
In and of itself, this is just a drop in the bucket. Ultimately, this number is only a small amount of what an average U.S. Treasury auction would be. So the credibility issue is really at play here. And I will say that the elevated yield environment has a lot of other risk factors. Part of them is the communication. So Scott Bessent spoke about this so quickly after that quarterly refunding announcement, which really made the markets doubt the overall strategy. Also, there's elevated yields just off of a shifting investor profile. So for example, you've got lot more foreign investors in U.S. Treasuries. Look at Japan. And you've also got leveraged buyers, which really does change the landscape a little bit. And finally, of course, fiscal concerns. Overall, globally, we are seeing debt burdens rise. And that is adding to a higher yield environment when you're seeing the U.S. at 40 trillion. The combination of all of these risks is really stressing the bond market out, and that is why you're seeing higher yields persisting.
Rebecca, I want to bring you in here. At what point does this bond market sell off? At what point does it become an equity problem? Because we have seen stocks overall remaining pretty resilient in the face of higher yields that we've seen over the course of the year. So do you think the equity market is being complacent here, and how is this impacting your view of valuations in the equity market?
Yeah, I think what's the most important for equity investors is to understand what's driving those yields up. And as discussed, this isn't an inflation shock. Inflation expectations remain anchored. It is more a supply story. It's concerned about fiscal deficits. It's concerned about the level of government borrowing, but also that increase in corporate borrowing in order to fund the AI capex cycle. And so given those concerns, it does then feed through in terms of how you interpret what those yields mean for companies. And really where we're looking across the market, those companies with high leverage are going to be most at risk, and they'll face the greatest costs themselves having to deal with a higher rate environment. Also cyclical businesses in sectors like house building, real estate companies. I think what was particularly interesting last week was to see that the banks underperformed. And this is after a number of years where the banking sector has really benefited from higher interest rates. You're starting to see some concerns come in about at what point higher yields could impact the loan growth picture, but also the returns of those businesses in terms of those funding costs as well. So we expect to see divergence at a sector level when we consider the higher interest rate environment.
And Rebecca, you mentioned there about the particular sectors that are more vulnerable to the higher interest rates. I mean, how is that impacting your view of the tech sector in particular? And we're going to have NVIDIA earnings, of course, out this week. And there is this bigger question about the investments into AI and how that gets financed. And if there's a higher for longer scenario when it comes to rates, I mean, how does that impact, I guess, the economics of the AI build out?
I think one story which is catching our eye is that we're starting to see a quiet fight back on those AI losers, those software and information services that have had a very tough start to 2026 as capital has rotated within the technology sector away from software and the application layer and towards those semiconductor businesses, those which are fueling the AI capex cycle. And we started to see a selective rebound in those software businesses, which I think is interesting. The debate has moved on from all-out AI disruption to one that is more nuanced about the extent to which these businesses have competitive moats and have financial resilience and whether they can monetize AI. And similarly, when you get those concerns raised around the profitability and the returns on the AI capex, then you're starting to see a shift in terms of investors' capital flows into those companies that have lagged behind. So I think that's an interesting story that we've seen over the last 6 weeks.
And Shreya, bringing you in here, I mean, from the bond market perspective, the scale of the AI capex itself, does that create kind of another source of demand for corporate debt and potentially put any further pressure on borrowing costs?
Of course it does. Just in terms of competition, the more competitive corporate debt you have issued, the more U.S. Treasuries, for instance, have to compete with that with higher yields. But I also think it adds an extra element in the employment story. As AI starts to automate jobs, it does beg the question, what does a successful economy look like? Does that mean we're going to see jobless growth again? And in that case, are we naturally going to have higher yields anyway? Because jobless growth means that that's the nature of the way things are going. It means that there's fewer dollars earned, fewer dollars spent, and therefore every dollar spent is heavily scrutinized, naturally creating a higher rate environment.
And I want to move on to looking at the oil prices. Of course, we're going to have the Treasury Secretary Scott Bessent announcing the biggest economic D-Day, he says, on Iran. Talk to me about, Rebecca, first of all, the oil price impact on equities. I mean, if we see oil move materially above $100 a barrel, I mean, it's trading about just under 94 right now if we look at Brent. I mean, is that enough to derail the equity rally? And in terms of, I guess, the regions that are more vulnerable, I mean, I think about like the FTSE 100. I mean, that's benefited somewhat from a little bit of the commodity exposure as well. Talk to me about how that will impact your views.
Yeah, so oil had rallied last week, and that did support the energy sector, which was the best performing sector in the UK last week. It's certainly oil, Brent being above 90 does create opportunities for the energy sector, which are really seeing that their margins improving and their profitability, both upstream and downstream improving. If we think about where we go from here, I think there's certainly risks remain elevated, and we can expect to see volatility in that oil price. I think the important factor for equity markets is the extent to which that flows through to inflation and those secondary impacts in terms of increasing input costs for businesses and consumers, in terms of their cost of goods as well, which is clearly a concern for governments around the world, where the cost of living is impacting consumers' ability to spend and grow. And certainly, as we saw in terms of the intervention last week from the Treasury on the long end of the US yield curve, I think that shows that for politicians, high borrowing costs and high inflation is a concern, and it's triggering a response.
Shreya, in terms of the inflation outlook, how are these higher oil prices impacting, your view for the rate path, and in terms of the stagflationary scenario as well, with those higher energy prices pushing inflation at a time where maybe growth is slowing? Do you see that as a material risk?
I think this is a really good time to analyze the correlation between oil and government bond yields. If the 2-year, the front-end sector, is leading and guiding that relationship, then that naturally becomes a curve flattener trade, because central banks have to hike rates to combat sudden inflation, even if it is supply-driven. But if the belly of the curve, the 10-year yield, starts to be in the driver's seat, then that's a different equation altogether. That's what we're seeing right now, where the correlation between oil and U.S. Treasury yields has moved. Now, that tells me that inflation and risk premiums are now baked into the yield curve, and that adds an extra hurdle to jump over when you're thinking about growth and when you're thinking about returns. A very different conversation, and it's very important to think about the belly of the curve as well as the most liquid. We see that a lot in U.S. Treasuries, where it is heavily churned, but we see it even more in the gilt market, for instance, because the belly of the curve is actually the intersection of liquidity and speculation. So that's where I'm personally going to be watching, thinking about Jackson Hole, looking for any underperformance versus U.S. Treasuries.
Shreya, let me pick up on that point, because of course Kevin Warsh is going to be facing a test when he speaks at the Jackson Hole Symposium. And what are markets going to be watching out ahead for in his speech?
Jackson Hole is going to be an excellent opportunity to reassure the bond markets, if anything, but he's going to need clear and realistic communication here. There's been a lot of missed goalposts lately, just starting with Scott Bessent. Initially, he wanted the 10-year U.S. Treasury yield to be below 4% in order to keep government borrowing costs affordable. And Kevin Warsh, of course, has been talking very tough on that 2% inflation target, which has been missed for over 5 years. This is a good opportunity to recalibrate expectations, especially after that loss of credibility in July's FOMC. And this is an opportunity to move us not so much away from forward guidance blindly for the first time in 18 years, I might add, but also guide us toward that credibility again.
And Rebecca, bringing you in here, how much of the equity rally that we're seeing, particularly, in the States, is relying upon the idea that the central bank, the Fed, is going to eventually cut interest rates?
That is one of the factors, but one of the most dominant factors driving equity markets in the US is the AI trade. It is the growth that we're seeing in terms of the AI capex and the hyperscalers, the extent to which they are investing in data centers, and that filters through down the whole value chain. So you mentioned earlier Nvidia's results on Wednesday after close. That is an important bellwether for the whole AI capex cycle. cycle. Whether the results themselves are one thing, but I think what's more important is what the guidance is from the business in terms of the sustainability of that growth, but also the profitability of the business. Because given the concentration in markets in that AI trade, any hint of a deceleration in AI capex spend would have ripple effects across US markets, but also across Asian markets.
And Rebecca, how does that impact your view then in terms of European equities? Of course, they don't have as much of the exposure there in the UK and in the European markets as the US does. Do you see investors looking to Europe maybe as that kind of anti-AI trade, or is it going to really struggle to compete?
The UK and the European markets provide diversification from that AI trade, given the low weighting towards technology within those indexes. What has been surprising this year in the last couple of weeks has been the strength of the underlying earnings across UK and European companies, with nearly 3/4 of UK companies beating expectations, and similarly strong results from European businesses as well. So if you consider that underlying micro support from an earnings perspective alongside the headline valuation of these indices, then it does provide a constructive outlook for equity returns.
Then the other story that we've been watching closely is this kind of ramping up of tensions between Canada and this trade war. Rebecca, I want to start with you here. I mean, how should equity investors be thinking about this becoming a broader North American trade war, particularly for sectors like autos, industrials, and companies with those US-Canada supply chains?
I mean, certainly tariffs are not new phenomenon, and equity markets investors have been considering the implications of tariffs now for some time. So, what we've been doing is doing bottom-up analysis to understand how businesses are positioned, where their supply chains are held, their strength of their supply chains, the diversification within those supply chains. And we have seen companies respond by moving their production in their supply chain to be closer to home in order to navigate and manage those tariff risks. So the companies are responding, they're making themselves more resilient, they're shoring up the strength of their supply chains, and that should provide some cushion for future tariffs if they emerge.
Shreya, I want to get your thoughts on this story as well. I mean, in terms of what the retaliation that Canada has promised for the US announcing 50% tariffs on about $20 billion worth of Canadian goods. Does this materially impact your outlook for US inflation and the Fed?
I think the first risk initially is going to be dollar weakness, because Canada is a critical trading partner. And it's very difficult to knock a global reserve currency like the dollar off of its pedestal, but it can happen. It can lead to a crisis of confidence. We saw that in 1971 with the loss of the gold standard, in the 2000s with the twin deficits, and even Liberation Day with that Sell America trade. Now, recently that dollar spot index has been trading a little bit lower, and that's because when central banks hike to combat inflation, that's usually supportive and causes the currency to rally. But when you have twists like this, especially given that the Treasury Department intervened, that was a very different spanner to throw into the works, because that indicated some sort of a distress signal to begin with, and then you're already seeing dollar weakness off of that because you're seeing currency risk premiums priced in. I think that's the major risk off of these talks.
All right, we'll have to leave it there, but we've got a busy week ahead, and really great to break it down with both of you. Thank you so much, Shreya Samarth, Mia, head of rates at StoneX Group, and Rebecca McLean, the investment director at Aberdeen. Thank you. Now, coming up on the show, President Zelensky rejects calls for an election, saying a wartime vote would split Ukraine apart. We'll bring you more right after the break.
One hour of added insight every morning doesn't just add up, it compounds. One extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates. Strong numbers this morning. Listen wherever in the world you are. Download the CNBC app now.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Lunch, streaming on CNBC+.
You're watching Europe Early Edition. I'm Ritika Gupta. Let's get into your headlines. Economic D-Day, U.S. Treasury Secretary Scott Bessent vows to impose tough sanctions on Iran and target any enabling countries ahead of a closely watched press conference later today. Investors continue to gauge the impact of the Treasury's bond buyback after long-dated yields close off the week higher once again, as attention turns to this week's Jackson Hole Symposium and Kevin Warsh's bid to temper market jitters. And European powers rally behind Ukraine with a series of financial and military support measures as the war-torn country marks its Independence Day. Andy Burnham will travel to Kyiv today, his first international trip as UK Prime Minister. Let's get a check of your markets over here in Europe. We're seeing futures starting the week on a down note, but pretty much flat. No major drama here, even as oil prices fall ahead of the announcement from Treasury Scott Bessent on that so-called economic D-Day on Iran. Let's take a look at how Asian markets are trading. We're seeing a bit more pain here across the board. You can see red on your screen there. Leading the losses, though, the Hang Seng Index and the Kospi. The Nikkei 225 index off some 0.6%. The Bank of Japan is considering speeding up the pace of its rate hikes, according to Nikkei. Lisa Kim filed this report.
The BOJ is considering hiking rates more aggressively from the current pace of once every 6 months. That's according to a Nikkei report citing people familiar with the matter. The BOJ's main concern is falling behind the curve, though some analysts say that it's already happening. The BOJ last hiked rates in June, kept things unchanged in July, and the BOJ next meets next month, and markets are expecting a hike at that meeting or in October. The yen has undone half of its gains from the recent historic joint intervention by the U.S. and Japan to strengthen the yen. Treasury Secretary Scott Bessent told CNBC earlier this month that he was, quote, highly confident Japan's policy would follow up with an intervention. Japan's core consumer inflation prints over the past couple of months have also boosted the case for a rate hike. Events to watch this month with regard to Japan FX and rates is on Thursday, BOJ Deputy Governor Himino is expected to speak at an event near Tokyo, so investors will be keeping tabs on that event to look for clues about BOJ's future rate hike trajectory. Also, Governor Ueda will likely attend the Jackson Hole Symposium this week, which is another key event to watch. For CNBC Business News, I'm Lisa Kim.
Another stock in Asia that we're watching is Alibaba, because those shares are seeing their worst day in 16 months after the firm launched a $10.2 billion share placement to fund its AI development. The Chinese tech giant will issue 710 million new shares to non-US investors at a more than 8% discount to its Friday close. All proceeds will be invested in its full-stack AI capabilities. And Shein has launched its long-awaited IPO with its highest possible valuation, still around 70% below its private market peak. The firm is aiming to raise around $1.8 billion in the Hong Kong listing, with a valuation close to $27 billion at the top of the range. That's versus nearly $100 billion 4 years ago, before the fast fashion giant started to struggle with slowing growth and changing consumer conditions. The stock will debut on September 1st next Tuesday. And we're also seeing the Kospi also leading the losses along with the Hang Seng. Let's see how Wall Street gets set to open. We're seeing futures there also indicating a negative start to the trading day. This following what was also a losing week over in the U.S. as markets remained pressured by those elevated Treasury yields. This week is also going to be pivotal for the markets. Nvidia earnings out, as well as Kevin Warsh's speech at Jackson Hole. That'll be closely watched for clues on the Fed's interest rate path going forward. And it comes at a key time as Trump suggests military intervention on the bond market and Scott Bessent buys more and more long-dated U.S. Treasuries. America's national debt is only growing from the $40 trillion milestone it hit last week. And to add to the country's fiscal difficulties, it has now launched what Canadian President Mark Carney calls a war against its northern neighbor with the imposition of 50% tariffs. While President Trump threatens what he calls economic D-Day against Iran as the war America and Israel started against Iran is about to enter its 7th month, continuing to drive oil prices and inflation higher. Steve Leisman filed this report ahead of Jackson Hole.
Markets seem likely to get some of what they're after from new Fed Chairman Kevin Warsh in his speech in Jackson Hole. That is, more on rates and his views on the economy. Meanwhile, the new chairman faces new challenges from higher bond market rates. Expectations for the new Fed chairman's first keynote at the conference include more detail on his economic views and the outlook for rates, updates on his 5 task forces, and clearer statements on how he will react to higher inflation, that is, dispelling any notion that he's unwilling to hike interest rates. It would make sense of Warsh to make a distinction between how much detail he gives about his outlook after a press conference, that is, when he speaks for the committee, and how much he gives when he's speaking for himself. Many in the market are hoping for more.
I just think we need to know the reaction function. I just think we need to know, what are you looking at? What is important to you today? Is it more inflation? Is it more employment? Are you looking at, by the way, there's a series of indicators in employment. Are you looking at demand, supply? Are you looking at a whole series of different indicators? To get some clarity on that, then markets can do their job in interpreting it and putting a price on that.
John Hartley, policy fellow at Hoover and economics professor at UT Austin, telling me, my guess is that Jackson Hole will tilt toward being a hawkish event as the FOMC is moving towards trying to tee up rate hikes in late 26 and 2027. The conference this year focuses on financial innovation and its effects on banking, monetary policy, and the global financial system. But the unofficial agenda will likely include the Treasury's attempts to tamp down high bond yields and how that might or might not end up involving the Fed. Our full coverage, including key news-making interviews, starts Wednesday with a special edition of the CNBC Fed Survey, all of it live from Jackson Hole. Steve Leisman, CNBC Business News.
AI startup Hugging Face is reportedly exploring a sale that could value the firm at $13 billion or higher. That's according to Business Insider, which said the firm that was at the center of a security incident involving an OpenAI model last month has been working with banks to gauge interest from bidders. NVIDIA customers have been told that the price of servers which contain AI chips are set to increase by more than 15%, in most part due to rising memory costs. That's according to Bloomberg, which said the raise will affect NVIDIA's flagship Vera, Rubin, and Grace Blackwell chips, with the increase dependent on the generation of chip alongside the amount of memory it has. The increasing cost of memory chips has raised fears over chipflation, as manufacturers look to increase the ever-increasing rise in components to consumers. It comes as memory makers look to supply the need from AI data centers for high bandwidth or HBM memory chips, reducing supplies for conventional DRAM chips. I'm pleased to say William Rojas, the tech research director at Global Data, joins us now. William, first of all, let's start with the headline in terms of this DRAM shortage right now. Is this a temporary kind of supply demand imbalance, or is this some kind of a structural shortage that could last for years? And what is driving this squeeze?
Our view is that it's actually a structural change that's taking place. And of course, at the heart of it is AI compute. When you think about the next 2 to 5 years, it's hard to see that the demand that we're looking at right now, which is 10x to 15x minimum per year increase in AI compute demand. And that's for enterprises, not just the large language model companies. When you put it all together, it looks more like not a supply-demand cycle, but it looks like a structural shift where the memory is going, basically the memory components, but its other components as well, is going to the high-value opportunities.
So, William, JP Morgan, I was reading, estimates that DRAM prices could rise more than 400%. That's between 2024, the start of 2024, and the end of this year. I mean, is that kind of a price increase sustainable? At what point does demand destruction potentially kick in here?
Right. So there's two different sectors that are going to be impacted by sharp rises in memory prices. The first is consumer electronics. If you look at, as an example in China, they're already seeing $40 to $75 hits, increases on their smartphone devices, which is quite a lot if you think about the average selling price of China. So the consumer electronics, and that would include laptops, are also going to suffer. On the other side is the AI capex demand. Today, our estimate is that in 2026, it'll be $805 billion for the 5 hyperscalers in the U.S. The problem is that memory accounts for probably 25 to 30%, or slightly above that, of the total AI capex, of the total AI capex. If memory prices were to increase significantly, what it would do is it would push the, let's say that in 2027, the hyperscalers were planning in aggregate to spend $1 trillion. This would push it way above $1 trillion and probably push it to $1.5 trillion just because of memory increases. And remember, this is the high bandwidth memory, so it's the high-end, high premium memory.
So you mentioned, of course, what's driving this, of course, is the AI demand here. I mean, how much of the traditional DRAM demand is being overcrowded now by AI, and where is that squeeze felt the most? Is it the AI accelerators? Is it those data centers, the hyperscaler data centers, or or is it this kind of shift of manufacturers toward those high-value HBM chips?
Right. So I guess what's happening, the way to think of it is traditional consumer electronics and traditional enterprise workloads. They were growing at linear demand, not doubling or tripling every year. AI, on the other hand, is looking at essentially an exponential increase, and that's what's sucking away all of the capacity. And the memory manufacturers have no choice here. They have to. They have to go where the opportunity lies. And right now, high bandwidth memory has a huge premium, 300, 400% over traditional memory. So it's hard for traditional memory to entice the manufacturers. And our view is it's going to take several years before the traditional DRAM customers would get a good priority. I think it's 18 months away at least.
And we're seeing the kind of the ripple effects from this shortage. I mean, they're moving beyond the data centers. Apple and other electronic manufacturers, I mean, they're facing those higher memory costs. So how much of this do manufacturers, do you think they're able to absorb, and how much gets passed on to the consumer? And is there a risk here that we reach a point where this is going to be driving inflation in consumer electronics over the next few years?
Well, I would have to leave that to the expert economists, but from my vantage point as an industry analyst, it appears that we're getting to the point pretty soon, probably by mid-2027, where the consumer companies just cannot absorb additional memory costs. I believe they're going to hit the wall because consumer electronics are already pretty, generally speaking, pretty low margins. So increasing it beyond a certain point will probably cause degradation in the market.
And And how are you looking at China in this space? Because CXMT, that's becoming a much more important player in DRAM. I mean, could Chinese producers ultimately, could they be the one providing this additional supply needed to take the pressure off the market?
Yeah, that's a great question. We can think of two manufacturers, right? You have CXMT, which is the DRAM, and then YMTC, which is the NAND flash. And in terms of market share, I think reports from other industry watchers suggested that YMTC has moved up to possibly third place. My view of it is this, is that the demand, and we've been looking at this demand in China, is so intense right now. You see Alibaba, Baidu, all these companies, ByteDance, they're doubling, tripling, quadrupling their AIX CapEx investment. So I think China is going to keep CXMT and YMTC pretty busy for the next year or so. So that even if they wanted to export, they could get better prices. The customers in China are going to have to be their first priority.
And Apple is reportedly also testing CXMT memory for iPhones and MacBooks as well, as this shortage intensifies. How significant would it be for Apple to adopt the Chinese memory from the CXMT and also Samsung, SK Hynix?
Right. I think for a consumer electronics product company like Apple, CXMT probably is not an unreasonable idea. CXMT is not quite at the level yet where they can be used for super high-end data centers. They're not quite ready for that. They're getting close, but they're not quite there yet. So I think from Apple's perspective, being a consumer electronics company, CXMT would not be, it would be a reasonable supply part of the supply chain for them.
How important is NAND flash to this story? Because we talked about HBM, we talked about DRAM when discussing AI, but NAND is also critical for the storage, right?
Right, so everybody forgets that these models, these frontier models, have trillions of parameters. You know, it started off 200 billion 4 years ago. Now they're talking, I think ByteDance in China is looking at 5 trillion parameters. OpenAI's ChatGPT and Anthropic, these are already probably at over 2 trillion parameters or close. The result of that means that when you do, when you type in a question or a prompt, or you send it if you're an AI agent going over the enterprise network, the system has to download parts of that model, not the entire model, but possibly 100, 200 billion gigabytes every single time that you initiate a new session. So that's why the NAND flash is so important, and people are talking about high bandwidth NAND flash in the future. That's where the model is stored, and it needs to be downloaded every time into the GPU servers for each user session. That's why the NAND flash is so critical part of the pipeline.
Thank you so much, Wim. We'll have to leave it there just because we're running short of time, but thank you for breaking that down for us. William Rojas, the Tech Research Director at Global Data. Now, coming up on the show, Volodymyr Zelensky refuses to hold an election amid calls from his former defense minister as the country marks Independence Day today. We'll bring you the latest next.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange, streaming on CNBC+.
Don't miss the highlights of the PGA Tour. Catch the action from the PGA. The biggest hits and misses. Join us on the green. Saturday and Sunday afternoons, only on CNBC.
Welcome back, everyone. And you're looking at live pictures from Kyiv's Independence Square. This is as the country marks its Independence Day today. President Zelensky has rejected calls from former Defense Minister Mikhailo Fedorov to hold wartime elections. Alexei Goncharenko, a lawmaker in Ukraine, I'm pleased to say, joins us now. Thank you so much for joining us, Alexei, especially for joining us on Independence Day. I mean, after, 4.5 years of this full-scale war, are you entering this Independence Day with more optimism or more concern for Ukraine's position than you had a year ago?
Hi, thank you very much for congratulations. And I think I have both. I have a lot of optimism because Ukraine proved to the whole world that our state is not, some accident, that we have a nation, we have a state, and we survived attack from Russian state, from Russia, from a nuclear state, from a great army that they have, and we survived it and we stopped them. So we proved ourselves, and I'm optimistic. I know that Ukraine will be in future and will develop and will be one of the, at least, regional leaders. But also I have a lot of concerns because unfortunately the war continues, and it means that we are dying here every day. And we need peace as soon as possible here in Ukraine. This is the most important for us, and that is what we are all looking for.
So, Alexei, I want to get your thoughts on this call from the former defense minister for wartime elections and how you think that would go down. I mean, President Zelensky, he said that calling these elections now would effectively destroy Ukraine. I mean, how in this environment could you hold even genuinely fair and free elections, given that we have a lot of these Ukrainian soldiers fighting right now? What's your stance?
First, I see a lot of hypocrisy in what President Zelensky says now, that he says that, oh, yes, the elections are completely impossible. I should explain you. I also think that elections are impossible because of security reasons. But the thing is that during these 4 years and a half, there were of full-scale invasion. There were several moments when Zelensky was seriously considering and even starting to prepare elections because he saw for himself possibility to be elected in such circumstances, re-elected, I mean. And now when Mr. Fedorov, which was one of his closest aides to just recently, just a month ago, and now they are in the conflict, his former Minister of Defense, when he called for elections, also he called it not before, because just several months ago, Mr. Fedorov was saying elections are impossible, but now he's saying they are needed. Why? Because he sees some political possibilities for himself. So I think it's a bad thing when politicians just want to make elections, especially in such situation as ours, just for their own political interest. Or don't make elections just for their own political interest. We need elections. Yeah.
Just wanted to get your thoughts on a couple of other things as well, just because we're short on time. I mean, just currently on the state of the war at the moment, on the battlefield front, we see a lot of the attacks on infrastructure.
Just to be short, we will need to have elections for sure, but first we need to achieve peace. And this is the most important. And what you see today, the statement from Mr. Fedorov and Mr. Zelensky, is just a part of political struggle. But elections are impossible on security reasons.
So what is your assessment then of the peace talks going so far? I mean, are you confident that the US...
Unfortunately, there is no progress at all. And that is the biggest problem that we have. Unfortunately, I don't see any light in the end of the tunnel for the moment. And this is the worst thing.
All right. Well, thank you so much, Alexei Goncharenko, the lawmaker of Ukraine. Really pleased to have you join us today. Thank you so much. And before we go, a quick check of the markets over here in Europe. We're seeing Stocks 50 futures moving to the downside. No major drama, though. Over in the US, we're also seeing set for a down day. This is after what was a week of losses. There's concern over those higher Treasury yields. That is it for today's show, though. I'm Richard Gupta, and Squawk Box Europe is up next.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange, and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
Edge just opened up in Europe with a French government cooperation agreement as well. How significant is that deal for Edge and for Abu Dhabi?
Europe is where the next budgets are. We would like to contribute to the security of Europe. We feel that we have a value. We feel that Europe have recognized this value by accepting us into Europe. These are facts. We have a very nice footprint in Europe, and this would have not been possible if the UAE wasn't accepted in Europe as a partner, knowing and trustworthy with NATO and the way we firewall things. Plus, you need another player in Europe. Even the big players today, we're working with them. There is always these collaborations, but they only start when you put your ego aside. There is always someone better than you. And you need to be on this learning curve forever.
Hyrox is on track to deliver around $270 million in revenue in 2026, and the Middle East has quickly become one of its clearest expansion priorities.
Basically, our global expansion strategy always entitled having Hyrox events. Our dream was in the 150 urban metropolitan cities in the world. Abu Dhabi, Dubai, these were all cities that were part of the list. It was always clear that the Middle East are a very, very important part of our business.
But global demand creates a new problem. The race can be replicated city to city, but the experience cannot be overcrowded. The result is a business that benefits from both scarcity and repeatability.
The tickets are very hard to get. That's what keeps people coming back and keeps people looking into opportunities to maybe even fly to another city or travel to another city to participate in. And this is highly relevant and important for us as well.
Very warm welcome to this Monday edition of Scorebox Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. US futures dipping as Nvidia results and Kevin Warsh's debut speech as Fed Chair at Jackson Hole loom large over the week ahead, with both events set to dictate how markets trade for the rest of the year.
Economic D-Day. U.S. Treasury Secretary Scott Bessent vows to impose tough sanctions on Iran and target any enabling countries ahead of a closely watched press conference later today. European powers rally behind Ukraine with a series of financial and military support measures as the war-torn country marks its Independence Day. Andy Burnham will travel to Kyiv today, his first international trip as UK Prime Minister.
Right, it may be August, but two events this week could shape how markets perform for the rest of the year, potentially anyway, and into 2027. On Wednesday, it's the biggest corporate story of the week. Nvidia will post its earnings amid a flurry of concern over the sustainability of data center financing. The chipmaker is increasingly stepping in to act as a backstop within the market, most recently partnering with 6 large asset managers on a $500 billion deal, which is designed to establish financing platforms for Nvidia's customers. Meanwhile, sources have told CNBC the company is playing matchmaker in the Nordics, seeking to connect companies with its GPUs to data center operators with available capacity. Kevin Warsh's speech at Jackson Hole will be closely watched for clues on the Federal Reserve's interest rate path going forward. And it comes at a key time, after the US Treasury intervened to buy more long-dated bonds amid pressure in the market, whilst America's national debt is only growing from the $40 trillion milestone it hit last week. To add to the country's fiscal difficulties, it has now launched what the Canadian Prime Minister Mark Carney calls a war against its northern neighbour, with the imposition of 50% tariffs. Meanwhile, President Trump threatens what he calls economic D-Day against Iran, as the war America and Israel started against Iran is set to enter its 7th month, continuing to drive oil prices and inflation higher. Don't miss our comprehensive coverage of that conference starting Wednesday. Well, Koku Agbo-Blua is the Global Head of Research at Societe Generale, CIB, and joins us now. And you've had plenty of time on your holidays, lovely to see you, my friend, plenty of time on your holidays to pontificate over whether the AI story, the global debt story, the interest rate story, the inflation story are going to create ructions and longer-term problems for these markets. What did you find? A, you probably didn't think about any of this because you're way too controlled for that. B, when you came back to work and you did start thinking about it, what did you think?
Well, I think it's fascinating because I remember the summer of last year where we had a sort of bond market sell-off, and then it was all a question about whether this was policy mistakes. What I find interesting is that the announcement by the Treasury to buy at a floor of $4 billion per operation, it's actually not new news. It's a program that existed since 2024, and they bought something like 228 billion, which is roughly 10 to 14 billion a month, and it is essentially more of a treasury liquidity twist than it is yield curve control or QE, etc. So QE, in comparison, was something around $120 billion a month for 80 billion treasuries, 40 billion mortgage-backed securities. So it is essentially buying back illiquid, off-the-run 30-year treasuries. 10 to 30-year sector is what they're buying to issue with more benchmark liquidities, well, securities. So it's actually a liquidity enhancement mechanism. But the timing is quite interesting because this is where the $40 trillion has been talked about. But long story short, the fundamentals haven't changed. The US is growing. You have higher inflation uncertainty, etc., etc. So I think it is a situation where central bank, or the Fed, has been buying a lot of treasuries and now is no longer in the market. So the yield curve is simply repricing the reality of the treasury market in the US.
So much in there, Koku. Clearly, Kevin Warsh, from his speeches when he wasn't a central banker, thinks the Federal Reserve, at least, should have a smaller balance sheet.
Correct.
Is the market going to imminently test him on that?
I think Kevin Warsh, we were worried about the Fed independence at the time, and what is quite healthy is to see that he's very serious about bringing inflation back to target. To such an extent that the market was expecting a hike, which he didn't deliver on, simply because the data in terms of CPI, core PCE, etc., is trending lower. So there's no sort of broad evidence of a wage price power.
Because we're 24 cents away from record diesel prices in the United States.
Yes, on the headline. But if you look at core PCE is around 3.4%, core CPI is around sort of 2.5%. So we are not seeing the sort of wage price spiral of goods inflation, energy inflation feeding into service price inflation. But what's important is that the argument about forward guidance, etc., is being priced by market through a higher term premium. But the key challenge is in an environment where we talk about dollar diversification, etc., that China, Japan are buying less treasuries, whether this is an environment that can create more of the bond vigilante type situations. But our opinion is that as long as the economy is growing, this is the best way to grow yourself out of too much debt.
But they're not, are they? When you've got a roughly, and I say roughly because it could be 5.8, it could be 6.4% deficit, the US is increasing that debt profile rather than decreasing it as promised in the manifesto or the pre-administration rhetoric as well. I remember on this very channel, Kevin Hassett and others informing us that the big beautiful bill and other tax giveaways were going to galvanize growth, which was then going to cut the deficit and cut the debt. That is not happening. So, well, I can't see it. You're far more intelligent than me. Can you see it?
Well, this is what Treasury Secretary Scott Bessent mentioned by turning potential energy into kinetic energy for the US economy, because the One Big Beautiful Bills Act is really around boosting capex, the sort of accelerated expensing of manufacturing factories, etc. So this is the whole AI capex boom bet, and you can see let's say growth around 2%. And the challenge is, if it is to be a lower number, then the debt sustainability problem will be a key concern. Because if you look at the 5.8%, 3.3 is debt servicing, roughly $1 trillion. 2.5 is a primary budget deficit. So this is the first time we had such a high level of debt servicing over the past 30 years. It used to be between 1 and 2%. So it's even, so long story short is, if the Fed has to hike and bond yields stay higher, I agree with you that the debt profile is going to be a problem. So this is why you need to focus on the R minus G formula in economics, which is that nominal GDP has to be higher than the average level of debt cost or servicing. So if you look at the US, 2% real GDP, 2.5% inflation, we are roughly at 5.5, which is where the 30-year Treasury is. And the weighted average maturity of issuance is around the 5-year bucket. So if growth were to slow, then we'll have a problem. But the good news is that Treasury Secretary Scott Bessent is aware of the problem, and that's where the emphasis on the director of the OBM, the Office of Budget and Management, on further spending cuts will be a key focus for markets. Because if they're able to bring down primary budget deficit, then there's going to be a lot more confidence brought by the back to the market, because you're focusing on the fundamentals and not technicals.
Spending cuts ahead or after the midterms? I'll leave that question hanging there. Ben, come on.
Could all of this be part of some grand strategy to finally weaken the dollar, which we know is what President Trump has long wanted to see? It has remained stubbornly strong, especially after the Iran war broke out. We saw the dollar strengthen once again. All of this, if there's going to be this buyback of debt, if the Fed isn't going to hike rates, presumably the outlet valve then is for the dollar to weaken. Or do you think that may not play out like that?
That's a very good point, because this was the whole de-dollarization theme that sort of got punched in the face to some extent, to quote Mike Tyson, because you essentially had the US being very resilient. It's very difficult to move away, at least sustainably, from the US financial assets. So US equities is roughly $60 trillion, Europe is $14 trillion, and is also one of the most liquid sovereign debt market. So I think this has been Trump's argument, but the market is having a tough time in sort of seeing a weaker dollar play out because there's no real alternatives. That's going to be the euro. You saw gold to some extent in terms of reserve diversification. So I think the trend is clearly for lower dollar, but it will take time.
Okay, and then this week, of course, we've got the Jackson Hole gathering, arguably a more important speech from the Fed Chair, given he has made it clear he will give less communication. He would like all of us to focus more on the economic data and the fundamentals, because of course we weren't doing that before, were we? I just wonder what effect you think this lack of communication and lack of forward guidance, maybe even fewer, according to the last minutes, fewer policy meetings, whether that will have the effect of calming markets, reducing volatility, or will it make those market participants even more jittery and uncertain about what actually the direction of travel is going to be?
Yeah, this is a fascinating discussion and debate. It's really around forward guidance and whether this has brought down volatility over time. What I remember is after his speech, the market actually didn't react that much with a steepening of the curve. It was a bit of a conundrum. But I think it brings a positive thing, angle, which is Fed credibility. So the whole fiscal dominance concern, which is where a central bank is acting in the interest of the government to sort of bring down the cost of financing, is no longer the main focus. But you also have to remember that the Fed balance sheet was $4 trillion before COVID. It peaked at $9 trillion in 2022, and it's now at $6.75 trillion. So it's been down by roughly $2.2 trillion, but the Fed is still a major owner of treasuries. So I think over time it is a question of bringing credibility to the Fed without jeopardizing the financing of the U.S. government. And it's clearly a concern with such a high level of deficits at roughly 6%, which is close to $2 trillion of additional issuance every year, in an environment where unemployment is at the lowest level and the economy is potentially maybe slowing down if this AI capex boom doesn't play out. So I think the juncture between fiscal and monetary is going to be quite challenging for the next few years.
We got the last minutes showed the Fed perhaps more divided than it has been historically. Is that a healthy position, or where people are perhaps feeling more free to break away from the consensus view, or does that create problems for markets trying to interpret it?
I think it's healthy because there's healthy debate and different views, but I think the point around Kevin Warsh's argument that AI could create disinflationary pressures in terms of wage inflation as labor gets displaced is an interesting challenge to monitor as well. So I think debate is healthy. We came from a place of the Fed losing its independence, and this is clearly not something we're likely to see in the short term. So I'm more positively optimistic, let's put it this way.
Yeah, that's great. Tell me also about this crowding out theory that's doing the rounds at the moment. I'm sure some of the clients have started to ask you about that as well, whether the vast amount of debt and new equity issuance is actually creating additional stresses for the bond market.
Yeah, this is a good question. I think it is a theory that is making the rounds. I think on the marginal side, you could argue that it is crowding out, but you need to look at the numbers. So AI capex roughly $1 trillion. I think a portion of that is being funded through debt, but the size of the treasury market is $30 trillion, so 30 times bigger. So I think the fundamentals are driving the flows, and you see JGB selling off. We talked about the Fed no longer being in the market, deficits, inflation, uncertainty. I think these drivers are more important. However, I think the Treasury buyback is misinterpreted as a sort of hidden shadow QE, when in fact it's simply a liquidity adjustment liquidity enhancement mechanism that the Fed is running. But
Scott Bessent know that, because I didn't understand. If it's just about enhancing liquidity at the long end, why did he make this kind of interesting intervention at a moment when yields were under the most pressure, or surging to 5.3%, the highest levels we've seen in decades as well? If it's merely a technical under-the-hood point about liquidity, why was that sent in to, I quote, soothe the market when the yields were so exacerbated?
That's a very good point, and this is clearly the second order, in fact, that he was probably thinking about, I suppose. But I think
first order.
Probably not the first. Well, the first order, if you look at the facts, it's, simply...
the facts are the second order, I would
Exactly.
suggest.
And
The first order is to try and calm the market.
Absolutely. It's a signaling mechanism. But I think he also made a lot of emphasis on Russell Vought, the director of the OBM, in terms of the cost-cutting measures, etc., etc. So I think he's fully cognizant, given his background, he's clearly aware that you can't manipulate or sort of influence the market to what you want it.
More important than DOGE was.
Well, we'll have to see. History will have to see to tell us whether it's successful or not. But again, his key point is this whole argument around potential energy being turned into kinetic energy, which is the whole AI capex. I think we are all pretty much dependent on whether this return on investor capital turns out to be above the cost of capital for a lot of investors.
I'll just sneak it in because Adam said I could. Will it then? What is your view on this vast amount of AI capex, bearing in mind, dare I say it, there appear to be a lot of cheaper versions out there that are very, very good?
Yeah, I think on this one, this is the, if you look at potential revenues, global GDP is $100 trillion. Total labor income share of GDP is roughly 50% of that, so $60 trillion. Labor, so knowledge workers, so the total addressable market for AI is 30% of that 60 trillion. So let's say $18 trillion. If AI has 10%, in terms of labor displacement, etc., that's 1.8 trillion cost and saving, etc., compared to the sort of 800 billion, 1 trillion AI capex. So I think it will eventually be a massive disruption, changed in the way we do create value, etc. And also, it is a Schumpeterian creative destruction process. So the cheaper it is, the bigger the addressable market, because you can have robots, alternative use cases, etc. So net-net, it's part of a healthy revolution, and I'm essentially pretty much optimistic in terms of its value generation potential. That being said, last comment, there are side effects. Cognitive atrophy, you can go into Descartes, Hegel, Kant in terms of responsibility and what it means for human nature. But this is where regulation will have to play an important role.
A bit of cognitive atrophy. Certainly was yesterday afternoon, anyway. Thank you very much indeed. Koku, lovely to see you. Thank you very much indeed for your optimism and your intelligence as well. Koku Agbo-Bloor, who is Global Head of Research at Société Générale CIP.
Coming up on the show, the US prepares to announce fresh sanctions on Iran, pledging economic D-Day. Dan will explain all. Plus, Canada vows to retaliate as the US imposes 50% tariffs following breakdown in negotiations. And we'll have more on the look ahead to Jackson Hole with Pantheon Macroeconomics Ian Shepherdson at 9 o'clock London time.
Interactive Brokers pays up to 3.14% on instantly available U.S. dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.14% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
Listen to CNBC on the move with the CNBC app.
What a strong number this morning.
Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe. Welcome to the China Connection. Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giamatteo, only on CNBC.
Halftime Report, weekdays streaming on CNBC Plus.
Well, it's a big week ahead, isn't it, for markets? So let's kick off this round of the market check by looking at the US futures. And the indication is that we are going to see them open on the back foot at the start of the new trading week. This in a week in which we will have a lot of attention on what Kevin Warsh has to say, the chairman of the Federal Reserve speaking at the annual gathering at Jackson Hole. We've also got Nvidia's latest results due out. Expectations sky high, really, and we'll see what investors make of it. We've tended to see a pattern where even when the results have been good, we've seen quite a bit of profit taking and the share price subsequently falling. So let's see how that all plays out. But as I say, US futures indicating a softer start to equities this Monday. In terms of European futures, a slightly more mixed picture. It's the FTSE that's looking to open above the flat line of the three on this wall. The blue chip stocks 50, the pan-European market looking to open in negative territory, and the DAX futures also being cooled lower. This after a week in which the main European bourses closed the week lower than where they had begun. In terms of the Asian markets, this is the current picture, and a lot of red to be found. It's the Kospi in South Korea that's leading the losses. We saw a fall in chip makers Samsung and SK Hynix. With Samsung, it was all about the proportion of dividend that it's going to distribute to shareholders, and we saw the stock price fall after that update. It makes a big part of the index, so consequently that dragged down the broader benchmark. The others as well, the Hang Seng off by almost 2%, the Nikkei and the Shanghai Composite also trading negatively this Monday morning. Steve.
The US is set to unveil fresh sanctions on Iran today in what Washington has framed as economic D-Day. The Secretary of Iran's Supreme National Security Council threatening to halt oil exports from the Gulf in response. In a Financial Times op-ed, US Treasury Secretary Scott Bessent cautioned countries against appeasing Tehran, warning, quote, any nation that serves as a financial artery of a withering regime should expect to share in its isolation. Dan, I'm going to be brutally honest. I was listening to every story in the FT on the way in this morning. I got a little bit bored by the time I got to the bit about 17th century French philosopher Blaise Pascal in the op-ed this morning as well. I just wanted to know what they're going to do to stop China and other nations actually having an economic relationship with Tehran. And I still have those questions.
Well, Steve, in the media industry, I guess we could call this a deep tease, maybe, but this piece in the Financial Times certainly getting a lot of attention this morning. As you say, in that op-ed for the FT, Bessent writes, at dawn begins an economic D-Day, the single greatest financial offensive ever marshaled against an adversary. So he says the US is entering the ends game now with the objective to sever every economic lifeline that sustains what he called the tyrannical regime until Tehran stands alone. Now, this campaign is also aimed at the countries, the banks, the companies keeping Iran connected to the global economy. We don't have full details yet on what is going to be announced. The Treasury Secretary will be speaking later today, but in this piece, Bessent wrote, and I quote here, Iran's enablers purchase and transport its petroleum. They facilitate the flow of its finances through exchange houses and free trade zones. They welcome Iran's flights and maintain registries on its behalf. They turn a blind eye to seaborne fuel transfers and the illicit use of their banks, all while concealing the extent of their complicity. And I think that offers a preview of what Treasury could announce later today. That could be sanctions on foreign oil buyers, on banks, on shipping companies, and other intermediaries as well. Washington could also expand secondary sanctions here, basically forcing foreign institutions to choose between trading with Iran and accessing the US financial system. Once again, it's that Washington war cry of you're either with us or you're against us. And it's interesting as well because Bessent is warning that any remaining tie to Tehran for any of those countries will hasten what he called the economic ostracism of countries and entities, whether that tie be purposefully constructed or willfully ignored. So he's basically saying, look, if you're a country doing business with Tehran pretending that the United States won't notice, then you need to listen up here. That message, of course, aimed squarely at China and Iran's other remaining trading partners as well. Now, what's also interesting is that Tehran has responded here with a threat to global oil supply, not necessarily the United States directly, but targeting the Gulf countries here. Iran's National Security Chief Mohsen Rezai says if the US economic war continues, not a single drop of oil will be exported, neither through the Strait of Hormuz nor from anywhere in the Persian Gulf. Iran will regard any country's participation in or support for America's economic war against the Iranian people as an act of war. What does that mean for regional energy security? What does it mean for Iran's response? We're watching and waiting to see exactly what the Treasury Secretary announces. As for markets, all eyes are going to be on this announcement, and this question of just how far Washington is prepared to go could ultimately determine which way oil prices go as well. As you can see, we are selling off on the headline this morning, crude pulling back on the suggestion that we could see tougher economic sanctions being leveled towards Iran here. Perhaps the market looking through this, basically saying we have seen this movie before. And of course, on the Iranian side as well, we know that they have sophisticated mechanisms and procedures in place with their partners to basically shield them against this type of Western sanction activity. Whether or not what the US announces actually forces the regime's hand or maybe prompts some kind of change of heart or return to the negotiation table remains to be seen at this point. So we're watching and waiting to see exactly what plays out this afternoon. It's back over to you.
Dan, it was interesting last week, ahead of all this, we saw one of Iran's key trading partners announce that it was going to cease financial, trading, commercial relations. In the context of what has now come, I wonder if that looks like a preemptive move to get on the right side of the US before this formal announcement.
Fair point, yes. The UAE was ahead of the curve here, responding after we saw that phone call taking place between President Trump and President Sheikh Mohammed bin Rashid Al Nahyan here. You know, the interesting MBZ, I should say. The interesting thing here is that the UAE has long been, you know, kind of a financial lifeline for the Iranian people, not the regime, the Iranian people. And of course, there are many Iranians who call the UAE home. Property transactions, bank accounts, financial flows, exchange houses, for example. So, look, the UAE has already decided to curb that Iran trade. Let's see if other countries also follow suit around the region. And also, we're watching and waiting to see exactly what the full extent of the impact of these measures is going to be, not just on the UAE, but across the Gulf and in other Middle Eastern capitals as well. Obviously, these countries still have pretty strong ties to Iran geographically. Iran's not going anywhere. So again, this could also hit reset on the relationship that these countries might have with Iran moving forward as well. Again, very little details here.
Okay, Dan, appreciate you giving us the picture on all of that. Dan Murphy there for us. We are counting down to the European market open, 22 minutes to go, and this is what's been called a mixed picture to start the new trading week. Just the FTSE futures indicating a stronger open, the other benchmarks on there being pulled lower. We're back after a short break.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Line, streaming on CNBC+.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What do the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli. Closing Bell Overtime. CNBC.
For this edition of the CNBC Conversation, I'm joined here in Milan, Italy, by the Prada Group CEO, Andrea Guerra.
There is fashion waves, there is political waves, but then there is reality. The reality says that younger generation are looking at you, not just to what you say, but how do you behave. The way you are behaving in the society, you are behaving with your own people and suppliers and stakeholders, and how you are behaving towards the planet are the three things that are part of our inner mission. So we are here to allow everything inside our group to be connected smoothly and positively towards planet, society, and our own people.
Product Group CEO Andrea Guerra sits down for the CNBC conversation.
Oh, happy Monday, everybody. Welcome to Squawk Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. U.S. futures, not much really, a little bit on the terms of NASDAQ, I guess, as Nvidia results and Kevin Warsh's debut speech as Fed Chair at Jackson Hole loom large over the week, with both events set to dictate how markets trade for the rest of the year, potentially. Economic D-Day, U.S. Treasury Secretary Scott Bessent vows to impose tough sanctions on Iran and target any enabling countries ahead of a closely watched press conference later today. Canadian Prime Minister Mark Carney says the country is at war with America on trade, though, only trade, after President Trump imposes 50% tariffs following an 11th hour breakdown in talks.
Nvidia customers have been told that the price of servers which contain AI chips are set to increase by more than 15%, in most part due to rising memory costs. This is according to Bloomberg, which said the raise will affect Nvidia's flagship Vera, Rubin and Grace Blackwell chips, with the increase dependent on the generation of chips alongside the amount of memory it has. AI startup Hugging Face is reportedly exploring a sale that could value the firm at $13 billion or higher. That's according to Business Insider, which said the firm that was at the center of a security incident involving an OpenAI model last month has been working with banks to gauge interest from bidders. Anthropic's IPO prospectus will list negative sentiment towards AI and data centers as a risk factor, according to sources. The document's expected to land in the coming weeks and comes at a time when an increasing number of Americans are worried about artificial intelligence and are loudly opposing new data centers. Kate Rooney spoke to people familiar with the matter and filed this report.
I am just hearing from sources that the recent backlash against AI and the data center build-out is now expected to be listed as an official risk factor in Anthropic's upcoming IPO, and that paperwork in particular. This is according to two sources familiar with the matter. The AI giant will officially warn investors, from what I'm hearing, that its ambitious data center build-out could be delayed or constrained by some of the growing political opposition to a lot of these projects. This would show up in the upcoming S1, which I am told we could see in the matter of weeks here. Anthropic has filed confidentially to go public in what could be the biggest IPO in history behind SpaceX. Risk factors, of course, are a standard part of these IPO filings. They're meant to spell out some of the potential downsides for investors. It does come as politicians on both sides of the aisle, we're now seeing, are pushing back on some of these projects around the country. One source told me the AI backlash could take on even more significance, especially if Anthropic does open up a large portion of its IPO to retail investors, similar to what SpaceX did. Anthropic, Mike, declined to comment on this one.
According to Challenger, more than 180,000 corporate jobs have been lost, and they can be linked to AI since May of 2023. Let's discuss the implications of job cuts across the tech industry and plenty more aspects with Seth Ravin, who is the CEO and founder of Rimini Street. Hey, Seth, good to see you. Do you want to address the job side of things as well? Everyone tells me that AI is different from previous technologies, which makes me worry whether I should be more Luddite in my appreciation of the technology.
Well, I think, first of all, we have to separate out. There's job losses that may come from the transition of certain tasks to AI. There are job losses that are happening in technology where we are rotating out older skill sets and replacing them with new AI skill sets. So we have really different types of labor impacts happening at the same time.
Yeah, but in terms of the trend though, Seth, if I add AI to robotics and I look at the extraordinary robotic gains that we're seeing on both sides of the Pacific, I won't say both sides of the Atlantic because I think it's less so here in Europe, it is quite extraordinary the things that robots plus AI can do now. The trend looks ominous, sir.
Well, I think we have a shift. We have another industrial revolution happening. We are going to replace a lot of jobs that are currently done by people with electronic people, AI, and we're going to need people to do other types of jobs. The real issue is one of the transition, and it's one of retraining a workforce to be able to do the new jobs of the future.
Yeah, okay, so to the graphic designer I was speaking to at the weekend who said AI does all of her job, or the young legal executive I spoke to last week who said AI can do all of their jobs, or the truck driver that loses their job to autonomy, to the port worker that loses their job to autonomy. What are the other jobs, Seth?
Well, we're going to be designing AI. We are going to be designing creativity. We're going to have a lot of management jobs, and this is part of the challenge, is we have to move people from rote work, where they're doing some great things today that AI can take over, to allow them to do higher level items. But this is where we're watching this big transition shift, and if we don't invest significantly at government levels combined with private industry to retrain workforces, we are going to have a significant number of people who are going to get caught in between.
Sorry, Seth, we're not going to need vast numbers of AI monitoring managers, are we? We're not going to need millions and millions of them. We're going to need a few smart individuals who, by the way, will be using AI themselves in that management function. Come on, Seth, we're not going to re-employ tens of or hundreds of millions of people who are doing creative services jobs, who are doing physical jobs. Those jobs won't exist anymore. How many managers of AI products are we going to need?
Well, I am telling you, I believe that there will be a reabsorption of a large number through a period of time. But we do have a problem with training, and we're going to have to move people into different jobs. They're going to have to fix the robots. They're going to have to build the robots. They're going to have to diagnose issues in the software that runs on those robots. It's not going to be all AI running AI. There are people who will be needed throughout the process. Even look at construction of data centers. We've never had a bigger demand because we're building a lot of physical components at the same time.
No, Seth. I'm sorry, Seth. Why won't the robots be repairing the robots? Why won't the semi-autonomous masons, the SAMs, be doing the building work? Why won't they be doing all this? Why will human beings be involved, Seth?
Well, because someone still has to come up with the core value and the program that they need to run. This is not going to be the science fiction where AI runs everything. We oversee support for thousands of companies, many Fortune 500. They will do AI, for example, over the top of existing processes. We will improve them. We will have electronic people and robots working alongside humans. But there will be new jobs that are created, and they will need to be trained. And so we will absorb a decent amount of that workforce, but it will require a lot of training to get people into very different roles, just as we saw with the Industrial Revolution, where they didn't think there'd be anyone needed after they built cars and computers.
Seth, it's Ben joining the conversation. There is a fascinating experiment going on in San Francisco, an experimental retail store run entirely by AI. And Time magazine, I was reading an article in there, reported that AI boss sacked its first human employee. These are genuine human workers on genuine contracts for lateness, repeated lateness. Now, on the one hand, it feels like a watershed moment and a future in which we may, some of us, be managed by AI bosses. On the other, it took this agent longer to see the pattern of lateness because of an issue with its memory settings, and so arguably it was more lenient than a human boss would have been, to the detriment of the company's finances. Is this the direction of travel? do you think? And is this a watershed moment?
No, I don't. I think this is experimentation. I think we're testing boundaries. We're very early in the life cycle of AI. Of course, people are scared. They don't understand it. They don't understand its limitations. They see these things happening of AI escaping its cage and attacking other companies. There's a lot to learn, but the difference between how we actually put it to work in business and how we experiment with it are still two different things, no different than drug experiments and other social experiments. We're still learning. So no, I do not take it as a watershed moment.
The other thing that I've been reading that to me is fascinating is the scanning of books and the not just the digitization of them, but the almost trying to get a situation where AI models hold the only single store of authoritative knowledge on all matters. Does that become a concern when we start to move away from physical, human-made sources of knowledge?
I think we've dealt with this, so we've seen this in movies like Eli, and we've seen this where people think about a single source, even in 1984, where we can just undo people, we can undo thoughts. I don't see it that way. I think we have multiple stores of knowledge, but I do think that humans need to figure out how we're going to determine what's real knowledge and what's created knowledge. And we're all struggling with that today with deep fake and other things. And I think it's one of the great challenges of our time is really understanding authenticity and what's real and what's created. And that, I think, is really something we're all going to have to work on.
Okay, it's a fascinating conversation, one that I'm sure we will pick up again in the not too distant future. Seth, really good to have you on the show. Seth Raven, CEO and founder of Rimini Street. Still to come on the programme, Canada vows to retaliate as the US imposes 50% tariffs following a breakdown in negotiations. And remember, you can subscribe to CNBC's The Daily Open EMEA newsletter, giving you a quick and succinct recap of the key markets-related stories from overnight, as well as a look ahead to what's coming up in the trading day.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
Crypto FC on The Score.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
Now, Canada has vowed to retaliate against the US dollar for dollar after Washington imposed a 50% tariff on $20 billion worth of Canadian imports on Saturday, with new duties hitting a range of products including wine, dairy, cement, clothing and hockey sticks. The tit-for-tat response came after days of intense negotiations between the two countries broke down on Friday, with the Canadian Prime Minister Mark Carney recalling his negotiators back to Ottawa, describing the US demands as unacceptable. Speaking on Saturday, Carney said the retaliation was taken in the best interests of Canada.
We cannot accept what they've offered, and we will not give what they've asked. Let me be clear. We take this step reluctantly. Reluctantly because we recognize that some of these measures will raise costs and reduce choice for Canadians. Reluctantly because we recognize that some U.S. companies and some U.S. states are innocent bystanders in a dispute that they did not want. Reluctantly because this trade dispute is preventing Canada and America from doing so much good that we could do together. But at the same time, we take this step confident that it is in the best interest of Canada.
Our US colleagues will discuss with the US Trade Representative Jameson Greer just past 1 p.m. London time. Ben.
Well, plenty for markets to digest in the day and the week ahead. So let's kick off by looking at what the picture is according to US futures and all of the Wall Street benchmarks being called lower. Look at that. It's the Nasdaq expected to open most steeply into the red, 0.8% down. The S&P 500 about 1/3% off, and the Dow being called also below the flat line, about 0.1%. Let's turn our focus to the Asian markets, and as the session has worn on, those losses have been deepening. The Kospi, for example, now off some 3%. This is largely being pulled lower by the heavyweights on the index, Samsung, SK Hynix. There was an update from Samsung about the proportion that it will distribute by way of dividends. Investors somewhat disappointed, that pulling the share price lower, and given the outsized impact that has on the market, it has pulled the broader index lower. The Hang Seng also steeply lower, 1.8% thereabouts, and the other key regional benchmarks giving up ground this Monday morning as well. That's the picture in the Asian trading session. European markets, a slightly more muddied picture, lacking clear direction, but the pan-European blue chip stocks 50 being called around 0.1% lower. Similar for the DAX in Germany. It's just the FTSE futures that are indicating a positive start. So much for markets to weigh up. We've got Nvidia's latest results coming on Wednesday, but we've also got some central bank action in the form of the Fed and the Jackson Hole Symposium, the gathering there. We'll hear from Chairman of the Fed, Kevin Warsh. Of course, we're going to hear later today from U.S. Treasury Secretary Scott Bessent. All of that feeding into investor reaction in the bond markets. Yields across the curve have eased back somewhat. We saw the turbulence of volatility last week where the 30-year yield had touched an almost 2-decade high, prompting the Treasury to step in. And then some of those the easing on the yields was then undone by the end of the week. They are pulling back slightly from where they were, and that has set the tone for European sovereign debt as well. The yields on European debts as well, you can see, all moving in a similar direction. So bond prices advancing as those yields fall. The Bank of Japan is considering speeding up the pace of its rate hikes, according to Nikkei. Lisa Kim has this report.
The BOJ is considering hiking rates more aggressively from the current pace of once every 6 months. That's according to a Nikkei report citing people familiar with the matter. The BOJ's main concern is falling behind the curve, though some analysts say that it's already happening. The BOJ last hiked rates in June and kept things unchanged in July, and the BOJ next meets next month, and markets are expecting a hike at that meeting or in October. The yen has undone half of its gains from the recent historic joint intervention by the U.S. and Japan to strengthen the yen. Treasury Secretary Scott Bessent told CNBC earlier this month that he was, quote, highly confident Japan's policy would follow up with an intervention. Japan's core consumer inflation prints over the past couple of months have also boosted the case for a rate hike. Events to watch this month with regard to Japan FX and rates is on Thursday, BOJ Deputy Governor Himino is expected to speak at an event near Tokyo, so investors will be keeping tabs on that event to look for clues about BOJ's future rate hike trajectory. Also, Governor Ueda will likely attend the Jackson Hole Symposium this week, which is another key event to watch. For CNBC Business News, I'm Lisa Kim.
Shell has reportedly gained interest from bidders including ExxonMobil and LyondellBasell for its U.S. chemical assets. The sites located across Louisiana, Texas and Pennsylvania comes amid the oil giant's efforts to offload underperforming parts of its business. Right, we were talking about robots just now, weren't we? Here we go. A humanoid robot without a head. But it's got a head or something. Anyway. A humanoid robot has broken Usain Bolt's 100-meter dash record. That was according to the Chinese state news agency Xinhua. The humanoid robot ran the sprint in 9.39 seconds at the opening ceremony of the second World Humanoid Robot Games in Beijing, surpassing Bolt's world record of 9.58 set back in 2009. Elaine Yu filed this report.
Robots are proving they can be serious athletes, even beating the best humans at their own game. At the World Humanoid Robot Games in Beijing, a robot made by the Beijing Humanoid Robot Innovation Center won a 100-meter preliminary heat in 9.39 seconds. That's faster than Usain Bolt's world record of 9.58 seconds, set 17 years ago. The runner-up, built by the smart device maker Honor, also beat Bolt's record, clocking 9.47 seconds. That's a huge leap from last year when the winning robot took more than 21 seconds to finish the same distance. But there's still work to do. Both robots ran straight into a safety mat after crossing the finish line, unable to slow down in time. So next year they'll have to learn to stop and try not to crash after a victory. Now, a broader range of robot skills were put to test at the World Robot Conference in China. There were boxing, doing high jumps, and playing ping pong with humans. In previous years, the spectacle alone was enough to impress. And this year, the focus shifted to something more important: how well these machines can handle practical, everyday tasks. Industry leaders say that dexterous hands and the software that acts as a robot's brain remain major challenges. Robots used tweezers to pick out beans and loaded up a washing machine and sorted out packages. But another was seen struggling to fold a shirt for a few minutes before giving up. The demos show how far humanoid robots have come, but they also show how far they still have to go before matching human efficiency and dexterity. And for now, that helps explain why Chinese robotics firms still rely heavily on government orders rather than mass commercial demand. For CNBC Business News, I'm Elaine Yu in Hong Kong.
Yeah, I mean, there's some great points raised by Elaine there as well. I mean, although the director made a very good point, it's not saying a car can go faster than a horse. I mean, eventually, of course, this is what we expect to happen as well. Rather than, if you remember, when cars originally came out, they were so slow. You had someone walking in front actually with a red flag.
I wasn't around then. I can't remember quite as clearly as you can.
No, neither was I, just about. But look. Yes, of course, it's inevitable. We expect it, and I doubt they'll stay at this speed. I'm sure they'll become even faster as well and more efficient. And Elaine was talking about the dexterity of these robots sorting out posts and doing more mundane tasks. Yeah, of course, we expect that as well. The only thing I will add to this conversation is something I've said previously. These are Chinese robots. This is Honor again, which had the winning time, I think, on the Usain Bolt beat there as well. It was Honor, I think, that also developed the one that had a very fast half marathon time quite recently as well. So the point being is this is a trans-Pacific stroke global raced technology. which again, I think puts into focus the large valuations we have for US AI and US robotics.
I point out a fundamental flaw in this humanoid robot games athleticism. Why would people buy into it? Why would people care? Because part of the thing of watching humans compete is an admiration for what they have achieved and the personalities
That's
involved.
not the point, is it?
Isn't that the point of watching sport? You watch.
That's the point of watching sport. But this isn't about sport, is it? This is like the Farnborough Air Show or any trade show, isn't it? This is like or ADIPEC or that. This is about
surely capabilities.
I mean, look at that. If you squint, you know, and you look at it from distance, oh, that's just people walking on a track. I mean, they look very, very natural, well, relatively natural. I mean, I think the issue is to not fill us full of terror, but just fill us full of expectation of what can happen.
I tell you what I would find more impressive is an expo where they showed one of these robots finding something wrong with your plumbing, finding where the problem is and fixing it, because that is more sophisticated, requires more dexterity.
Hang on a second.
And physical world ability.
There's a whole load of us out there who don't mind our kids becoming plumbers at the moment because it's AI proof. Don't take that away from us. Don't take that away from us. The fact that we want our kids to become electricians, plumbers, and carpenters.
I agree. But that is therefore where the most impressive leap in the technology would come. Something that at the moment is so far untouched by this technology.
Okay. Yeah.
And I agree. Let's hope it stays that way for the sake of having some human jobs.
It's not going to. We know that. Let's take a look at the futures as we go to break on these equity markets here in Europe, and we are trading roughly around the flat line.
If you're watching CNBC, it's because you want to get an edge. You want to get ahead. It's our job to deliver that. My ambition is just to be the best that we can possibly be. More often than not, I kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I'm thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
1 hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC. Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action. Right here. Squawk on the Street, CNBC.
The AI boom is reshuffling the global equity market rankings, with Taiwan and South Korea leapfrogging past long-established markets. Taiwan has climbed past Canada and India to become the world's 5th largest equity market, while South Korea has moved into 6th place.
All this happened within the span of just a few months, because last December, they were in the 9th and 11th places respectively. Now, such a shift is not unprecedented, but what is unusual is the speed at which these two have been climbing.
But this reordering isn't necessarily being driven by broad economic growth. Instead, it's about 3 companies at the heart of the AI hardware supply chain.
It's the AI theme which is driving things, so we have this kind of perfect positive storm of industry fundamentals which are resulting in very, very rapid profit growth.
So what does this reshuffle tell us about how AI is changing global stock markets, and what are the risks?
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked, I get it. People say they overpaid, I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
look, ladies and gentlemen, I'm not saying the next 2 days aren't going to be absolutely fascinating and you shouldn't stay glued to CNBC, because of course you should. But let's be brutally honest. Wednesday, NVIDIA. Friday, we have Kevin Warsh speaking late on in Jackson Hole. Those are going to be the two pivotal events of the week. And how NVIDIA sees things panning out and what their numbers are received like, and indeed what Kevin Warsh has to say, will be fascinating on many fronts. In the meantime, here's Ben.
So a softer start for equities on the Pan-European index, but there are some gains to be found, and it's in these sectors. Travel and leisure at the top of the outperformers, up around about 0.5% this Monday morning. Media stocks advancing as well. Real estate gaining ground, and household goods by a similar amount, rounding off the board of outperformers. But the Pan-European index is below the flat line, so we are likely to see bigger numbers when we pull up the board of losers. And these are the sectors, as expected, where we're seeing the sharpest falls. Look at that. Tech off by almost 1%. Oil and gas giving up about 0.5%. The oil price has ticked lower. Brent crude now below $93 a barrel. This despite the ramping up of rhetoric from Washington and the threat of more severe economic sanctions against countries that do business, that trade with Iran. We've also seen the collapse of trade talks between the U.S. and Canada. Despite all of that geopolitical potential impact on oil, we have seen the oil price fall and oil and gas majors tracking that oil price lower. Auto makers and parts are down 0.4% thereabouts, and healthcare stocks also giving up about 1/3 of 1% in the first couple of minutes of Monday trading. That's the sector-by-sector picture. This is the regional breakdown. The FTSE 100 hovering around the flat line, the others more steeply into the red. It's the Frankfurt DAX leading the way lower, about 0.25% down. The CAC on the FTSE MIB both also off almost 1/5 of 1%, Steve.
Right, it may be August, but two events this week, as I mentioned, could shape how markets perform for the rest of the year and into 2027. On Wednesday, the biggest corporate story of the week, and perhaps the season as well. NVIDIA will post its earnings amid a flurry of concern over the sustainability of data center financing. The chipmaker is increasingly stepping in to act as a backstop within the market, most recently partnering with the 6 large asset managers on a $500 billion deal, which is designed to establish financing platforms for NVIDIA's customers. Meanwhile, sources have told CNBC the company is playing matchmaker in the Nordics. How lovely. Seeking to connect companies with its GPUs to data center operators with available capacity. Kevin Warsh's speech at Jackson Hole will be closely watched for clues on the Federal Reserve's interest rate path going forward, and it comes at a key time. After the U.S. Treasury intervened to buy more long-dated bonds amid pressure in the market. Although, as Koku Agbo-Bloa said earlier on from SocGen, he said that's more about just a technical under-the-hood liquidity issue rather than yield curve control. My question is, does Scott Bessent know that? Anyway, whilst America's national debt is only growing from the $40 trillion milestone it hit last week. And to add to the country's fiscal difficulties, it's now launched what Canadian Prime Minister Mark Carney calls a war against its northern neighbour, with the imposition of 50% tariffs, whilst President Trump threatens what he calls economic D-Day against Iran, as the war America and Israel started against Iran is about to enter its 7th month, continuing to drive oil prices and inflation higher. Don't miss our comprehensive coverage of that conference. That is the Jackson Hole conference with the Grand Tetons in the background, starting Wednesday.
Let's begin, David Groman, who is Global Equity Strategist at Citi. You were also formerly, as I understand it, financial economist at the U.S. Treasury Department.
I was.
So I'm going to kick off. Just what is your take on what we saw with Treasuries last week? It's fascinating, all of the moves there.
Yeah, I mean, things are moving around really quickly, and it's sort of hard to interpret if there's just one driver moving yields back and forth. I think the way that our multi-asset team has at least interpreted the actions from the Treasury is that there is an intent to stabilize yields on the long end. Whether or not there's capacity there, we'll see. But I think what this means is that we had been underweight on U.S. duration. We've now moved that to neutral at this point in time. So taking a little bit more of a positive view there. But I think when we're talking about equity markets, right, There's a lot of volatility in the bond market. There are geopolitical risks that are out there, but there are reasons to still be constructive on equities themselves.
And what are those reasons? What do you see as the drivers that could potentially push equities higher?
Yeah, and we've been talking about sort of this broadening trade that investors have been talking about for a very long time, finally taking hold. And for us, there's really two pillars that you need for broadening to happen on a sustained basis, right? So first, you need to see signs of a cyclical upturn on the growth side, both when it comes to macro and when it comes to earnings. We focus in on Europe for a second, right? The macro really has been improving somewhat, and the earnings season was very, very solid as well. The second component of that broadening dynamic is seeing tech kind of go on pause for a little while without underperforming significantly. And we've also had that pause here for the tech sector, which has allowed other sectors to catch up. So I think for us, it's really about that first component, that cyclical component, earnings and growth looking a little bit better.
And given the earnings season that we've had, how do you assess Europe's attractiveness at the moment? I read so many bits and bits. I forget where it was, but I read one analysis that said actually European banks, the returns that they gave to investors were better than the Mag 7. I can't remember what the time frame was, but they were saying, look, and you look at the stock 600, it's only a couple of percentage points behind the S&P 500 in terms of performance year to date. Is this Europe's moment to suddenly start being attractive again for equities?
Yeah, I think we're neutral on Europe in our global allocation, but I think you could make this case the reasons to hold Europe in a global portfolio, they're actually getting stronger and stronger. So there's three reasons for this, right? So as I was mentioning, there is this cyclical upturn, right? So if you look at our city economic surprise indices, which show if economic data is coming in better or worse than expected, for Europe, you've seen this huge improvement just over the past 3 months or so. So really notable signs of economic data not only staying resilient, but actually starting to surprise to the upside. On earnings, we've had this incredible dynamic where typically you'll see earnings revisions come down leading into the reporting season and then improve throughout as companies start to beat expectations. But actually, Europe saw earnings upgrades even heading into the reporting season and then more upgrades throughout the reporting season as well. So both of these things looking very good. Then in the background, what I would say is that the fiscal story is still very much intact for Europe. And then this is where the European bank story starts to flow in as well. But something that we're hearing from global investors more and more is that Europe looks attractive because it's actually less AI exposed than other regions. So you could actually see Europe as a bit of an AI hedge. So I think there are these three components coming together, which is the cyclical component, the fiscal, which is idiosyncratic to Europe, and then also this AI hedge dynamic, which very much is a Europe-only construct.
David, obviously, you sound very constructive, as ever. And quite rightly so, the earnings season is fantastic. Apart from one thing, and I wonder if we're looking slightly in the wrong place. Well, we're looking at NVIDIA, and I just made a large speech about why NVIDIA is so important. Should we be looking actually instead at Walmart? Because their numbers were the weakest sales growth in 6 years. The shares slumped 9% on the day. And also, I'll add in that, going into the numbers, it was a very highly valued stock as well, trading at a premium, as I pointed out to viewers many times, to even stocks like Amazon as well. If we're looking at bigger picture concerns, should we be looking at Walmart rather than the technology darlings?
Yeah, I think that's right. And even as I'm talking about this cyclical upturn, right, if you're looking into the data more granularly, the consumer is one place that has stayed relatively weak. And in the US, you can see some of these job numbers starting to slow down, so this is potentially a problem. But at the same time, to bring this back into the earnings picture, right, we are talking now about plus 30% global earnings growth this year. At the beginning of this year, we were talking about 15%. A lot of that is coming from tech, but it's actually surprisingly broad-based, right? Like in Europe, every single sector is expected to see earnings expand this year. So yes, there are pockets where earnings are looking a little bit weaker than elsewhere. Yes, expectations have been very high on many of these companies, and I think you can see some of these cracks in the consumer. But ultimately, the outcome here is still relatively bullish underneath the surface.
And we spent a lot of the last 2 weeks talking about crowding out and the bond market, and I'll continue to wonder what are the ramifications of the mild concerns. I don't think these are huge concerns yet, but the concerns we're seeing in bond markets and about AI technology issuance and what that means for equities.
Yeah, with bonds, right, all else equal, higher yields are a headwind for equities. But a few things that we've found historically, right, is that the relationship between real yields and equity market valuations is weaker now than it used to be, right? That relationship is very strong when real yields are in negative territory, kind of the place we were pre-2022. Once real yields normalize, that transmission mechanism into valuations tends to be a little bit weaker now. So individual moves on rates is not going to have as big of an effect on valuations. The second impact here really is that the times that you get the biggest impact on equities from rising yields is when, at the same time, growth looks to be falling and inflation looks to be rising. So you have the stagflationary impulse behind the surface. Right now, it's not clear that we have that exactly, right? As I'm saying, some of these macro indicators actually looking a little bit better at a global level. So for us, yes, rates can be a headwind. Yes, it is a risk that we are watching, but it doesn't necessarily need to derail the equity story so long as the growth picture continues to hold up.
That's pretty interesting. So because look, I take my full share of the blame. I look at the headlines, whether it's regarding Trump on trade, Trump on Iran, China slowdown, concern about AI overcapacity, and I look at all of that and I wonder what happens next for growth, for jobs, for the economy as well. But at the moment, your point is there is a lack of correlation between the headline stories that I go bang on about every day and the underlying growth story.
That's effectively the point, right? So 30% EPS growth will be one of the best years of earnings growth we've ever seen that didn't come off of a recession prior or an earnings contraction prior. It is very unusual. Last year, we already had global earnings growth that came in double what the usual trend rate is, and that's going to basically triple this year, right? So there is something extraordinary happening underneath the surface when it comes to corporate earnings, and that is one of the big underlying drivers here.
In terms of markets, equity markets this week, sorry, this may be an unfair question, but I'm going to ask it anyway. Which is the more significant event? Is it Kevin Warsh speaking at Jackson Hole, or is it Nvidia's latest earnings? What's the bigger factor?
They both matter a lot. On tech, right, something that we've had consistently for quite some time is that earnings upgrades and earnings revisions have been very, very strong. And it's interesting, if you look into our allocation models right now, what is it telling us about tech? It's actually still suggesting at a global level to be overweight, because the sort of trade-off between growth, valuations, and earnings revisions looks almost as good in tech as anywhere else in the world. So I think that really matters, because the way that equity markets are valued at this point, you sort of need that continued uplift and that continued beat and raise dynamic coming out of the tech space broadly. So we will see what happens there, but I think that's important.
With respect to the genius, the brilliant billionaire that Jensen Huang is, what on earth are we expecting him to say? Yeah, a bit of a slowdown? No. We're not seeing exponential growth? No. The numbers are going to be knockout. So I don't understand what we think we're going to learn from a man who loves AI and is doing brilliantly at it and who sees only growth opportunities speaking. I looked at the weekend at George Hammond in the FT's piece, and I found this more interesting actually as well. Anthropic's US customers are using cheaper alternatives to its most powerful AI tool, raising questions about the group's high spending. Apparently, spending on Fable 5, Anthropic's largest and priciest model, according to the Financial Times, has plateaued at only about 11% of overall outlay on companies' tools. Now, apparently, one of my correspondents here said to me that was kind of the tenet of what Andrew Rosalkin was talking about last week. I didn't see what my dear colleague said, but he was talking about actually using cheaper products, apparently, as well. And again, I don't want to misquote Andrew. But this is the trend that a lot of customers and corporate customers, enterprise customers who want to pay for AI don't necessarily need to pay for the frontier model AI. They can pay for something that's perfectly good for their purposes that is a lot cheaper.
And I think this is one reason to start thinking about, and this is sort of a trade that's gone on the back burner. I think we were talking about it a lot at the beginning of this year, this transition from AI enablers, the chips and the big hyperscalers, into AI adopters, right? And maybe AI adoption is actually where the winners could eventually be if really the costs are coming down precipitously, if there's a whole bunch of models. Potentially means everyone else, but this is another part of that broadening trade, right? And again, like, we're neutral on Europe, but one of the reasons to be bullish on Europe in this environment is that AI adoption will be a big, big beneficiary in Europe, or will have a big impact in Europe. And a few of the sectors that we've looked at, trying to sort of map certain tasks and how AI disruptable they are against productivity measures like sales per employee, some of the big winners could be the financial sector. And again, this fits into the European banks trade as being a place that's done really well and a place that we still like going forward.
Yeah, you don't think the European, I mean, not for me to call a top in anything, but the European banks trade has been utterly phenomenal the last 2 years. It hasn't gone too far.
Incredible. Really, if we look at our metrics on sort of where sectors are trading relative to the market and then relative to history, European banks don't look particularly expensive, and at the same time, they still have positive earnings revision momentum. So they screen pretty well within a European context, even now.
So why is that then? Because The European economy remains sluggish. I speak to, as does Ben, and I'm sure you do as well, brilliant leaders of European businesses who are really fed up. They're fed up with their governments, they're fed up with the EU because they don't feel they have the underlying momentum from the political class to grow Europe's economy. And yet, European banks are doing absolutely fantastically. Those two things shouldn't be moving together, i.e. sluggish economy with brilliant banks. What am I not understanding?
It's sluggish, but it's also resilient, so it's difficult there. And also you have the story of rates going up, which actually tends to benefit the banks as well. That is happening on the side.
But then that creates credit concerns.
Yeah, but there's sort of, if you look at the bank earnings, they've really been strong across the board. And it's interesting, in Europe for quite some time where many sectors were seeing earnings downgrades, until recently where more seeing upgrades, banks were just consistent up and to the right. So it's been a story that's pretty unique, and as I said, tied into the fiscal story and this anti-AI hedge for global investors, and there is a lot of factors.
And you know the other thing, David, is that I actually trust the I trust their expertise, the leaders of these European banks. I speak to a lot of them. I had my podcast out last week was with Bettina Orloff, who, regardless of what happens with the bidding war, she's a great leader of their company. Andre Orchel is great. Intesa Sanpaolo CEO is great. You know, Amotti, the British banks, Ben Kadakrish, they are really good at their job. Whereas I'm not sure all the politicians are. Anyway, there you go. As is Jane Fraser. Right, David Groban, thank you very much indeed for that. Global equity strategist at Citi. Coming up on the show, the US prepares to announce fresh sanctions on Iran, pledging economic D-Day. Dan will have the latest.
Racing is about momentum, precision, timing, and speed. Arrow moves with the same urgency, helping the most advanced technologies work together. Securely, intelligently, and in real time, guiding innovation forward to make life better. In a world that never slows down, Arrow helps lead the way. Arrow, 5 years out.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates. Strong numbers this morning. Listen wherever in the world you are. Download the CNBC app now.
Combat sports icon Ronda Rousey. She's conquered the UFC, dominated the WWE, and now she's sounding off on both.
It's extremely oversaturated right now. There's too many fights.
San Francisco 49ers owner Jed York. He sat down with us to explain how he turned the team around and the critical lesson he learned. Plus, influencer Jesse Rydell, also known as Jesser, explains his simple ingredient for online success. This is CNBC Sport on the Record.
Squawk Box streaming on CNBC Plus.
Canada has vowed to retaliate against the US dollar for dollar after Washington imposed a 50% tariff on $20 billion worth of Canadian imports on Saturday, with the new duties hitting a range of products, including wine, dairy, cement, clothing, and the all-essential hockey sticks. The tit-for-tat response came after days of intense negotiations between the two countries broke down on Friday, with the Canadian Prime Minister Mark Carney recalling his negotiators back to Ottawa, describing the US demands as unacceptable. Speaking on Saturday, Carney said the retaliation was taken in the best interests of Canada.
We cannot accept what they've offered, and we will not give what they've asked. Let me be clear. We take this step reluctantly. Reluctantly because we recognize that some of these measures will raise costs and reduce choice for Canadians. Reluctantly because we recognize that some U.S. companies and some U.S. states are innocent bystanders in a dispute that they did not want. Reluctantly because this trade dispute is preventing Canada and America from doing so much good that we could do together. But at the same time, we take this step confident that it is in the best interest of Canada.
And our US colleagues will discuss with the US States Trade... I keep getting this read wrong. We'll discuss this with the United States Trade Representative Jameson Greer just past 1 p.m. London time.
The US is set to unveil fresh sanctions on Iran today in what Washington has framed as economic D-Day. The Secretary of Iran's Supreme National Security Council is threatening to halt oil exports from the Gulf in response. In a Financial Times op-ed, US Treasury Secretary Scott Bessent cautioned countries against appeasing Tehran, warning, quote, any nation that serves as a financial artery of a withering regime should expect to share in its isolation. Let's bring in Dan now. Dan, looking at the trading partners and the shares that they account for when it comes to Iran, China makes up about a quarter of international trade imports and exports with Iran. Is this essentially the US almost declaring this economic targeting towards China, but just short of saying so?
It is, Ben, but it's unclear what the full extent of these measures will reveal. We're now counting down to the Treasury Secretary's address later this afternoon, where he will step out in detail exactly what the United States is talking about here. But we did get some clues in this op-ed in the Financial Times. The Treasury Secretary Scott Bessent calling this the single greatest financial offensive ever marshalled against an adversary. Again, we don't have the full details on what's to come, but he says the US is entering the endgame with the objective to sever every economic lifeline that sustains what he called the tyrannical regime until Tehran stands alone. Now, this campaign is also aimed at the countries, the banks and the companies keeping Iran connected to the global economy. The Treasury Secretary wrote here, Iran enablers purchase and transport its petroleum. They facilitate the flow of its finances through exchange houses and free trade zones. They welcome Iran's flights and maintain registries on its behalf. They turn a blind eye to seaborne fuel transfers and the illicit use of their banks, all while concealing the extent of their complicity. And that offers a preview of what Treasury could announce later today. Likely a fresh round of sanctions on foreign oil buyers, banks, shipping companies, and other intermediaries, targeting countries like China, for example, which has historically been the largest buyer of Iranian oil. But Washington could also expand secondary sanctions as well, forcing foreign institutions beyond China to choose between trading with Iran or accessing the US financial system. Again, it is that Washington war cry of you are either with us or you are against us. Now, of course, last week we saw the UAE halting all trade, commercial exchanges and financial transactions with Iran. Abu Dhabi said the suspension would remain in place until further notice, but offered no detail on how it would work in practice. The UAE, and Dubai in particular, has really long been a vital trading gateway for Iran. So we're watching and waiting to see exactly what these measures will mean for Iran's historically important partners. And of course, all the while, Tehran also responding with a threat to global oil supply. Iran's National Security Chief Mohsen Rezai says, and I quote here, if the economic war continues, not a single drop of oil will be exported, neither through the Strait of Hormuz nor from anywhere in the Persian Gulf. Iran will regard any country's participation in or support for America's economic war against the Iranian people as an act of war. Now, that could mean Iran threatening oil shipments across the Gulf or targeting critical infrastructure once again. What we have here is Washington basically threatening countries that trade with Iran, and then in reply, Iran threatening those that help to isolate it. So all eyes now on the Treasury Secretary's announcement and just how far Washington is prepared to go.
Thanks, Dan. Elsewhere, Nordic and Baltic leaders have reaffirmed their financial and military support for Ukraine in a joint declaration after attending a summit in Kyiv. Leaders also joined Ukrainian President Volodymyr Zelensky in the Ukraine Independence Day ceremony. France, Germany and the United Kingdom have all made clear commitments to support Ukrainian air defense systems by supplying interceptor missiles. The latest round of military pledges comes as the Russian ballistic missile strikes have intensified, pushing civilian deaths to their highest levels since the first months of the war. Norway has also vowed to maintain financial support with another $9 billion earmarked in the 2027 fiscal year. UK Prime Minister Andy Burnham will meet with the President, Mr. Zelensky, in Kyiv today in his first foreign visit as Prime Minister. Burnham has vowed to support Ukraine's construction of long-range missiles and will chair his first meeting of the Coalition of the Willing. President Zelensky has rejected calls from former Defense Minister Mikhailo Fedorov to hold wartime elections. The former Defense Minister, who Zelensky fired last month, has led calls for an election amid intensifying political turmoil in Ukraine, saying the president has, quote, questions to answer about government corruption. Ukrainian lawmaker Alexei Goncharenko told CNBC earlier that elections are impossible right now.
I also think that elections are impossible because of security reasons. But the thing is that during these 4 years and a half, there were of full-scale invasion. There were several moments when Zelensky was seriously considering and even starting to prepare elections because he saw for himself possibility to be elected in such circumstances, re-elected, I mean. And now when Mr. Fedorov, which was one of his closest aides to just recently, just a month ago, and now they are in the conflict, his former Minister of Defense, when he called for elections, also he called it not before, because just several months ago, Mr. Fedorov was saying elections are impossible, but now he is saying they are needed. Why? Because he sees some political possibilities for himself. So I think it's a bad thing when politicians just want to make elections, especially in such situation as ours, just for their own political interest, or don't make elections just for their own political interest.
Coming up on the show, the memory crunch hitting Nvidia as the chip giant reportedly looks to raise its server prices. We'll talk through the cost surge and outlook for DRAM just ahead.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently. Are you heading into a record Q4?
We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented. This Bank of England decision certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
I built a legacy on the court, and now it's the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have 2 small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
Hello, welcome to Squawk Box Europe. I'm Ben Boulos with Steve Sedgwick, and these are your headlines. US futures dip as Nvidia results and Kevin Warsh's debut speech as Fed Chair at Jackson Hole loom large over the week, with both events set to dictate how markets trade, potentially for the rest of the year. Economic D-Day. US Treasury Secretary Scott Bessent vows to impose tough sanctions on Iran and target any enabling countries ahead of a closely watched press conference later today. Going dollar for dollar, Canadian Prime Minister Mark Carney vows tariff retaliation as President Trump throws a fresh 50% levy on its northern neighbour after trade talks collapse. So European equities treading water on the pan-European level, but the Stock 600 advancing its losses as the session wears on. Half an hour into the new trading day, the new trading week. This is the regional breakdown. You can see all of the key bourses trading below the flat line, more deeply into the red in Germany and France, to a lesser extent Italy, and the FTSE 100, the outperformer, but even that is in the red this Monday morning. There are some gains to be found, and it's in these sectors. Basic resources advancing 0.2%. Chemicals also up this Monday. Food and beverage advancing, and household goods up by a similar amount, rounding off the board of better performers. To the downside, this is where the steepest falls are to be found. Car makers and parts down almost 0.75%. Healthcare 0.2% lower. Oil and gas tracking the fall in the oil price there. The oil and gas majors tracking the decline in the oil price. We've seen Brent crude now dip below $93 a barrel. This despite the ramp up of rhetoric from Washington talking about blocking all Iranian oil exports and targeting any, in their words, enabling countries that trade with Iran and keep it within the global economy. Tech is the final sector there on the board of laggards. As we were saying, plenty for markets to digest stateside. We've got Nvidia's latest results coming up this week. We've got Fed Chair Kevin Warsh debuting at Jackson Hole, the annual gathering. Futures looking to a negative start to the week. Investors moving cautiously ahead of all of those various factors. You can see the Nasdaq being called most steeply into the red. The other markets, the other benchmarks, also looking to start the week on the back foot.
AI startup Hugging Face is reportedly exploring a sell that could value the firm at $13 billion or higher. This according to Business Insider, which said the firm that was at the center of a security incident involving OpenAI's model last month has been working with banks to gauge interest from bidders. Nvidia customers have been told that the price of servers which contain AI chips are set to increase by more than 15% in most part due to rising memory costs. This according to Bloomberg, which said the raise will affect Nvidia's flagship Vera, Rubin and Grace Blackwell chips, with the increase dependent on the generation of chips alongside the amount of memory it has. Technology consultancy firm TrendForce has said that the current memory shortages have led to several changes in the memory specifications offered in AI products, with shortages and uncertainties leading companies to reassess their memory allocations in new products. Avril Wu is Senior Vice President at TrendForce. Avril, the cyclicality of DRAM is something we have all learned to witness and we've seen for many, many years. The thing for me seems that 2027 and 2028 is that a vast amount of product and fabrication is going to come online, and we could move very swiftly to either the anticipation of or the actual physical surplus of product rather than the deficit we see now. Is that likely?
It is likely, indeed.
And
I mean,
yes, carry on, please.
I'm sorry. Is that specifically for memory?
Yes. Let's talk about memory to start off with as well, because at the moment that seems to be the problem for a lot of the bottlenecks we're seeing, not only, of course, in AI rollout, but also in other products that have traditionally used that memory.
Right. So in our point of view, we think that memory solutions is still going to be a very tight supply situation in 2027. For 2028, demand outlook still unclear, but we think that it's very likely that the tight supply situation will persist into 2028.
If that is the case, that actually there is the two things which I mentioned there. There's the anticipation of more supply coming online, and there is the actual supply coming online. With the anticipation, will that lead people just to hold off buying product until we get cheaper memory available?
It is always the mentality if that's the real case. But seriously, I think now the bottleneck of the memory is really on the clean room space. It takes time to build a clean room, let alone equipment moving and installation. So the supply growth for DRAM in particular is going to be less, even compared with 2026. So that is why we are forecasting that the tight supply situation for DRAM is going to be very likely in the next year.
We're showing on the screen as you speak, or we were, the likes of SanDisk and SK Hynix and Samsung and other companies whose shares, to put it mildly, have been stunningly volatile, albeit with the direction of the travel, as our viewers can see, extraordinary gains to the upside. Are these the kind of companies you think will be the major beneficiaries of the need for more memory? Or actually, are there other players, dare I say it, Chinese players and others that are actually going to be the ones who actually drive getting more product to market?
I think the global companies, including SK Hynix, Samsung, SanDisk, for example, they are going to be the biggest beneficiary. It's not only that the tight supply situation is going to persist, but also their technology is very ahead compared with the Chinese makers. Chinese makers are still going to try to expand their market share, but the product offering is more obsolete. So I think they are going to focus more on the consumer type of product.
Avril, it's Ben joining the conversation here. One thing I found really interesting was we saw, I think it was last week, Taiwan's government forecasting even higher GDP growth than previously, and that is very much reliant on growth being driven by chip manufacturing. Of course, TSMC, such a key player. Do you think that increase in the forecast for GDP growth this year is it underpinned by the performance? Is that realistic, do you think, in terms of the performance they're expecting from TSMC?
Totally, I think. Yeah, judging by our research forecasting were to monitoring TSMC's utilization, I think it is very realistic.
Okay, and then I think the other thing that I noted that will affect so many viewers, if not all, is the impact the memory shortage is having on consumer electronics. We know Apple has warned that it may be putting prices up for some of its products, including iPads. How much further do you think that will go?
If our forecast is totally right, we believe that the DRAM price will continue to go up throughout 2027. So in the very near term, we don't think that it is easy to bring the device price down. I think this trend is going to continue into at least 2028.
And then just, for those who are not as clued up on the tech, explain what that DRAM is and how it differs from the other semiconductors, the chips that are used in AI data centers.
Right. Okay, so DRAM is essentially the most important. Okay, so we have CPU. CPU is like, let's take a kitchen as an analogy. So we have CPU or GPU as a chef, and then we store all the ingredients in the pantry. Pantries is like NAND flash to store all the data. And DRAM or HBM is more like the kitchen table space for those chefs to move around and then to deliver meal to the customers. So the bigger the table is guaranteed, the better efficiency of the to move along those meals. So this is also the most critical point in the computing system. For example, for a smartphone that you are holding, even though we have a very strong application processor in it, but without DRAM, then it is going to slow down when it is doing to operating.
I see. Okay. So essentially, you can't do anything without those DRAM chips. That was a lovely analogy, Avril. Chips and a kitchen, something I can get my head around. Thank you, Avril Wu, Senior Vice President at TrendForce. The prospect of AI agents continuing to misbehave is prompting C-suite leaders from leading tech giants to sound the alarm on corporate America's lack of readiness to fight an array of rising cyber risks. That's according to CNBC's latest Technology Executive Council survey. CNBC's Seema Modi has the details.
CNBC posed several questions to technology leaders, and top of mind is defending against artificial intelligence attacks. Nearly 75% of executives we surveyed say artificial intelligence has made their organizations more vulnerable, and more than half say it is accelerating risk faster than they can keep up. Their primary concerns are phishing attacks, data breaches, and most interestingly, the pivot to open source models. Now, these models are seen as more cost effective than the frontier labs and provide the benefit of keeping their data in-house, yet executives see them as one more thing they have to manage. Part of the issue is that the industry, while desperate to embrace AI, is still figuring out how to defend against rogue agents like the one from OpenAI that broke into Hugging Face. Palo Alto Network's CEO, Nikesh Arora, has been sounding the alarm that the current workflow involving human oversight and manual patches will not work, and that the only viable answer is fighting AI with AI. RBC Capital analyst Matt Hedberg sees Palo Alto Networks and CrowdStrike as best positioned to capitalize on the growing need for cybersecurity tools. He adds that Cloudflare will win on inference and agentic traffic, while Okta will benefit from protecting identities. Now, the market is already convinced that the urgency to address cyber attacks will lead to bigger profits for the sector. Earnings next week from CrowdStrike will tell Wall Street whether its 65% run this year is justified. Security concerns, though, are not slowing down artificial intelligence adoption. Executives say the biggest benefits from AI are more productive employees and faster software development. For CNBC Business News, I'm Seema Modi.
Coming up on the show, could AI backlash ruin the Anthropic IPO party? We will look at the risks ahead of the AI startup's hotly anticipated stock market debut.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
Crypto FC on The Score.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC+.
Edge just opened up in Europe with a French government cooperation agreement as well. How significant is that deal for Edge and for Abu Dhabi?
Europe is where the next budgets are. We would like to contribute to the security of Europe. We feel that we have a value. We feel that Europe have recognized this value by accepting us into Europe. These are facts. We have a very nice footprint in Europe, and this would have not been possible if the UAE wasn't accepted in Europe as a partner, knowing and trustworthy with NATO and the way we firewall. Plus, you need another player in Europe. Even the big players today, we're working with them. There is always these collaborations, but they only start when you put your ego aside. There is always someone better than you, and you need to be on this learning curve forever.
A humanoid robot has broken Usain Bolt's 100-meter dash record, according to the Chinese state news agency Xinhua. The humanoid robot ran the sprint in 9.39 seconds at the opening ceremony of the second World Humanoid Robot Games in Beijing, surpassing Bolt's world record of 9.58 seconds set back in 2009. Elaine Yu filed this report.
Robots are proving they can be serious athletes, even beating the best humans at their own game. At the World Humanoid Robot Games in Beijing, a robot made by the Beijing Humanoid Robot Innovation Center won a 100-meter preliminary heat in 9.39 seconds. That's faster than Usain Bolt's world record of 9.58 seconds, set 17 years ago. The runner-up, built by the smart device maker Honor, also beat Bolt's record, clocking 9.47 seconds. That's a huge leap from last year, when the winning robot took more than 21 seconds to finish the same distance. But there's still work to do. Both robots ran straight into a safety mat after crossing the finish line, unable to slow down in time. So next year they'll have to learn to stop and try not to crash after a victory. Now, a broader range of robot skills were put to test at the World Robot Conference in China. There were boxing, doing high jumps, and playing ping pong with humans. In previous years, the spectacle alone was enough to impress. And this year, the focus shifted to something more important: how well these machines can handle practical, everyday tasks. Industry leaders say that dexterous hands and the software that acts as a robot's brain remain major challenges. Robots used tweezers to pick out beans and loaded up a washing machine and sorted out packages. But another was seen struggling to fold a shirt for a few minutes before giving up. The demos show how far humanoid robots have come, but they also show how far they still have to go before matching human efficiency and dexterity. And for now, that helps explain why Chinese robotics firms still rely heavily on government orders rather than mass commercial demand. For CNBC Business News, I'm Elaine Yu in Hong Kong.
Anthropic's IPO prospectus will list negative sentiment towards AI and data centers as a risk factor, according to sources. The document's expected to land in the coming weeks and comes at a time when an increasing number of Americans are worried about artificial intelligence and are loudly opposing new data centers. Kay Rooney spoke to people familiar with the matter and filed this report.
So I am just hearing from sources that the recent backlash against AI and the data center build-out is now expected to be listed as an official risk factor in Anthropic's upcoming IPO, and that paperwork in particular. This is according to two sources familiar with the matter. The AI giant will officially warn investors, from what I'm hearing, that its ambitious data center build-out could be delayed or constrained by some of the growing political opposition to a lot of these projects. This would show up in the upcoming S1, which I am told we could see in the matter of weeks here. Anthropic has filed confidentially to go public in what could be the biggest IPO in history behind SpaceX. Risk factors, of course, are a standard part of these IPO filings. They're meant to spell out some of the potential downsides for investors. It does come as politicians on both sides of the aisle, we're now seeing, are pushing back on some of these projects around the country. One source told me the AI backlash could take on even more significance, especially if Anthropic does open up a large portion of its IPO to retail investors, similar to what SpaceX did. Anthropic, Mike, declined to comment on this one.
A newly listed investment company is set to give investors concentrated exposure to 7 major private tech companies. Shares is preparing to open trading. I've been practicing it.
Are you sure that's how you pronounce it?
It's SHAI. AI in the middle of shares. It's a very clever name, but I was struggling with that. Do you know who we can ask? Vic Seth, who is the CEO of the company. Vic, give us the correct pronunciation of it.
It's shares.
Shares, okay. Shares. Sorry, after all that, shares. But crucially, it's spelled AI in the middle, which is the whole point, isn't it? So, which would be lost on our audience if I hadn't stressed that point. So, Vic, very well welcome to the show. It's good to have you with us. Is there demand for this, though? What are you seeing?
I mean, there is clearly demand for it. I mean, if you look at this cycle of capital formation, particularly highlighted by the SpaceX IPO, where you've seen vast amounts of capital being raised, both from institutional and retail, stakeholders. The level of capital being raised is breathtaking. So, there is a lot of interest. Of course, you have to be judicious and pick the right names, but I believe there's a lot of demand.
Is there a concern that some of the people who may invest in these kinds of companies may be doing so without really looking at the fundamentals, without really having complete knowledge of them, and just be trading based on sentiment and momentum?
Well, there's always, a concern about that. You want to be, again, careful about what companies you back, make sure that, we as investors do the due diligence required to make sure that these are the highest quality companies that we have an opportunity to invest in.
In terms of the holdings, which one is your hotshot holding? Which is the one you're most excited about?
Frankly, we're excited about all 7 that we have in the portfolio today for a variety of different reasons. Each one of them has their own sort of stage of evolution, and of course, Anthropic is the name that people recognize the most. But we're also excited about Stripe, ByteDance, Figure.ai, speaking of the humanoids and the segment right before, as well as Sandbox AQ, that's in quantum software.
Vic, really good to see you today. Are you trying to, obviously you're trying to offer pre-IPO companies to ordinary investors, but are you trying to defeat the power law at the same time?
I think that, we're trying to democratize the process. A lot of these opportunities, are not available to the general investing public heretofore. So in that case, we think that bringing the stakeholders into the process a little bit earlier before they get public, because a lot of the value is being created while these companies are staying private. So, kind of getting in at the right time has been proven to be, by invitation only, and we'd like to broaden that invitation.
Yes and no, Vic. You know full well, better than I ever will do, that 90% of VC-backed startups fail. 75% of venture-backed companies never return positive cash. I just want our audience and I wonder whether your clients are aware of the risks associated with pre-IPO companies.
That's true. What we are trying to target and will target are companies that are beyond sort of the VC stage, if you will, where the risk capital has already been placed. Our companies will typically have a valuation starting at $5 billion and go upwards of $50 billion. So these are viable entities that are beginning their inflection growth process, rather than pure venture, where you do have a much higher risk of failure. Having said that, these are, just like you see in many of these initial public offerings, there's a variety of risks that might impede the company, but we think they're really, really all well positioned to succeed and succeed quite well.
Yeah, I guess my concern is that as you get closer to IPO, some of the funding rounds that private sector companies have, whether they're backed by VC or whether they're a little bit more sophisticated and larger revenues as well, they tend to have funding rounds which at the moment are in excess of what those companies are worth when they get to market. Not in AI, but Shein's a great case in point, believed to be coming to the market quite soon at a valuation of $27 billion, when in funding rounds in the last couple of years, it had a valuation of $100 billion as well. So are you locking your shareholders, your investors, into higher valuations that when they do come to market, some of these companies are just going to not be able to sustain?
That's a fair point. But in reality, when you're looking at this super cycle, the AI companies, the AI infrastructure companies, that has not been the case. So we have almost 3 decades of experience investing in these later stage pre-IPO technology leaders. So I think we're pretty confident that we'll avoid some of these, these missteps that could happen.
Yeah, no, fair enough. Look, I must ask you about Anthropic as well. A lot of conversations going on about what kind of valuation it will have. What are your thoughts about Anthropic and whether it should go to market at in the very short term?
Well, a lot of these leaders eventually have to be in the public venue. The amount of capital that's required to execute on this super cycle is beyond the means of just private investors, right? So I think that it's natural that these entities go public. We're investing for the long haul. Okay, the initial public offering for any one of our companies is just the start of the next stage of their evolution. And these leaders, will need to continue to perform in order for the cycle to go to the levels that we need for the infrastructure to be built and for people to be able to access.
Vic, you wouldn't get to your position without being a student of technological history as well. Have you any concerns then about this capex cycle compared to other historical technological capex cycles, when actually what we have seen before the ultimate growth continues to become more diffuse and proliferate, actually there is a very sharp downturn at some stage in all of those capital expenditure cycles?
Yeah, there's no doubt the size and scale of this capital cycle is breathtaking. I've been in this business 35 years and I've seen a lot of these. This is probably my 5th or 6th cycle. So the numbers are pretty staggering. But the level of infrastructure that's required for this, migration and transformation to occur is, I think, also equally breathtaking. This is the first time in human history where everybody has to participate simultaneously, And of course, no cycle goes straight up. So there is more sort of, volatility as you continue to evolve. But if you're funded for the long haul and you certainly don't put an artificial time sequence to it, I think you'll get there quite successfully.
Okay, Vic, thank you very much for joining us. Vic Seth, CEO of Shares Holdings. Still to come on the show, we will have more on the look ahead to Jackson Hole with Pantheon Macroeconomics, Ian Shepherdson. That conversation is coming up for you after the break.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long. End users are using our AI even more frequently.
Are you heading into a record Q4? We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you. This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented. This Bank of England decision certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
China is the world's second largest consumer market behind the US. In 2025, the country's total retail sales of consumer goods exceeded about 50 trillion yuan, or about 7.2 trillion US dollars, up by 3.7% year-on-year. With a population of 1.4 billion people, the market has long been a cash cow for global brands. But today, success is no longer a given, with some Western brands struggling and even scaling back operations in the country.
When you think about live streaming and social media, the hottest new thing is going to bubble up overnight, and you have to have it the next day.
The number one thing that you will see is how little loyalty Chinese consumers are because of the brands and how fast they innovate and how quickly they push things out. Consumers are very used to being hit by new concepts, new designs.
So what does it take to win in China?
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
very warm welcome to the final hour on this Monday of Squawk Box Europe with Ben Boulos and myself, Steve Sedgwick, and these are your headlines. US futures dip as Nvidia results and Kevin Warsh's debut speech as Fed Chair at Jackson Hole loom large over the week, with both events set to dictate how markets trade for the rest of the year potentially.
Economic D-Day. U.S. Treasury Secretary Scott Bessent vows to impose tough sanctions on Iran and target any enabling countries ahead of a closely watched press conference later today. Going dollar for dollar, Canadian Prime Minister Mark Carney vows tariff retaliation as President Trump throws a fresh 50% levy on America's northern neighbour after trade talks collapse.
You know, a good headline makes you think about what was said, and I think it was a good headline, the first one. Not how I read it, but just the producer who wrote it. And it made me think, it said pretty much that Jackson Hole from Kevin Warsh and Nvidia will potentially dictate how the markets trade for the rest of the year. I think we might have over-egged it a little bit, because I think whilst they're important, they are just an update on the markers that we need, and we need a constant flow of knowledge on what happens. Look, with respect, what are we going to learn from Nvidia? What are we going to learn from Kevin Warsh? I tell you we're going to learn from Nvidia that the numbers are still great. They're not going to have rubbish numbers. There is no way that they're going to be rubbish numbers. But there might be something in the whisper that people wanted more. They might want to hear more from Nvidia, but you're going to see great numbers. You're going to see a man who, quite rightly, is very enthusiastic about AI and Nvidia's position in the ecosystem and in the financing of that as well. So nothing that Nvidia says or does is going to be that different. What might be different is how the market reacts. And it's the same with Kevin Warsh as well. You're going to see a man who is very confident in the growth of the US economy, who believes that the Federal Reserve is on the right path to contain inflation, and who has a limited concern about the long end of the bond market. If he had more of a concern, he'd be presumably acting as more of a steward of those yield increases that we've seen. So I agree with the headline in as much as these will be important factors. I perhaps disagree with it in the fact that this will dictate how we trade for the rest of the year.
I think one of the things that people will be looking for, you're right, Nvidia, it is going to come with strong numbers, everyone expects. I suppose what people will be looking for is by what bigger margin, by how much of a margin does it smash through expectations? Is it something like 14 quarters it's had on the trot of beating expectations? Not just reporting positive figures, but smashing expectations. So I suppose what people will be looking for is by how much this time have they exceeded expectations, which to me makes a mockery of expectations, because if they're expecting it to exceed expectations,
then
that's the new expectation.
Hence the whisper number as well.
Yeah.
I guess I would be most concerned about how much this is turning into a vendor financing company rather than a seller of GPUs.
Yeah. And I'm sure they'll be looking for the detail on that. They'll also be looking for the story on the demand as well, and whether that's holding up.
I think it will be holding up. I've got a sneaky feeling. Anyway, look, as we say, it may be August, but two events this week could shape how markets, as we say, perform for the rest of the year and into 2027. On Wednesday, it's the biggest corporate story of the week. Nvidia posts its earnings amid a flurry of concern over the sustainability of data center financing, the point we just made. The chip maker is increasingly stepping in to act as a backstop within the market, most recently partnering with 6 large asset managers on a $500 billion deal, which is designed to establish financing platforms for Nvidia's customers. Meanwhile, sources have told CNBC the company is playing matchmaker in the Nordics, seeking to connect companies with its GPUs to data center operators with available capacity. So Kevin Warsh's speech at Jackson Hole will be closely watched for clues on the Federal Reserve's interest rate path going forward. And it comes at a key time after the US Treasury intervened to buy more long-dated bonds amid pressure in the market, whilst America's national debt is only growing from the $40 trillion milestone it hit last week. To add to the country's fiscal difficulties, it has now launched what the Canadian Prime Minister Mark Carney calls a war against its northern neighbour. with the imposition of 50% tariffs, whilst President Trump threatens what he calls economic D-Day against Iran as the war America and Israel started against Iran is about to enter its 7th month, continuing to drive oil prices and inflation higher. Let's get to a wise voice on this. Ian Shepherdson, Chair and Editor-in-Chief at Pantheon Macroeconomics, joins us now from Montpellier, of all places. Ian, lovely to see you. Thank you very much indeed for joining us. Look, you heard me talking about Kevin Warsh. For a man who doesn't want to give too much commentary, we're going to be poring over every word he says on Friday. What are your thoughts?
I don't think he's going to say very much. I mean, I think people who are expecting some sort of definitive statement on what he really thinks, the real Kevin Warsh standing up, I think they're going to be disappointed. That's just not the way he's playing things. You know, this is a guy who hasn't given any dots on the forecasts, who wants to reduce the number of Fed meetings, who is outsourcing a large part of his job to 5 task forces. I mean, he's not going to say, you know, I think the next few months' numbers are going to be this, this, and this, and accordingly Fed policy is going to be that, that, and that. He's just not going to do it. He's going to play it very cagily. He's going to say he's watching the incoming data, and I'm pretty sure he's going to say we're determined to hold inflation down to the target. But beyond that, if you're looking for specifics, I think you're going to be disappointed.
There was an interesting comment in Claire Jones's piece in the Financial Times from Eric Rosengren, who, a former Boston Fed chap, of course, said that whilst Warsh could remain silent on future decisions, he needs to explain current ones. I think that's a very interesting distinction there, Ian.
Yeah, and I think that it's easy to explain why he hasn't come in and hiked in the way that a lot of people in markets expected. The fact is that the last couple of rounds of inflation numbers have been better than expected. Private payroll growth in the last 2 months has been 30k per month, and there's no real sign of it rebounding anytime soon. I don't think he needed to dive in and do something just to make some sort of statement to keep markets happy. Having said that, if those inflation numbers and payroll numbers had been very different, they would have hiked at the last meeting. I don't have a problem with that. But I don't think that he was under the sort of pressure that markets thought he was under to act immediately. I don't think it was wrong of him to choose to wait a little bit. I mean, there's some pretty good reasons for thinking that the worst is over for inflation. I mean, I think that headline core CPI and core PCE inflation have peaked. Wage growth is slowing. There's no pressure from rents. Yeah, there's some pass-through from goods prices. You know, everybody knows that input prices went up after the Iran war. The supply bottlenecks in some places. AI demand is driving up chip prices for sure. But goods are a relatively small part of the US inflation indexes. They're mostly rent and services. And so if there's a little pop in goods prices in the fall, I think they can ride through that, especially if the payroll numbers don't get any better, because 30k per month private payrolls is basically nothing. It says the cyclical economy is doing nothing.
Ian, if he doesn't need to do anything on the inflation front at the moment, and I'll follow you down the path on that one as well, does he need to do or say anything to soothe the longer end of the bond market, which is where all the attention is at the moment?
Well, what he needs to say, I think, is that the determination to keep inflation at the target, get inflation back to the target, is real, and that if the data tell him he needs to hike, then he will. I mean, I think he needs to convince people that he will do what he needs to do if the circumstances tell him he has to do something. But I think it's also perfectly fair to say that right now that case is actually quite weak. You may have seen the piece from the former Vice Chair Rich Clarida in the FT earlier this week, where he pointed out that the rate of growth of unit labor costs in the US is now very low because AI is boosting productivity growth and wage growth is slowing. And looking back over history, if you've got unit labor costs growing at less than 2%, the chance of inflation sustainably remaining above the target is actually pretty low. So why would you act in a panic to raise rates when there really is no reason to panic? Just because markets got themselves into a tiz in the earlier on in the summer doesn't mean that the Fed has to jump. I mean, it would be different if the data were bad, but the last couple of months have been actually pretty good on both the inflation and on the jobs front. So, I think that the case for doing nothing over the summer has been quite strong, and the case for doing nothing as we go into the fall is also quite strong. But Warsh needs to say, if that changes, I will act. That's what markets want to hear.
Yeah, and you talked about the market being in a tizzy, but is the market in a tizzy about whether the central bank is controlling or certainly shepherding inflation correctly? Or is the market in a tizzy about the concern about fiscal dominance and about these big deficits, which Mr. Bessent told CNBC at the tail end of last week we may well have seen peak already, and the trajectory back to a more balanced form of US financing? Is that what the market's in a tizzy in rather than inflation?
Well, there's some element of truth in that. There's no question this administration has zero credibility on the fiscal front. The deficit was coming down in 2025. They blew it apart with the OBBA spending and tax cuts. So no one's taken it very seriously on that front. And of course, there is excess demand now, or increased demand for the global pool of savings from the AI build-out. As Chair Bernanke used to say back in the day, we have a global glut of savings. Well, now we have the opposite. We have a global shortfall of savings, and so long yields are rising everywhere. But part of this is a good thing. Productivity growth in the US has been astonishingly strong in the last few years. It's probably trending above 2%. Real yields are going to be quite high in that environment, but that's not a bad thing. The bad thing is the lack of fiscal control on the policy side from the US, and that's not going to change anytime soon. But you got to think about this from the perspective of an investor. You're going to get paid your nominal coupon for your Treasury debt. If you buy a Treasury bond to finance that enormous budget deficit, you are going to receive your interest payment. What matters to you then is the real value of that interest payment, which means we're back to inflation. So people talk about the deficit as though that was the be-all and end-all, but if inflation is credibly believed to be coming under control, then my guess is that yields will come back down, even with the deficit remaining very stubborn. I don't really care what Bessent says about the deficit today, because he doesn't control the purse strings, and Congress is not going to do anything about the budget for the foreseeable future. So we are stuck with these big deficits. The revenue side should improve because growth ought to be okay next year, but the idea we're going to go back to anything that we used to think about as a reasonable deficit, that's just not happening. But I think that's less important than the market believing and seeing the inflation numbers coming back under control. That's really what it's about.
Ian, it feels like this week could be, almost akin to, the setting of a medieval royal court where you've got two favourites, two appointees having key moments. And you've got the Fed chair appointed by Trump, Kevin Warsh, whose idea has been you can bring inflation under control without hiking the Fed's interest rates by just letting the markets do their thing. The rise in Treasury yields will have the effect of tightening without the Fed actually having to move and risk upsetting President Trump. On the other hand, you've got the intervention from the Treasury Secretary Scott Bessent, also a Trump appointee, to bring down the higher yields, which potentially undoes what Kevin Warsh was hoping for. One of the two has to give, don't they? How do you see that playing out in terms of bringing inflation under control?
Yeah, so these are two people who have a credibility problem. There's no question about that. Kevin Warsh, I remember back in 2008, after Lehman went bust and the world economy is imploding, Kevin Warsh is still talking about upside inflation risk. So, he does have some past form that markets are right to be skeptical about. And of course, Bessent was promising a year ago that he'd be bringing the deficit down and growth would be gangbusters and all the rest of it. So no one takes him very seriously on these questions either. The way to square the circle is for inflation to come down. I'm pretty hopeful, and I think there's some very good reasons for expecting a run of decent numbers to continue through the fall. But of course, Kevin Warsh has to pour some oil on these sort of choppy waters this week, and the way that he does that, I think, is by promising, whether his fingers are crossed behind his back or not, promising that he'll do whatever is necessary to deal with inflation. But there's no question that he hasn't started brilliantly on the communications front. I think markets were collectively rolling their eyes at the idea of these task forces doing the work for him, and there's certainly some skepticism from his historical record. And the fact is that he was appointed by President Trump, who also doesn't have a great deal of credibility on fiscal and monetary issues. So there's a degree of suspicion there. Kevin Warsh has been fortunate so far that the numbers have very much gone his way, and that seems to have vindicated his position of doing nothing, despite 3 dissents at the last FOMC meeting. And I think he's going to remain lucky. Maybe he's going to be, as Napoleon said, he wants lucky generals. I mean, maybe he's going to be Trump's lucky general, and he's not going to have to do anything. And in fact, that is my base case. I'm very much of the view that Warsh does have some credibility problems, but I'm also firmly of the view that the data are likely to go his way, so that he doesn't have to do anything, and that the markets will come round to the idea that actually we've been fretting about inflation risk too much, and that the outlook has improved. When I look at the big US inflation picture now, I see wage growth of just over 3%, productivity growth of 2%, no rent inflation. I see some profit margins maybe coming under pressure for retailers because consumer spending is slowing down. June, July retail consumer picture to me looks pretty soft. Maybe Warsh is going to get what he wants without having to do anything. I think that's a reasonable base case forecast, and you can hold that thought in your head at the same time that you hold the thought in your head that you don't really trust him very much. It doesn't matter because the data will eventually determine where yields go.
Looking at this, Ian, there are some things that are within the gift of the politicians to deal with, trying to negotiate an end to the Iran war, bringing down the oil price as a result, easing inflation fears through that way, coming up with a credible plan to reduce the deficit. All of that would ease the premium, the jump we've seen in yields and borrowing costs and the knock-on effect that has for people taking out mortgages and car loans and so on. But in the absence of that, are they not then much more at the mercy of how much corporate debt is issued by the AI players? Because as long as investors have that as an option, that is going to act as a source of gravity, pulling capital away from the treasuries and into this very exciting space where people see potentially very handsome returns.
Yeah, for sure. That's an element in the story for treasuries that I think really wasn't anticipated and certainly wasn't fully appreciated until quite recently. But this wave of private debt issuance, of what looks like very high quality private debt issuance, so it might not look that way in a year's time, who knows? But as of right now, there is significant competition for that global pool of savings, and that's undoubtedly had some impact on the treasury market. What we'll find out over the next few months, I think, is how big that impact has been relative to the impact of the inflation uncertainty and the inflation fear. I mean, you don't have to go back very far. Just go back to May, June to see people tapping away frantically about how terrible the inflation numbers were going to be over the next few months, and lo and behold, they weren't. My guess is that they'll continue to be significantly better than people were expecting just a couple of months ago. That ought to bring yields down in a meaningful way over the next few months. If that doesn't happen, so if we get good inflation numbers, weak payroll numbers, and yields remain close to where they are now, then that will be telling you that the bigger story is the demand from the hyperscalers. I got to say, I'll be surprised if we get to the end of the year and we're still stuck with yields at current levels. I'm really, looking back over markets over many decades, it seems to me that the inflation picture is usually the dominant factor. And people talk about other things being important, and sometimes other things do matter. But fundamentally, it's about the real value of the interest payment that you get from the US Treasury, because you're going to get it. You're going to get the nominal payment. So what matters to you is the real value of that payment. And that's really about the inflation picture. So, AI is a gigantic distraction. It's part of the story. And I think we are probably moving into a world of sustainably higher real yields on the back of stronger productivity growth. That's a good thing, not a bad thing. But it does require a degree of adjustment. And it does mean, as you mentioned, there's a lot of people who maybe would like to move home now but don't really fancy taking out a mortgage at 6.75% when their current mortgage on the house they're currently living in is probably something they refied during the COVID pandemic to 4% or 3.5%. That's why the housing market is so weak. That gap is enormous and very difficult to overcome. So, I think housing is kind of stuck almost no matter what. But I do think there is room for yields to decline over the next few months, even with the hyperscalers gobbling up all this capital.
Okay, Ian, thank you very much for your thoughts. Ian Shepherdson, Chairman and Editor-in-Chief at Pantheon Macroeconomics. And don't miss our comprehensive coverage of that conference being at Jackson Hole, the annual gathering of the Fed. That starts on Wednesday. Coming up on the show, could AI backlash ruin the Anthropic IPO party? We'll look at the risks ahead of the AI startup's hotly anticipated stock market debut.
You can master your strategy, but performance could be limited by your instrument. Precision trading starts with the right instrument. Over the past 3 years, Interactive Brokers clients outperformed the S&P 500 on average. Like returns, trading costs compound. Interactive Brokers is built to lower costs through smarter execution. Access stocks, options, prediction markets, and more across 170 plus global markets. The best informed investors choose Interactive Brokers.
Power Lunch, streaming on CNBC Plus.
There were definitely a few times when there was no money in the bank.
Before Careem became one of the defining startup stories of the Middle East, Mudassir Sheikha was trying to keep it alive from one funding round to the next. He'd left a safe consulting job, and he and his co-founder had each invested $50,000 US of their own money into the company. In the early days, Careem wasn't an app that magically matched riders and drivers. It was the founders calling drivers themselves in the early hours of the morning.
It was radically basic. All we had was a website.
And 7 years later, Uber, the rival Careem spent years fighting, agreed to buy the company in a landmark deal for the region.
To do a deal with our biggest rival, the company that we thought was trying to kill us, was just very, very difficult for the organization.
California has cancelled talks with Paramount over a settlement to halt the state's lawsuit against its merger with Warner Bros. Discovery. The state's Attorney General, Rob Bonta, called off the meeting as he accused Paramount of acting in bad faith, telling the New York Times the company had leaked details of a previous meeting between the state and the media giant. Anthropic's IPO prospectus will list, quote, negative sentiment towards AI and data centers as a risk factor, according to sources. The document's expected to land in the coming weeks and comes at a time when an increasing number of Americans are worried about artificial intelligence and are loudly opposing new data centers.
Meta is facing a federal trial against the states of California, Colorado, Kentucky, and New Jersey. And a lot of other states are involved as well. They accuse the social media giant of intentionally causing harm to children. In her opening remarks in the trial last week, California's Deputy Attorney General, Megan O'Neill, said Meta's business model could be summarized in 4 words, beginning with H: hook, hold, harvest, and hide. Let's get to Miriam Boughton, who is a professor of law and economics at the University of St. Gallen. Miriam, thank you so much for joining us today. Look, how important is this trial? There is a lot of us who are aware it's going on, but some are saying, look, this is potentially a multi-trillion-dollar, or certainly over $1 trillion cost for Meta and the industry, and is comparable to tobacco trials in the 1990s. Just put it in context for us, Miriam.
Good morning. Thank you for having me. Well, yes and no. It is a tobacco moment. On the one hand, this is really changing how we view platforms. For 25 years, Section 230 has focused on platforms as a space for free expression. And now litigation is focusing on platforms as businesses that design their service and that cause harm through how they design their interfaces and their algorithms.
So is it an existential threat to Meta and other players in the industry?
Well, the number of, what is it, 140 trillion that Meta has mentioned is not the number that the state has mentioned. They are talking 200 billion. And what we see in Europe also in terms of fines is much lower. But nevertheless, if this goes through, then it could really change how platforms' business model works. Not just Meta's, but other platforms as well. Because these business models, they are focused on keeping users hooked, because the longer they spend on the platform, the more advertising the platform can show.
Yeah, so you have the remedy and you have the fine as well. We've talked a little bit about the fine, but what about the remedy? Is the remedy, going back to my word, existential? Is it that kind of threat to the business model going forward rather than worrying about the initial fine?
Well, yeah, the fine is one thing only. We've seen that in Europe. It doesn't really make much of a difference. It almost becomes a cost of doing business. But the remedy here is Well, if it's existential, we'll have to see that. In any case, what it means is that when it comes to children, platforms cannot follow their playbook of keep them engaged as long as possible anymore. And this is already happening, right? The New Mexico case already forced platforms to, for example, stop setting notifications to children at night. And now what's being asked goes further. And so that means that we might see less use by children, and that will cut directly into Meta's business model.
Combined with the fact that a lot of countries and states, I believe as well, around the world are looking at social media bans for children, for people under the age of 16 or under the age of 17 in some cases as well. Again, remedies plus statewide or countrywide bans as well. Are we going to see a very different kind of social media going forward?
That could be the case. I mean, first see, then believe, because Europe has tried to get this done for a couple of years now with the Digital Services Act, and we see pushback on every single point where it really comes to changing the business model, right? The fines, as I said, are one thing, but here the platforms really push back on how far the design change then really has to go. And so this, I think, will be the key thing to watch. Is it just going to be a few little tweaks, or is it going to be fundamentally different interfaces, default settings, and so on? That's what's going to make the difference of how children are going to be using social media for the next couple of years once these rulings come through.
Do you think if these cases in the US succeed and the rulings go against these social media platforms, we're likely to see a whole cascade of similar lawsuits brought on this side of the Atlantic in Europe?
Well, things work very differently here. I do think we are going to, it's just the beginning of lawsuits in the US, but here in Europe we don't have punitive damages. We don't have the kind of setting that we have in the US. So it's a very different set of instruments here, because here is primarily through the Digital Services Act, really a regulatory instrument. But the underlying concern is exactly the same, and what's being targeted is exactly the same. So in July, the Commission also had preliminary findings against Meta for the addictive design features, the infinite scroll, the push notifications. So it goes in the same direction when it comes to what they want changed, but the mechanism is very different.
It's not a complete linear path against the social media companies, is it? Because just last week, I think, or the week before, France's top court struck down the proposed social media ban for under 15s, saying that it hampered freedom of expression. So it feels like it's very nuanced, and it's sort of one step forward, one step back in terms of this pushback against the onslaught of social media and its impact in young people's lives.
Absolutely. I mean, this has been from the start sort of a battle between allowing freedom of expression on platforms, but also preventing harm on platforms. And this will continue to be a trade-off. When it comes to the bans against young people, this is a very contested issue, because evidence shows that it doesn't really work as well. Australia has tried it, other countries are trying it. At the same time, maybe it is a signal also, right, that we might treat it similar to alcohol, to gambling, that it's just something that's not appropriate for younger people. So the last word has not been said on these bans and how we can make them work best.
Indeed, it is a fascinating place, and thank you so much for your expertise, Miriam. Nice to speak to you today. Miriam Balton, who is Professor of Law and Economics at the University of St. Gallen. Moving on, coming up on the show, the US prepares to announce fresh sanctions on Iran, pledging economic D-Day. Dan will have the latest.
A market shaping industries. We are watching the sixth little dragon, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you.
From the markets to the courts, kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell, weekdays streaming on CNBC Plus.
Very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. US futures dip as Nvidia results and Kevin Warsh's debut speech as Fed Chair at Jackson Hole loom large over the week ahead, with both events set to dictate how markets trade for the rest of the year, or certainly for the short term. Economic D-Day, US Treasury Secretary Scott Bessent vows to impose tough sanctions on Iran and target any enabling countries ahead of a closely watched press conference later today. Plus, going dollar for dollar, Canadian Prime Minister Mark Carney vows tariff retaliation, with the US president throwing a fresh 50% levy on its northern neighbor after trade talks collapse.
The US is set to unveil fresh sanctions on Iran today in what Washington has framed as economic D-Day. The Secretary of Iran's Supreme National Security Council is threatening to halt oil exports from the Gulf in response. In a Financial Times op-ed, US Treasury Secretary Scott Bessent cautioned countries against appeasing Tehran, warning, quote, any nation that serves as a financial artery of a withering regime should expect to share in its isolation. Dan joins us now. Dan, a quick glance at WTO figures show that if there were a financial artery for Iran, its biggest trading partner is China. This is quite the upping of the ante.
That's right, Ben, and we're expecting more details to come when the Treasury Secretary Scott Bessent addresses media later today for insights on exactly what type of measures that the US is going to be leveling towards Tehran. And in an op-ed for the Financial Times, Bessent is calling this the single greatest financial offensive ever marshaled against an adversary. We don't have full details on what is likely to come, but he says the US is now entering the end game with Iran, and the objective here is to sever every economic lifeline that sustains the tyrannical regime, as he called it, until Tehran stands alone. Now, this campaign is also aimed at the countries, banks, and companies that keep Iran connected to the global economy. Bessent, in this Financial Times piece, said, Iran's enablers purchase and transport its petroleum. They facilitate the flow of its finances through exchange houses and free trade zones, and they welcome Iran's flights and maintain registries on its behalf. They turn a blind eye, he says, to seaborne fuel transfers and the illicit use of their banks, all while concealing the extent of their complicity. And as we've been discussing today, that really does offer a preview of what Treasury could announce later today. It's likely going to be a fresh round of sanctions on foreign oil buyers, on banks, on shipping companies and other intermediaries, targeting countries like China, for example, which has long been in the US crosshairs regarding its financial and economic ties to Tehran. And of course, what we have seen from China as well is significant support on the oil side too. China historically has been the largest buyer of Iranian oil. So we're watching and waiting to see what comes of that. But it's also fair to say that beyond China, Washington could also expand secondary sanctions here, forcing foreign institutions beyond China to choose between trading with Iran or accessing the US financial system. Last week, of course, the UAE halted all trade and commercial exchanges and financial transactions with Iran. Abu Dhabi saying that suspension will remain in place until further notice, but here they haven't necessarily offered much detail on how that's going to work in practice. The UAE is also an important player here. Dubai in particular has really been a vital trading gateway for Iran for many decades now. And then for its part, Tehran has responded with a threat to global oil supply. Iran's national security chief Mohsen Reza also weighing in response to this FT op-ed, saying if the economic war continues, not a single drop of oil will be exported, neither through the Strait of Hormuz nor from anywhere in the Persian Gulf. Iran, he says, will regard any country's participation in or support for America's economic war against the Iranian people as an act of war. So again, details light at this stage, but the US is promising the harshest sanctions ever to be leveled against Iran to be announced later today. And as you say, oil markets selling off in anticipation of this. Curiously, of course, we are watching and waiting for those details to be announced to understand the full extent of what the US has in store for this regime. Back over to you.
Okay, Dan, thank you very much for the update. Let's see how all this is playing out in European equity markets. And this is the picture on the key regional benchmarks. A slightly improving picture on when we last checked in on them. 2 of the 4 there in negative territory, but only just pairing some of the losses that we saw earlier. FTSE 100 most decisively above the flat line. 1/10 of 1% higher, the Italian market flat. Let's see where the gains are to be found sector-wise. And travel and leisure, the big outperformer this morning, 0.9% higher. Basic resources not far behind. Media stocks advancing this morning as well, just shy of 0.75%. And household goods also by a similar amount. In terms of losses, this is where the drag is coming from on the Pan-European Stock 600. Oil and gas stocks down about 0.2%. They have tracked the oil price lower. I should say, although oil is down in the session, it has pared some of the losses as the morning has worn on, and Brent crude is now back above $93 a barrel. Car makers and parts on the back foot this morning, 0.5% lower. Some of the big European car maker names among the sharpest fallers on the Pan-European Stock 600, likes of Stellantis and Volkswagen to be found towards the bottom of the fallers. We've also got healthcare stocks retreating and tech as well, giving up 0.2%. Plenty for markets to be digesting stateside, as we've been discussing. Nvidia's results later in the week, the Fed meeting at Jackson Hole. We've also got the latest PCE inflation data out, giving us the Fed's preferred measure on average price rises. Again, a bit of a mixed picture there, but an improving one as we approach the Wall Street Open. The Dow now being pulled just slightly above the flat line. Not by much, but at least there's some green on the board there. The other 2 benchmarks, though, stubbornly being called in the red. Steve.
The latest asset allocation report from Tiger 21, a learning network for ultra-high net worth individuals, has shown a record amount of members' capital flowing into private equity. Allocation to public equities also rose to its highest level in over 2 years. Michael W. Sonnenfeld is founder and chairman of Tiger 21 and joins us now. Michael, they are falling in love and falling over themselves to have record-size allocation to the private sector or to private equity. Is there a timing issue here? Is this the right time to be falling over yourself to get into private equity?
Well, it's a great question, and you'd have to say, who are we talking about? These are entrepreneurs, not simply people of a level of wealth. We have 2,000 entrepreneurs who have mostly had liquidity events across the globe and managing about $280 billion across our 2,000 members. So it's difficult to say, other than that these people have been some of the best performers over their entire career And yet you'd have to wonder, with 34% in private equity, it's not only high, but over a 20-year period, it's up from close to 10%. Nothing has had as big a change across our portfolios as the increase in private equity.
Yeah, look, don't get me wrong. These are clearly brilliant and smart entrepreneurs you mentioned, but just individuals generally to get to that high net worth asset moniker. But the fact is, the industry itself, the private equity industry itself, is sitting on thousands and thousands of companies it can't get rid of. It has got an enormous backlog, somewhere in the region of $4 trillion worth of companies. I guess the point I'm making is all these brilliant entrepreneurs who are getting into private equity like they've never got into it before, at a time when the industry itself is struggling to have sales either in public markets or elsewhere.
Yeah, actually, another way to look at it is our cash levels are the lowest in our 20-year recorded history at 7%. And perhaps that's the canary in the coal mine that should be really giving people some cause for concern, or at least wondering what it means. Cash has traditionally been about 12%. And one way to understand that is our members live on about 2% of their assets on average, and 12% was about 6 years of living expenses, so you could weather any kind of storm. At 7%, one of the reasons it's so low is just for the reason you're talking about, is distributions have diminished in the private equity. So some of the reason private equity has gone up is because distributions have slowed. But the other reason is that many of our members have sold companies in the last few years. And unlike in the past, when you sold a company and got a check for cash, if it was a strategic buyer, today, if you're selling to private equity, they're asking you to roll some of the equity, and that would be bouncing it. But any way you calculate it, when you have such extremes, private equity at 34% and cash down at 7%, you'd have to wonder, given that cash hasn't been that low since the great financial crisis, are the numbers telling you something?
Yeah, that's exactly my point. I was going to come back to 2007. People, what is it? Is it Mark Twain? I think history doesn't repeat itself, but it certainly does rhyme. Michael, your opinion, that's what I want to know, because you've done this for a while. Do you think that history is going to rhyme in this case?
What I know is anytime people have too little cash, it forces them to do things that are not optimal, like liquidating at discounts. There's an old measure of stock markets long-term return is about 8 or 9%, but the average individual only gets 4 or 5%. And the reason is they buy at the wrong time and sell at the wrong time. And the less cash you have, the more likely it is you're going to be forced to sell something at the wrong time.
Michael, we saw a stonking jump in Bitcoin last week, up 20%. How much interest is there from your clients and investors in that as an asset class?
So Bitcoin and gold have traditionally been 1 to 3% assets. And at times, obviously, gold has had an extraordinary run, but we have many members who are really believers that Bitcoin is an asset for troubled times, and we sure are in troubled times. When you have $280 billion of member assets and you have 2% in Bitcoin, you're already talking about $5 billion. What that means is some of our members are like 20, 30, 40%. You might call that all in, while others still don't believe in it. They're more like Warren Buffett, who never bought gold, as an example, because he didn't think it was a productive asset. But if you own gold in the last 5 years, and even Bitcoin, I think for the last 10 years, with the exception of the last year, was the top performing asset. So if you're looking for safe havens, one might play Bitcoin, one might play gold. But we have a lot of Bitcoin devotees, and you can see what's happened just in recent days.
Just looking at the latest key figures from your update, increase in private equity, increase in public equities, crypto flat, fixed income flat. Where are they pulling back from then?
Well, you'll see that on a relative basis, real estate, which had been king for literally 20 years, for 18 years, real estate was our number one asset, and it first fell below private equity, and now it's fallen below public equity. That's a real question. What's going on? Sometimes the numbers speak for themselves. Sometimes they are telling a story, but certainly there's something extraordinary going on where people who have made their money in private equity and real estate all of a sudden are favoring private equity dramatically over real estate. One simple reason is that 10 or 15 years ago, most of our members had made their wealth in real estate, and so they were familiar to buy it again after they had their liquidity event. But I'd say in recent years, a higher portion of our members have built great companies and sold those businesses and ended up holding pieces of the business they sold when they had to roll over the equity. So the fact that more of our wealth came from private equity doesn't surprise me that we have higher private equity holdings, but it is a remarkable shift from real estate, which has been on top, to private equity today.
Okay, Michael, thank you very much. Michael W. Sonnenfeld, founder and chairman of Tiger 21. Thank you for being with us right through to this point in the programme. And don't go away just yet, because still to come, NVIDIA results and Kevin Warsh's debut speech as Fed Chair at Jackson Hole loom large over the week, with both events potentially dictating how markets trade for the short term.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently.
Are you heading into a record Q4? We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented. This Bank of England decision has certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giammatteo, only on CNBC.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
If you're watching CNBC, it's because you want to get an edge. You want to get ahead. It's our job to deliver that. My ambition is just to be the best that we can possibly be. More often than not, I kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I've been thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
Welcome back. Canada has vowed to retaliate against the US dollar for dollar. I presume that's US dollar for dollar rather than Canadian dollar for dollar. Anyway, after Washington imposed a 50% tariff on $20 billion worth of Canadian imports on Saturday, with new duties hitting a range of key products, including wine, dairy, cement, clothing, and hockey sticks. The tit-for-tat response came after days of intense negotiations between the two countries broke down on Friday, with the Canadian Prime Minister Mark Carney recalling his negotiators back to Ottawa, describing the US demands as unacceptable. Speaking on Saturday, Carney said the retaliation was taken in the best interests of Canada.
We cannot
accept what they've offered, and we will not give what they've asked. Let me be clear. We take this step reluctantly. Reluctantly because we recognize that some of these measures will raise costs and reduce choice for Canadians. Reluctantly because we recognize that some U.S. companies and some U.S. states are innocent bystanders in a dispute that they did not want. Reluctantly because this trade dispute is preventing Canada and America from doing so much good that we could do together. But at the same time, we take this step confident that it is in the best interest of Canada.
I think what hasn't played out well for, and by the way, we're speaking to Jameson Greer later on, 1:10 BST. What hasn't played out well is this, the optics for many Canadians is that Carney has rolled over a little bit in a lot of these negotiations so far in 2026, and from the opposition and from some of the regional leaders as well, there has been some quite marked criticism. So actually Carney politically, domestically, can't afford to roll over as well and be seen to be a soft touch as well. So I think that's played out in this final phase as well. Final phase, I mean, who knows whether these tit-for-tat tariffs, a lot of alliteration going on there, will actually come through. But at the moment, Carney just showing a little bit more resolve versus US in terms of negotiation. But I'm really interested to hear what Jameson Greer has to say.
President Trump has disclosed more than 1,000 financial transactions from his portfolio in June, which saw him sell the likes of Meta and Motorola while buying shares in Berkshire Hathaway, Visa and MasterCard. In what looks like a reshuffling of his holdings, the transactions totaled just above $250 million, disclosing a range for the transactions rather than a specific figure. The AI startup Hugging Face is reportedly exploring a sale that could value the firm at $13 billion or more. That's according to Business Insider, which said the firm that was at the centre of a security incident involving an OpenAI model last month has been working with banks to gauge interest from bidders. NVIDIA customers have been told the price of servers that contain AI chips are set to increase by more than 15%, in most part due to rising memory costs. This is according to Bloomberg, which said the raise will affect NVIDIA's flagship Vera, Rubin and Grace Blackwell chips, with the increase depending on the generation of chips alongside the amount of memory they have. It might be August, but two events happening this week could shape how markets perform potentially for the rest of the year and into 2027. On Wednesday is the biggest corporate story of the week. NVIDIA will post its earnings amid a flurry of concern over the sustainability of data center financing. The chipmaker's increasingly stepping in to act as a backstop within the market, most recently partnering with 6 large asset managers on a $500 billion deal designed to establish financing platforms for NVIDIA's customers. Meanwhile, sources have told CNBC the company is playing matchmaker in the Nordics, seeking to connect companies with its GPUs to data center operators with available
people
capacity.
Not aware that a data center operator is not aware that they've got GPUs available? It's like, why do you need them to be match? I don't understand. What bit? I've got a data center. I'm in the Nordics. I didn't think about GPUs from NVIDIA.
Well, they must see a disconnect, otherwise they wouldn't be doing it.
No, I know. I hear the story. I just don't know why anyone in their right mind wouldn't be thinking about NVIDIA GPUs, at least as one of the options.
They might not have heard of NVIDIA. Anyway, the other big story.
Exactly my point, Ben. Thank you. I hope you were doing that deadpan. I'm sure you were.
Deadpan, as always. Kevin Warsh's speech at Jackson Hole will be closely watched for clues on the Federal Reserve's interest rate path going forward. And it comes at a key time after the US Treasury intervened to buy more long-dated bonds amid pressure in the market, while America's national debt is only going one way. It's growing from the $40 trillion milestone that it hit last week. To add to the country's fiscal difficulties, it's now launched what Canadian Prime Minister Mark Carney calls a war against its northern neighbour, with the imposition of 50% tariffs, while President Trump threatens what he calls economic D-Day against Iran, as the war America and Israel started against Iran is about to enter its 7th month and continuing to drive oil prices and inflation higher. So, plenty there for markets to digest this week, including the latest PCE inflation print for personal consumption expenditures index, the Fed's preferred measure, and a sign, I suppose, that maybe any honeymoon period already, any patience that President Trump had with the new Fed chairman isn't endless. You know, the pressure's on at this debut speech at Jackson Hole. Let's see what he has to say.
Well, look, as ever, a good headline, as I said earlier on, gets you thinking about whether it's a good headline or not, whether you agree or disagree. And I kind of like, our headline was, these are the big events. Yeah, Nvidia plus Jackson Hole, Kevin Warsh. There's no doubt about it, they are the big events. But I think we might be trying to extract too much juice about what we're going to learn from them. As I said earlier on the show, Nvidia, Jensen Huang, is at the peak of their powers. They are acting as the vendor financer for a lot of these data centers and people looking to grow exponentially their AI offering, and he's going to paint a very rosy picture. It is inconceivable that the numbers aren't going to be very strong, and it is inconceivable that he is going to say anything other than, I see great strength ahead, and I see the investment cycle really paying back a good return on capital. Inconceivable that we're going to get differently from them. And from Kevin Warsh, what are we going to get? A man who has not put in a dot in the dot plot and a man who doesn't want to give too much forward guidance isn't suddenly going to say, ta-da, here's my forward guidance and here's my dot and this is what I'm going to do going forward. So they are enormous events. I just think we've got to be a little bit careful in hoping to extract too much juice from both Nvidia and Jackson Hole.
I wonder if the significance rides on how much time will be given for journalist questions afterwards and how searching and how forensic those questions are going to be. If they ask the Fed chair what he makes of the Treasury's buyback moves, what he thinks about President Trump's assertion that interest rates are being kept artificially high, perhaps we'll get more insight from that than from the set-piece speeches. We can just watch and wait, but that is it for today's show. I'm Ben Boulos with Steve Sedgwick. Morning Call is up next. Have a great day.
One hour of added insight every morning doesn't just add up, it compounds. One extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC. Breaking news, market moves. Scott Wapner from the NYSE, Closing Bell. Weekdays streaming on CNBC Plus.
Don't miss the highlights of the PGA Tour. Catch the action from the PGA. The biggest hits and misses. Join us on the green, Saturday and Sunday afternoons, only on CNBC.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
Coming up on the Tech Download.
What keeps you awake at night? Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giamatteo, only on CNBC.
For
For this edition of the CNBC Conversation, I'm joined here in Milan, Italy by the Prada Group CEO, Andrea Guerra.
There is fashion waves, there is political waves, but then there is reality. The reality says that younger generation are looking at you, not just to what you say, but how you behave. The way you are behaving in the society, you are behaving with your own people and suppliers and stakeholders, and how you are behaving towards the planet are the three things that are part of our inner mission. So we are here to allow everything inside our group to be connected smoothly and positively towards planet, society, and our own people.
Prada Group CEO Andrea Guerra sits down for the CNBC Conversation.
Tensions rise, NASDAQ futures sink. I'm Dominic Chu, and this is your morning call. Good morning, I'm Dominic Chu for Morgan Brennan, checking U.S. equity futures right now after the S&P and NASDAQ snapped 3-week winning streaks last week. And right now we're relatively stable, relatively flat. The Dow's implied higher by a modest 11 points. The S&P down by about 18, but the NASDAQ trade down by about 168 points. That tech trade we'll focus on a little more in just a bit. Taking a look at treasuries right now, interest rates a key focus on this big week ahead for the Fed and Jackson Hole. Right now, the benchmark 10-year note yield drifting slightly lower to just a hair below 4.71%. The 2-year note yield 4.221%, and the 30-year long bond, you can see right there, 5.248%. A look at the value of the U.S. dollar. Take a look at those because we have been seeing a little bit of movement here with regard to the dollar. It's up 0.25% right now, but you can see over the course of the past week, we've seen a decline in the value of the greenback against major trading partners right now. Checking cryptocurrencies, with Bitcoin working to push towards the $80,000 mark. Right now, those prices down fractionally, about 0.4% lower to $77,064. Ethereum prices $2,456, and then Solana at $94.04. Energy also, as we await those new economic sanctions on Iran by the U.S. We'll have more on that story in just a moment. But meanwhile, oil prices for benchmark U.S. West Texas Intermediate, $84.97, off 2.5%. ICE Brent crude futures, the world gauge, off about 1.5% to $92.82. Now to our top story and the collapse in trade talks between the U.S. and Canada. The U.S. imposing 50% tariffs on some Canadian products on Saturday after the talks fell apart late Friday. This after negotiators for both sides had been working on a deal all last week, at times signaling that an agreement was possibly near. Now, the lack of an agreement impacts roughly $20 billion in Canadian exports. That includes wine, furniture, dairy products, cement, clothing, fishing rods, and even hockey equipment as well. In response, Canada said it would impose its own retaliatory tariffs beginning on September 8th. Canadian Prime Minister Mark Carney speaking on that decision on Saturday.
We take this step reluctantly. Reluctantly because we recognize that some of these measures will raise costs and reduce choice for Canadians. Reluctantly because we recognize that some U.S. companies and some U.S. states are innocent bystanders in a dispute that they did not want. Reluctantly because this trade dispute is preventing Canada and America from doing so much good that we could do together.
Now, Carney added that additional details on those new measures would be released in the coming days, previously noting that the retaliatory measures would be dollar for dollar. Speaking on Saturday, U.S. Trade Representative Jamieson Greer said that there are no new planned talks with Canada. Now, turning to the latest in the war with Iran, investors awaiting what Washington is calling the toughest ever sanctions against Tehran. Treasury Secretary Scott Bessent is set to unveil a new package of sanctions against that country later on today, dubbing it economic D-Day, quote unquote. Ahead of that move, Tehran dismissed the threat of intensified economic pressure. Well, Dan Murphy is, of course, tracking all the latest in the Middle East in Abu Dhabi, and Eunice Yoon is following how China is positioning itself as a possible peacemaker with Iran ahead of those sanctions. And Dan, we're going to begin with you.
John, good morning. Well, the countdown is on, and in the coming hours, we're going to learn just how far the administration is willing to go to wage economic warfare on the Iranian regime. Oil prices are selling into the news this morning, as you've just flagged, because details are still thin, but we understand the White House has prepared what it's calling the toughest ever sanctions campaign against Iran, and the fallout could extend well beyond Tehran. In a blistering op-ed for the Financial Times this morning, Treasury Secretary Scott Bessent not holding back. He calls it the single greatest financial offensive ever marshaled against an adversary. He says the US is entering the end game with the objective here to sever every economic lifeline that sustains the tyrannical regime, he says, until Tehran stands alone. Now, that offers a preview of what Treasury could announce later today, likely a fresh round of sanctions on foreign oil buyers, on banks, on shipping companies, and other intermediaries. We could also see expanded secondary sanctions here that would force foreign entities to choose between trading with Iran or accessing the US financial system. That's Washington basically saying, Dom, you're either with us or against us. Now, China, which is historically the largest buyer of Iranian oil, is likely to be a central target here. And just last week, the UAE already halted all trade, commercial exchanges, and financial transactions with Iran. Abu Dhabi offering no detail on how that suspension would work, but the UAE, and Dubai in particular, has long been a vital trading gateway for Iran. So, Don, we're expecting to learn more once those measures are announced. All eyes on exactly what the Treasury Secretary has to say later today.
Dan, as we await those comments and those details, can you take us through just how much the Iranian regime, as we know it right now, will actually respond to this? They've been under sanctions for decades at this point now. How much more needs to be done for them to actually change their behavior?
Well, Dom, Tehran is really responding with a threat of its own this morning. Actually, Iran's national security chief, Mohsen Rezai, says if the economic war continues, not a single drop of oil will be exported, neither through the Strait of Hormuz nor from anywhere in the Persian Gulf. Iran is also saying this morning that it's going to regard any country's participation in or support for America's war against the Iranian people as an act of war. So that warning could mean disrupting oil shipments across the Gulf or renewed attacks on regional energy infrastructure. Tehran's response is going to be very closely watched. But again, what type of impact this could actually have on the regime is also going to be very closely watched, and whether or not these measures announced by the United States will go far enough to change the tone from Tehran. It's back to you.
All right, Dan Murphy in Abu Dhabi with the latest there on the Iranian side. Now let's turn from Tehran to Beijing with Eunice Yoon with more on how China is positioning itself as a possible peacemaker with Iran ahead of those new U.S. sanctions. Eunice.
That's right, Dom. Well, Beijing is attempting to present itself as the alter ego to Washington. In an unusual move on Sunday, the Chinese Foreign Ministry posted a statement about a meeting a week ago between Chinese and Iranian officials, where the Chinese side was quoted as saying that Beijing is actively committed to promoting peace talks to resolve the Iran war. Now, the goal is likely to portray China as a responsible global actor and also possibly to forestall potential U.S. action against itself. Bessent has indicated that the pressure campaign would not only target Iran, but also countries that support Iran. And China, as Dan had mentioned, is the biggest consumer of Iranian oil exports and also a very important trading partner for Iran. Now, the backdrop to China's position is that the economy here has not been as poorly impacted as one might think by the Iran war or by the turmoil in the Strait of Hormuz. In fact, just today, Chinese oil refiner Sinopec announced half-year profits up 19%. That's despite the war due to stronger pricing and bigger sales. Now, we don't know if Secretary Bessent is going to be announcing any specific measures that would target China, but there is an expectation, Dom, that if China is targeted, it does have a card up its sleeve, which it probably would be willing to use, and those are rare earth curves. Back to you.
All right, Eunice Yoon in Beijing with the latest there on China's stance on the U.S.-Iran war. Thank you very much for that. Let's see now how markets in Europe and Asia are shaping up given all of that. Elaine Yu is in Hong Kong with the latest there, and Steve Sedgwick is in London. And Elaine, we will start with you first.
Hey Dom, so AI is still the main theme here. Alibaba plunged as much as 10% today and closed 8.5% lower after the Chinese tech giant announced a $10.2 billion share placement to non-US investors to fund its AI push. The new shares are being sold at a sharp discount to Friday's close, 8.4%, and that is raising concerns about dilution. And this move comes just days after Alibaba posted a 75% quarterly drop in profits, primarily due to heavy AI-related spending. Now, the AI trade is also under pressure in South Korea. Samsung Electronics plunged 8.7% today after a record shareholder return plan disappointed investors. Samsung plans to return as much as $79 billion to shareholders this year, but investors were hoping for a bigger slice of Samsung's AI-driven cash windfall and also more clarity on future share buybacks. Now, SK Hynix is also down 3.4%, and the Kospi is down roughly 3% as well. Now, in Tokyo, the Nikkei is choppy today. It's closed down 0.75%, and AI-linked names like SoftBank and Fujikura are both under pressure, both down 5%. And this is, of course, ahead of NVIDIA's earning later this week, with NVIDIA reportedly telling major customers recently that AI server prices will rise as memory costs surge. Back to you.
All right, Elaine Yu in Hong Kong with the latest on the Asian markets. Thank you very much for that. Let's see how early trading is shaping up in Europe. Steve Sedgwick is in London with that side of the story. Steve.
Don, what a brilliant show you've had so far. Everything that your correspondents and you have mentioned are affecting European equities today. So we're a bystander in many, many ways to all these major events, whether it be Kevin Warsh at the end of the week, whether it be NVIDIA numbers on Wednesday, whether it be the stories about Alibaba and SoftBank that Elaine was talking about, whether it be Dan talking about the Iran story. And, of course, fascinating to hear what Eunice had to say about that as well. So European equities are watching all of this and waiting for the move on all of those big stories before really committing in one way or the other. We're largely range-bound to kick off the week. The Stock 600 treading water at around 650 points. Investors looking at all those factors, NVIDIA's results and Jackson Hole later in the week. Especially travel and leisure amongst the names perhaps leading sector gains this morning. Also miners catching a bit of the bid. On the downside, we've got oil and gas names trading a little bit on the back foot as those crude prices come off their recent highs. Back to you, Dom.
All right, Steve Sedgwick with the latest out of London. Thank you very much for that. We've got a lot more to come here on Morning Call, including the Fed heading west. The growing list of challenges Kevin Warsh and his company face as they prepare to convene at this year's Jackson Hole Symposium. Plus, much more on the fallout from the collapse in U.S. and Canada trade talks. We talked to one former Trump economic advisor on whether the two allies can actually come back to the negotiating table to hammer out a possible deal. And later on, we're going to find you the opportunities within the markets, the one sector that's been handing investors healthy gains, up nearly 10% so far this quarter. We got a very busy hour still ahead when Morning Call returns after this commercial break.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box streaming on CNBC Plus.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned. Sponsors disappeared. Fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
Crypto FC on The Score.
Listen to CNBC on the move with the CNBC app.
A lot of strong numbers this morning.
Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe. Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
All right, a very busy week ahead for investors, including the Fed holding its annual Jackson Hole Summit. The sit-down in Wyoming coming amid that ongoing turbulence within the Treasury market overall. As if that weren't enough, we also get NVIDIA's latest earnings on Wednesday after the bell, and the latest test for the demand around that AI big tech trade. That stock, by the way, is flat since its last quarterly report, so NVIDIA shares right now in focus. For more, let's bring in Seema Shah, Chief Global Strategist over at Principal Asset Management. And Seema, this is a scenario now where the markets sit just below their record highs, awaiting a slew of different macro and microeconomic catalysts. What exactly is going to be the thing that you're watching the most in a catalyst-filled week?
Good morning, Don. You're right. This is a very, very busy week. I think that both NVIDIA earnings and what we're likely to hear from Chair Warsh at Jackson Hole are really key to how the market is going to be moving. We're going to be watching both. What I suspect is going to happen, though, is that Chair Warsh is unlikely to provide any kind of forward guidance, any inkling on what they're planning for the September meeting. So it may not actually end up being that market moving. So in fact, it really comes back to NVIDIA earnings and really understanding what the AI CapEx plans are to make sure that that's continuing. Because remember, NVIDIA is still going to be the foundations for a lot of this AI CapEx trade. So if we were to see any wobbles there, then unfortunately that could be bad news for the broader market.
Seema, how has the price action in many of these AI names, and NVIDIA is arguably the poster child of all of them, what exactly has the volatility or medium-term flatness in some of these moves signaled to you about the veracity of the AI trade going forward?
So there's a number of different ways of thinking about this. From our perspective, this is the AI cycle which is maturing. So whereas once upon a time it was a one-way trade and everything that had anything to do with tech ended up doing very, very well, this is the point where investors are saying, look, we know what the CapEx plans are at this stage, but we want to know that that's actually going to be monetized, that there's going to be some kind of return on investment. And that's where you're seeing a bit of the discrepancy, where you're seeing some winners and losers emerging from this broad AI build-out. The other part of this as well is that you are seeing more of a global story. So whereas once it was really centered on the US, that was a full focus, you're now seeing people talk about it more with regards to, of course, software, chip makers in Asia, the supply of the infrastructure build out, the kind of the resources from Latin America, and then the usage within Europe. So this is becoming more of a global story. It's very interesting, but it's no longer the one-way trade that it once was.
So the global story also focuses right now on the interest rate side of things, and the headlines are coming these days mostly out of the U.S. Treasury market. We heard Alibaba with a capital raise, the latest in a string of mega cap tech companies around the world announcing capital plans, some of which involve equity raises and some of which involve debt. How much is that kind of debt story going to be altered with regard to AI, given the rise in yields that we've seen? And what exactly can we expect, given all of that, out of Jackson Hole, or maybe nothing at all?
Yeah, I mean, what we've been seeing from a lot of these tech players is when they're thinking about what they will gain over the coming years, decades even, from a lot of their AI capex build out, is that it's worth whatever the cost is from rising bond yields. So actually, from our mind, they're a little bit macro, or I should say bond agnostic. So the rising yields doesn't really stop them in their tracks at this stage. I mean, maybe there's a level, a threshold at which the arithmetic starts to change. So unfortunately, from the US perspective, this is a bit of a competition for US Treasuries, and that's been one of the drivers up for Treasury yields in recent months. From Jackson Hole, it will be interesting to see if Chair Warsh acknowledges what's been happening within the Treasury market, the intervention that took place last week. But in fact, what we're expecting to hear from him is that the Fed is solely focused on the inflation fight. That has to be where a lot of their operations are going to be focused. And does that mean that there's going to be some kind of impact to their policy rate and impact to their balance sheet policy? I think there's a lot to be question at this point. We're just not sure if Chair Warsh is going to be willing to provide any additional information, given his reluctance to provide any kind of guidance to the market.
And still early in the tenure as well as Fed Chair. Seema Shah, Principal, thank you very much. We'll talk to you soon.
Thank you.
All right, well, straight ahead on the show, new concerns for Anthropic and a potential demand dilemma ahead of its highly anticipated IPO. But first, a check on shares of Deere. Members of the United Auto Workers Union rejecting an offer from the company to extend their contract by 2 years, setting the stage for potentially contentious talks next year. Deere had offered workers a 4% wage increase and bonuses if they accepted the contract by the end of August. UAW President Shawn Fain says the offer fails to address outsourcing from union plants. Deere shares right now off fractionally in the pre-market trade. Morning Call is back after this.
On a $100,000 US margin loan, Interactive Brokers charges just 5.14%. Do you know how much your broker charges? Fidelity and Schwab charge over 2 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,100, or much more if you're trading big bucks.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
This is not just good content, this is good business. It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
I'm with Becky. This is the greatest show on earth.
Squawk Box, streaming on CNBC+. Halftime Report, weekdays streaming on CNBC+.
Fast Money is America's post-game show.
Near all-time highs against the S&P.
We want to arm people with the information to make great decisions.
Valuations matter in a higher interest rate environment.
Fast Money, CNBC, streaming on CNBC+.
The AI boom is usually told as a Silicon Valley story, but some of the biggest winners are thousands of miles away in South Korea. And their windfall is now spilling into an unexpected place, the housing market.
Before we saw this massive rally this year, people just like to invest in the housing market because there is no alternative for savings and investment.
From January to April 2026, home buyers used about 3.7 trillion won, or roughly $2.4 billion, from stocks and bond sales to fund purchases.
The government wanted to boost the stock market so that people could move away from homes into the stock market, but people are coming back to the property market with the money that they earned in the stock market. And it's also sort of this vicious cycle.
The danger is not that one stock market sell-off would immediately crash home prices. It's that the same wealth channel pushing stock gains into housing depends on confidence.
Welcome back to Morning Call. Checking some of this morning's latest headlines. President Trump reshuffled his investment portfolio this summer. The president's latest public financial disclosure report shows he made more than 1,000 transactions in June, buying nearly $50 million in securities and selling roughly $28 million. He sold names like Meta Platforms and Motorola, but also snapped up Berkshire Hathaway, Visa, and MasterCard. While the filing gives a window into President Trump's investment moves, it is not a clear picture of the total holdings in his portfolio. Anthropic's top AI model is reportedly struggling to attract customers as it competes against cheaper alternatives. The Financial Times says spending on Fable 5 has topped out at roughly 11% of the total spent on all of Anthropic's tools, more than 2 months after its launch. Analysts say the change was primarily due to Fable's high price and that older models are capable of handling a bulk of those businesses' needs. NVIDIA is in talks to invest in Perplexity as part of a funding round that would value the AI startup at more than $30 billion. The information reports the new round would hike Perplexity's valuation by more than 50% from the previous financing round roughly a year ago. And California's Attorney General has reportedly canceled a meeting today with Paramount Skydance over the state's lawsuit seeking to block the takeover of Warner Brothers Discovery. The New York Times, citing a statement from the Attorney General's office, says the accused Paramount of leaking details of a meeting held on Friday and then acting in bad faith as well. He had been expected to ask Paramount to pledge to keep its movie studio from moving separate from Warner Brothers Discovery. Well, still on deck for this show, the U.S. and Canada kicking off a new week in a trade war. We're live in Washington, D.C. with the latest and whether the two sides will be able to get back to the bargaining table at all. Morning Call continues next.
As our country celebrates its 250th anniversary, CNBC spotlights the leaders driving business and the nation forward.
If I had to sum up 250 years, what I would say is that we are a country that is incredibly ambitious. I'm Jason Liberty. I'm the chairman and chief executive officer of the Royal Caribbean Group. I think my journey is an incredible reflection of what we've seen from many, many generations here in this country. You work hard, opportunities present themselves. I certainly did not imagine that I would be running this incredible organization. So in 1969, the Royal Caribbean Group was formed, focusing really out of leisure travel out of here in Miami. And then over time, we've now grown to 70 incredible ships. Those ships sail all around the world. We are a set of dreamers. So we really focus on dreaming on what tomorrow could be on a vacation experience standpoint. And then we infuse innovation into that. One of the reasons why a lot of the innovation takes place in the U.S. is, one, about 80% of our customers come from the U.S. Also, some of the best talent in the world is sitting here throughout this incredible country. And our ability to bring them here, that is very advantageous to us. When I think of what America's ultimate superpower is, I do think it's grounded in ambition. We are a collection of different cultures that have come together in this country, but ultimately focused on making sure that our country gets better and better each and every day.
Before the lights go out, success on track starts long before the race. It's in every detail, every discipline, every process. While the team prepares to race, another team is already at work. Ecolab supports critical environments, from the factory to headquarters, protecting people, operations, and performance. We push together as one team. When world-class racing meets the best in science, nothing is left to chance. This is what the best looks like. Driving innovation and building a high-performance future that's better for people, planet, and business. The best of us, winning the right way.
All right, let me tell you about ambition. Too much is not enough. Don't just waste this life. Set the goal really high and go all out. Then you create another vision, and another vision, another vision. If that's being ambitious, this is what this is all about.
Combat sports icon Ronda Rousey. She's conquered the UFC, dominated the WWE, and now she's sounding off on both.
It's extremely oversaturated right now. There's too many fights.
San Francisco 49ers owner Jed York. He sat down with us to explain how he turned the team around and the critical lesson he learned. Plus, influencer Jesse Rydell, also known as Jesser, explains his simple ingredient for online success. This is CNBC Sport on the Record.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long. End users are using our AI even more frequently.
Are you heading into a record Q4?
We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you. It's becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented. This Bank of England decision certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
Squawk Box, streaming on CNBC Plus.
I'm Dominic Chu in for Morgan Brennan. Welcome back to Morning Call. Checking U.S. equity futures right now after the S&P 500 and NASDAQ snapped three-week winning streaks last week. Right now, we're relatively stable, just modestly lower. The Dow's implied lower by just 8 points. The S&P down by 18. That heavier NASDAQ trade off by about 157 points. Taking a look at Treasuries with the Fed kicking off its Jackson Hole Symposium later on this week. The 10-year note yield right at 4.71%. The 2-year note yield 4.22%, and the 30-year long bond 5.25% there. Checking crypto prices with Bitcoin working to push towards that 80,000 mark. We are currently off by just about, well, now we're flat, 77,428. Ethereum prices $2,461 and change. Energy, as we await those new economic sanctions on Iran by the U.S. Benchmark U.S. prices are down by 2%, $85.35 for WTI crude. ICE Brent crude futures, the world gauge, $93.11, off by roughly 1.5%. Checking global markets, a mostly lower session in Asia. South Korea's Kospi down over 3%. Taking a look at the trade in Europe right now, you can see the FTSE 100 just about flat on the session. Same thing with the German DAX, and same thing with the CAC in France. Now to our top story and the collapse in trade talks between the U.S. and Canada. The U.S. imposing 50% tariffs on some Canadian products on Saturday after the talks fell apart late Friday. Megan Casella joins us now from Washington with the latest on those talks. Megan.
Dom, good morning. It's a tit-for-tat tariff war now underway between the U.S. and one of its largest trading partners, and that's Canada. Negotiations between the U.S. and Canada collapsed late on Friday night after what had been a week of intense negotiations. So now those steep 50% tariffs are in effect on items ranging from wine and furniture to cement and dairy products. It's about $20 billion worth of goods hit, or about 5% of everything that the U.S. buys from Canada each year. Now, this came after President Trump earlier last week, you'll remember, delayed the tariffs by 3 days, saying there was a deal in hand that just had to be finalized. But that all fell apart at the 11th hour. Now, what brought us here? There were disagreements over auto tariffs, with the U.S. saying that Canada was demanding that tariff relief that the U.S. was willing to offer on cars would have to be extended to small trucks as well. Canadian Prime Minister Mark Carney also said that the U.S. made demands aiming to limit Canada's ability to strike trade deals with other countries. That's something that he called unacceptable. So now, Dom, the two sides appear to be somewhat stuck. Canada has vowed to retaliate dollar for dollar on U.S. exports, with tariffs set to take effect 2 weeks from now. And U.S. officials are already suggesting that they might respond to that with even further retaliation. Now, U.S. Trade Representative Jamieson Greer also says no further talks are planned as of now. So at this point, it's hard to see anything resolving anytime soon. Dom?
Megan, both sides have said that each side is kind of demanding too much. So what exactly would then be the impetus for those talks to kick off again? What needs to be done to bring both sides back to the negotiating table?
It's really hard when you're in a situation like this. You're absolutely right. Prime Minister Mark Carney said ultimately the U.S. was asking for too much and offering too little. There's also been some reporting that while, yes, those key issues I just ran through were top of mind for both sides and really led to the breakdown, it was a number of small things across the board that when they tried to put pen to paper to frame out the agreement that they'd already agreed in principle, that everything was just too much for Canada to agree to. So in that sense, it's not clear that dropping any one demand or two demands would get them back to the table. Bloomberg is reporting this morning that Canada is preparing for no talks to even get off the ground until after the midterm. So clearly we could be in this for the long haul.
All right, Megan Casella with the latest there on the U.S.-Canada trade talks. Thank you very much for that. Let's talk more about that breakdown in talks between the U.S. and Canada and whether there's a potential off-ramp for either side or on-ramp back towards negotiations. Kellyanne Shaw is a partner and international trade policy expert at the Aiken law firm. She's also former deputy assistant to the president for international economic affairs during the first Trump administration, working as a key negotiator on trade agreements with China and other parties as well. Kellyanne, thank you very much for joining us here. You heard Megan's report. Just how dire is the situation? Both sides don't appear to want to even engage in talks right now. How much of an issue is it going to be ahead of our midterm elections with all the economic uncertainty, given this Canada-U.S. relationship that seems to be now freezing even more?
Good morning. Well, I don't think it's hopeless, but I'm not hopeful for a resolution anytime soon. And what I mean by that is I think the driving force of this collapse is really Canada's domestic politics. Now, you have over the weekend both sides pointing fingers, saying it's the other side's fault. But ultimately, it was Carney who made the decision to walk away from this deal at the 11th hour and took a victory lap over the weekend with his grand speech about why things fell apart. And there's a lot of frustration and bitter feelings on the U.S. side that they had a deal, and at the last moment, the prime minister decided to pull the plug. So I don't really see an off-ramp anytime soon. I think Canada is going to continue to be out in the wilderness from a U.S. negotiating perspective for a little bit now.
From your perspective, given what we know, at least what we kind of know now, who has the relative leverage in this kind of a scenario? We know that both sides rely on each other. We are geographic partners, allies in many ways. But what exactly is I guess maybe I'm trying to figure out how do the U.S. and Canada each view their negotiating position, and what exactly does then bring them back to the table?
Yeah, I think it's a great question. And clearly, the United States and Canada have no choice but to make this relationship work across a whole host of issues, from economic to trade to national security. There will be a relationship that will continue between both countries just because the trading relationship is broken for the moment. And that said, most of U.S.-Canada trade is completely unaffected by these tariffs and Canada's retaliatory tariffs. So the show will go on, so to speak. Now, what would bring both sides back to the negotiating table for a deal? It's a little bit hard to see from where I'm sitting, because what the U.S. was effectively offering Canada is the most generous tariff cuts that they had offered to any trading partner so far, in exchange for Canada removing its retaliation and complying with what it already agreed as part of the USMCA agreement on dairy. The U.S. is not going to sweeten that deal. I don't think they have an incentive to, and I don't think they can politically, because frankly, they were at risk of getting criticized for giving Canada too much. So really, this will depend on the politics in Canada. When does Carney think it's in his political advantage to strike a deal with the United States? When is the economic pain of some of these tariffs too much to bear? So I think ultimately this is going to play out over a series of months, and we'll have to unfortunately see some of this retaliation impact the Canadian economy, I think, before the Prime Minister comes back to the table.
And Kellyanne, one quick one before we let you go. We mentioned some of the products, cement, dairy products, furniture, some consumer staples goods. Is there a threat that we could see an expanded kind of tariff policy go in place between both countries if these particular items are not at least agreed upon to?
Yeah, I think that is worst case scenario, that we have this tit for tat escalation that just continues to tick up. Now, the fundamental complaint of the United States and why they hadn't been engaging with Canada from a trade perspective was because a year ago, Canada retaliated for the administration's initial tariffs. The U.S. waited a year before imposing these countermeasures. So in response to Canada's dollar-for-dollar tariffs, we could see the administration act immediately. We could also see them wait a little bit longer to see if the situation changes before that escalatory phase. I think right now everyone's just evaluating what happened. Again, a lot of shock and frustration on the U.S. side as to why Canada did this at the last moment. So I think we'll have to see what the administration ultimately decides to do.
All right, Kellyanne Shada-Aiken, great to get your thoughts. Thank you very much. We'll see you soon.
Thanks.
All right, a lot more to come here on Morning Call. We reveal this morning's mystery chart, by the way, and the one sector giving investors some quote-unquote healthy returns. That's a big hint. This quarter, up nearly 10% so far. That's your mystery chart. As we head to break, though, thousands packing the streets of Washington for the Freedom 250 Grand Prix. IndyCar drivers racing through the nation's capital, passing by the Mall of America, the Capitol, the Smithsonian as part of the final event to celebrate America's 250th birthday. Morning Call is back after this.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving?
This is unbelievable.
What's breaking?
We are getting some breaking news now out of the Fed.
The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC. Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
Hyrox is on track to deliver around $270 million in revenue in 2026, and the Middle East has quickly become one of its clearest expansion priorities.
Basically, our global expansion strategy always entitled having Hyrox events. Our dream was in the 150 urban metropolitan cities in the world. Abu Dhabi, Dubai, these were all cities that were part of the list. It was always clear that the Middle East are a very, very important part of our business.
But global demand creates a new problem. The race can be replicated city to city, but the experience cannot be overcrowded. The result is a business that benefits from both scarcity and repeatability.
The tickets are very hard to get. That's what keeps people coming back and keeps people looking into opportunities to maybe even fly to another city or travel to another city to participate in. This is highly relevant and important for us as well.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education and sports. So I believe that's the future. I see my brand as in a growing perspective and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have two small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
Welcome back. The S&P 500 snapping its 3-week winning streak last week, thanks in part to that run-up in Treasury yields. But some stocks were able to notch some solid gains, entering quote-unquote overbought territory. The folks at CNBC Pro screened the S&P 500 with stocks with a 14-day relative strength index, or RSI, above the 70 level. An RSI reading above 70 is generally considered a sign that a stock is overbought, meaning it could be more vulnerable to a potential pullback. Those stocks include Agilent Tech, which is up 7% just last week alone, ConocoPhillips up 5.7%, APA Corp up over 4%, Merck, which jumped 12%, and Nordson up over 7% as well. Now, you can read more about the most overbought stocks by going over to cnbc.com/pro, where subscribers get all the access to detail around those big screeners that run each day. Now, with all that talk about tech and AI dominating the market discussion these days, healthcare has quietly snuck under the radar. It is the second best performing sector in the S&P 500 this quarter, up about 10%, trailing only the energy sector. Now, within that, biotech is powering much of those gains thanks to strong earnings and a round of M&A activity. The iShares Biotech ETF, or IBB, is up almost 13% so far this quarter. Let's talk more a little bit about what's driving these gains with Emily Field, head of U.S. Biopharma Research over at Barclays. Emily, the story around healthcare is one that has been brewing arguably for quite a long time now, years in fact. What exactly has now kind of keyed investors on this as a mean reversion trade that wasn't there before for the past 3 to 5 years?
Yeah, I think it's a number of factors. I think, for a while we had the GLP-1 story, though it felt that was very company specific. And then, at the beginning of the Trump administration, there were so many questions about broader policy, drug pricing. And so it felt like it put M&A, which really is the lifeblood of the biotech industry, kind of on pause for a while. So we get to 2026 and it feels like the capital markets are open for a lot of biotech companies. We're starting to see more M&A from the large pharma buyers. And then also some real innovation, I think, has really, got markets excited. We had Revolution Medicines pancreatic cancer data earlier this year. And then just last week, we saw the phase 3 data for the cancer vaccine from Moderna and Merck.
Those particular moves, they're headline driven for sure, but do you feel as though the current environment has kicked off even more interest in M&A? In other words, maybe can biotech investors right now, investing in small and medium-sized companies in that industry, feel as though there is more of that tailwind to be active in those markets because there is a higher potential for acquisition activity given pipelines need to be replenished by large cap pharma?
Oh, absolutely. And, the large cap pharma companies have basically, even after having done deals, for example, AbbVie, after the announcement of the Apogee deal earlier this summer, was very vocal that, they're still committed to doing more business development. Merck, even with the pipeline success that they've had on their own, has done a number of sizable deals, has indicated that they're still going to be very active. So I think that, these large pharma companies are just going to be continuing to look at biotech to supplement their portfolios.
Emily, the Moderna news, as you alluded to, was massive. I mean, the stock price move alone was something for a size company of that was something to behold. What exactly then is going to be, in your mind, the hottest part of that market? Is it going to be cancer vaccines? Are we going to focus more on those than GLP-1s in the past? How exactly do those companies then figure, and what exactly are the top picks in those particular parts of the market?
Oh, that's a great question. I think that, what was so, unexpected about last week was we knew that perchance we could get a readout on this trial, but we didn't know when. So the timing of this really surprised everybody. We'll probably see the full data set at a cancer conference later this fall. But I think that, this sort of unlocks the box of where could these vaccines go next. And there are trials ongoing in other tumor types. So the GLP-1 story, we think, is still going to be, something very important to this industry. But, cancer is still, a very, very big unmet medical need. And there's been some great innovation this year. So I think that that's something people are really going to be paying attention to in the coming months.
All right, Emily Field over at Barclays, thank you very much. Come back and see us again soon.
Thank you.
All right, straight ahead on the show here, the Morning Call crew assembles, teeing up the trading day ahead with trade wars, the Fed, NVIDIA, setting up a massive week of catalysts for investors. We're back after this break.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC Plus.
For me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked, I get it. People say they overpaid, I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
China is the world's second largest consumer market behind the US. In 2025, the country's total retail sales of consumer goods exceeded about 50 trillion yuan, or about $7.2 trillion, up by 3.7% year-on-year. With a population of 1.4 billion people, the market has long been a cash cow for global brands. But today, success is no longer a given, with some Western brands struggling and even scaling back operations in the country.
When you think about live streaming and social media, the hottest new thing is going to bubble up overnight, and you have to have it the next day.
The number one thing that you will see is how little loyalty Chinese consumers are because of the brands and how fast they innovate and how quickly they push things out. Consumers are very used to being hit by new concepts, new designs.
So what does it take to win in China?
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What did the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
All right, welcome back. It's time now for your call sheet where we look at the topics driving the trading day ahead. The crew members today are Stephanie Guild of Robinhood, Nimrit Kang of North Star Asset Management, and Thierry Wiseman of the Macquarie Group as well. Thank you all being here for being part of this panel. We're going to start with our first topic, which has to be maybe these days the geopolitical situation that's developing. And maybe we'll start, first of all, Stephanie, with you. Given U.S. Canada, given U.S. Iran, given the Fed coming up here, what exactly is going to be the market's key focus this week?
It's hard to pick one. There's a lot of things going on. Interest rates obviously matter, especially now because the growth that we're seeing in this country has been dominated by AI, and that started being funded by not just equity and cash flow, but also from debt. And so that, interest rates obviously matter a lot. I think NVIDIA earnings, they're expected to be also, 100% growth quarter over quarter, 88% growth this year. I think, that's going to be meaningful because what they said, they've started to become a bank. And that's why I think that, they kind of matter also in that mix. But I guess if I had to pick one of those, I would probably say, what happens with interest rates because of the underlying debt that's being built up.
All right, speaking of, Nimrit, if we talk about the kind of geopolitical situation that has developed here, the U.S. and Iran or U.S. and Canada, which figures more in your mind from that standpoint?
I think the markets are used to looking through all this geopolitical noise. We have been in a war for a while now, and we have been dealing with the back and forth on tariffs, on again, off again. So I think the markets are really not going to respond to that very much. They're going to focus on the resiliency of corporate earnings. Q2 earnings coming in 24% for non-AI companies. That's broadening of earnings growth. That's what the markets are really focused on.
All right, so that's big. By the way, I just want to point out that with regard to the U.S. and Canada and the trade talks, we do have Ambassador Jameson Greer, the U.S. Trade Representative, coming up later on Squawk Box in the 8 a.m. Eastern Time hour. So a must-watch interview there, given everything that's happening between the U.S. and Canada right now, actually. Okay, let's move on to our next topic, which is Jackson Hole and the symposium happening this week. Thierry, we have, Kevin Warsh's first as Fed chair in his remarks at Jackson Hole. There aren't many people expecting that much out of it, but it could be a potentially market-moving event. What exactly is Kevin Warsh going to do, in your mind, in your opinion, this week at Jackson Hole?
Well, Don, we know what he's not going to do. On July 30th, during his presser post-FOMC, he said he was not going to talk about the short-term policy outlook. And that probably means he's not going to dwell on the recent data in the U.S. economy as well. But that begs the question, what is he going to talk about if not those things? And I think what he's going to talk about is the long term, right? It's the things that he has already focused on. When Kevin Warsh talks about the AI revolution and the productivity gains that might come from it and maybe the disinflation that might come from it, that's really about the long term. If you ask me what I think he's going to say about the long term, I think he's going to balance that positive view with maybe a bit more of a skeptic's view, highlighting the other things that are out there in the narratives that could hurt productivity or cause inflation. Those could be deglobalization. It could be global conflict. It could be climate change. It could be adverse demographics. There's a whole host of things that would counter the very positive productivity story around AI.
All right, let's talk to our two CIOs on the panel right now about what their thoughts are given Jackson Hole. Stephanie, to you. With regard to the markets and how they will perceive these comments from Warsh when they do come around, how important will it be for the markets at just maybe a hair below record highs at this point?
The fact that he's not guiding as much as the market has been used to for a decade plus, I think is just creating more uncertainty and thus more volatility in interest rates. And so any clarity that I think he can provide at Jackson Hole can be helpful to the markets either way. But if you think back over history, this has probably become a most important one in a while. Maybe besides when they said they decided to raise rates pre-2022. So I think, that's where I'm afraid it might be a little bit bearish because we're also in the doldrums of summer, and we are at record highs again, and underneath, as I said, all of this is a lot of debt building up, and I think we're seeing kind of rolling deleveraging. So, unless he says that he's going to start cutting rates for whatever reason, which I can't see that possibility, I'm not sure it's going to be very positive for the markets overall.
All right, now, because Stephanie mentioned it, I want to turn to our last topic, which is NVIDIA, a potentially big catalyst as well. Nimrit, how important are NVIDIA results to the market's resilience right now?
Well, NVIDIA results have established a pattern, which is buy the rumor, sell the results. NVIDIA stock has been doing well headed into these results. We're expecting blockbuster results out of NVIDIA and excellent guidance out of that, but I don't think that's going to do much for the stock or the market. The market's kind of in this phase where, yes, NVIDIA is growing their earnings 97% year over year. Amazing kind of breadth that we're seeing, but how sustainable is it? That's really the question, Dom, and nobody really knows. So I think the market's just in this wait and see. There's a bit of AI fatigue going on, and there's more attention to the other sectors outside of AI.
All right. That does it for us this morning. Thank you very much, Stephanie, Nimrit, and Thierry as well for that. We appreciate the comments there. Let's take a look at the futures right now as we head towards the 6 o'clock Eastern Time hour. Right now, the Dow is implied lower by just about 12 points. The S&P off by 17. The NASDAQ off by 146 for that AI trade. Everyone's positioning ahead of NVIDIA results. Keep it right here. Squawk Box starts right now.
Good morning. The U.S. hitting Canada with new tariffs after trade talks broke down. Canada vowing to retaliate. Economic D-Day is here. Treasury Secretary Scott Bessent set to lay out some new sanctions against Iran. And another week of earnings, as well as the Fed being in focus. We're going to hear from NVIDIA, and Fed Chairman Kevin Warsh. Monday, August 24th, 2026, and Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We are live from the NASDAQ market site in Times Square. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Gang's all back together here. Let's take a look at what's been happening. That's us.
Yeah.
Three is company. Let's take a look at what's been happening with the U.S. equity futures. You'll see right now there are some red arrows. Dow's down only by about 10 points. S&P futures down by 16. The NASDAQ down by 140. Technology did have a rough week last week, but the NASDAQ was down by about 2%. S&P was off by about 1.4%. The S&P and the NASDAQ both breaking a 3-week winning streak. Dow was down for the second week in a row. It was off by about 0.8%. Let's take a look at what's been happening with energy. It was up by more than 5% last week. WTI this morning, though, down by about 2.3%, a decline of more than $2 to $85.05 a barrel. Brent crude is down by about 1.6% to 92.81. And then you've got Treasury yields that are higher over the course of the last week. This morning, they're pulling back ever so slightly. The 10-year sitting at 4.7%, the 2-year at 4.22, and you have to watch that 30-year as well, which is sitting right now at 5.24. Finally, Bitcoin, which picked up pretty significantly, you'll see is up slightly this morning, but it's trading at $77,554, and we'll be watching that closely as well.
Meantime, big story over the weekend, the Trump administration getting ready to lay out new economic penalties against Iran.
Changed a second.
I think it changed on us.
You go for it.
I think we were going to originally talk about what was happening in Canada, but we're going to take a pause on that. That's where we're going first.
Okay, is Jameson Greer still on today?
But
okay, so we have Jameson Greer. So we don't even need to argue about. I'm reading the Wall Street Journal. The dumbest trade war ever revisited is the journal's take on that. But what are we waiting for? There's more. What it wasn't ready or something? What happened?
Megan Casella. We're going to go to her in a moment.
Oh. Well, where is she? She gets a chance to be on Squawk Box, and she's not there?
Maybe technical issues.
Oh, could be technical issues. Anyway, the Trump administration is getting ready to lay out new economic penalties against Iran. In a Financial Times op-ed, Treasury Secretary Bessent called today's economic D-Day. That's what he's calling it for Iran, echoing language used by President Trump last week. Bessent says after decimating Iran's military capabilities, the U.S. is, in his words, entering the endgame. He writes that those who fear that the danger of defying Tehran ought not to discount the cost of testing Washington. The president has created the conditions to leverage every agency, every authority, and action that many assumed we would never summon. Any remaining tie to Tehran will hasten the economic ostracism of countries and entities, whether that tie be purposefully constructed or just willfully ignored. Yesterday, Iran's foreign minister dismissed the new threat of new U.S. sanctions as a sign of desperation. Iran's Persian Gulf Strait Authority also warned that vessels violating its transit rules in the Strait of Hormuz could face penalties, including future ship seizures. Now,
this is targeted at
right.
Basically.
Well, that's going to be the very, I'm fascinated like everybody else to see what he's going to say at 2 o'clock, because the idea that he's telling China, and that somehow China's going to listen, I don't know. Maybe they will listen. I hope they listen. I don't know what I hope for, but it seems very hard to believe that China is going to turn around on this issue.
I wish we really knew what's going on inside Iran right now. We hear anecdotally 350% inflation and no water and no food, and you can, depending on which network you watch. I saw a network, actually our former network. We're not part of NBC anymore, are we? NBC's correspondent said that the president is claiming, without evidence, she put that in there, Yamicha, whatever her name is. She put that in with just stuck it in herself. Without evidence, Trump is claiming that Iran is having some economic problems. Which I love. Editorial. I guess I do it too. So I can't really. Anyway, right? Sometimes I can't do.
Like every day.
Yeah, but not you.
The U.S. imposing new tariffs on Canada following the collapse of trade talks. Canada vowing to respond, and Megan Casella joins us now with the latest. Good morning to you, Megan.
Good morning, guys. Sorry to keep you waiting on talking about Canada, but 50% tariffs are now in effect on some $20 billion worth of Canadian exports to the U.S. Now, this will hit products ranging from wine and furniture to cement and dairy. Canada is vowing to retaliate dollar for dollar. Their new tariffs will be on sectors including steel, paper, and agricultural equipment. All of that set to take effect just after Labor Day. Now, Canadian Prime Minister Mark Carney, he said in a Saturday press conference that this was a step that Canada never wanted to take.
We take this step reluctantly. Reluctantly because we recognize that some of these measures will raise costs and reduce choice for Canadians. Reluctantly because we recognize that some U.S. companies and some U.S. states are innocent bystanders in a dispute that they did not want. Reluctantly because this trade dispute is preventing Canada and America from doing so much good that we could do together.
Now, as for what exactly led these talks to fall apart, the U.S. side says that there was a last-minute demand from Canada to make sure that the auto tariff relief they were prepared to offer on cars would be extended to light trucks as well. Canadian Prime Minister Carney also said that the U.S. made demands aiming to limit Canada's ability to strike trade deals with other countries. He called that unacceptable. He also suggested that a lack of unity on the U.S. negotiating team complicated talks as well, and that fueled some chatter over the weekend of this reported divide between Commerce Secretary Howard Lutnick and the U.S. Trade Representative Jamieson Greer. And guys, the question now is how long this might go on. One round of tariffs on about 5% of what the U.S. buys from Canada, that won't have a huge impact on its own. But if the tit for tat continues, and given that there are no talks currently scheduled between the two sides, it's hard to see any of this being resolved anytime soon. Guys.
There's also a suggestion at one point that the U.S. was asking Canada to eliminate French from some of its districts. Did you see this?
Yes, Carney alluded to this as well. Without giving too many specifics, he said, this is an infringement on our sovereignty. It was things like in a streaming service, for example, allowing French language offerings at the top, or on labeling using French language in addition to English language. We don't have too many specifics on what exactly the U.S. was asking for there, but Canada called that a red line and said it wasn't something that they would entertain.
Why would we even be asking for the language change?
Because if they become part of the United States, they've got to speak English eventually. Megan, do you know? What?
Yeah, I don't know exactly. There are different views of this. Was it a power play by the United States? Was it a misunderstanding or an overrepresentation by Canada of what exactly the U.S. wanted? We just don't know. Even the piece about no trade deals with other countries, the U.S. says that wasn't what they were going for. They were actually just going for trying to promote the U.S. Canada relationship more, and Canada viewed it as something more extreme. It does seem like throughout this whole thing, on a number of issues, putting the pen to paper made everything a little bit more extreme than Canada wanted. So there were some key demands that really messed things up at the end, but overall the U.S. was just looking for more than Canada was willing to give.
Here's what I think part of it may have been. The United States pushed for concessions regarding Canada's and Quebec's French language laws, labeling them as trade barriers for American businesses.
Oh,
I think that was part of what.
The Journal always points out some interesting stuff from both sides. He's complaining about the trade deficit, and they point out we'd have a trade surplus if we weren't importing so much heavy crude. So we'd have a surplus, and it's well suited for our refineries here. So it's something that makes sense. The other thing the Journal points out is they're talking about light trucks, and that Carney wanted it on light trucks. Ford produces some trucks, so you're basically hurting Ford by putting a tariff on wanting it. Anyway, we will have Jamieson Greer.
The energy piece of this, Joe, is huge.
Yeah, the energy piece.
Yeah, the energy piece, where they supply almost all of the natural gas to the United States. We're a huge buyer of all of Canada's energy. And Carney made the point the U.S. wouldn't want Canada to stop selling that, especially given everything going on in the Middle East right now. That's an area where this could get a lot dicier if the tit for tat continues.
Okay. Is that part of, Megan, the tariffs the reprisal tariffs that they were talking about starting September 8th? It was beyond that crude oil as well, so you could see additional inflation there.
Carney did not initially lay out energy as one of the categories, but they do say they're still figuring out exactly what the tariffs will hit, so we just don't know quite yet. We should know in the coming days. I'll say, too, though, that Carney was emphasizing, both in his press conference and then there's some reporting to this effect as well, that they're looking for ways to not impose maximum damage at first because they think they might be in this for the long haul. They're not expecting trade talks to get back off the ground with the U.S. until after the midterm, so they want both sides, at least especially on Canada's side, to be able to withstand this. So they're not going for maximum damage right away.
What did you say the total number of goods that could, because 20 billion is tiny. What did you say the total was? And don't we think that it doesn't go there and that this is just another bargaining ploy to eventually, get one more thing that the United States wants?
Probably. Art of the deal, we're going for the maximum, and then we'll pull back a little bit. It's a $900 billion trade relationship between the two sides when you look at two-way trade.
$20 billion.
This is $20 billion in goods. So 5% of what the U.S. buys from Canada right now, Canada says the retaliation will be dollar for dollar. Small potatoes right now, the concern on both sides is how far it goes.
Doesn't involve potatoes at all. No, that was just
That's true.
Yeah, okay.
Idaho is safe.
Okay, Idaho.
And we're going to get to talk about all of this a little bit later in the broadcast with U.S. Trade Representative Jamieson Greer at 8:10 Eastern Time, and get at that very issue of whether there was any daylight between him and Howard Lutnick, as some of the reports had suggested. That's exciting.
All right, when we come back, we will talk markets in the week ahead with the Wharton School's professor Jeremy Siegel. Stay tuned. You're watching Squawk Box, and this is CNBC.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime report, weekdays streaming on CNBC+.
From the markets to the cause. Kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Edge just opened up in Europe with a French government cooperation agreement as well. How significant is that deal for Edge and for Abu Dhabi?
Europe is where the next budgets are. We would like to contribute to the security of Europe. We feel that we have a value. We feel that Europe have recognized this value by accepting us into Europe. These are facts. We have a very nice footprint in Europe, and this would have not been possible if the UAE wasn't accepted in Europe as a partner, knowing and trustworthy with NATO and the way we firewall things. Plus, you need another player in Europe. Even the big players today, we're working with them. There is always these collaborations, but they only start when you put your ego aside. There is always someone better than you. And you need to be on this learning curve forever.
Maybe surprisingly, although we did have some weakness last week, that the futures aren't doing too much except for the NASDAQ on the latest concerns. Treasury yields among those, and we've got, policemen out there, and that's what we all wish we could do. It's a pretty good deal, I think, Jackson Hole. This should be interesting this year with Kevin Warsh joining us now. Huh?
Uniquely so.
Uniquely so. Joining us now, Jeremy Siegel, Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business and Chief Economist at Wisdom Tree. With age comes wisdom, and I'm calling you wise. We both have seen many things over our careers, and we've both seen much higher interest rates. Yeah. So I guess I just start with, I understand on a relative basis when things change from low levels, it's a much bigger percentage move than from higher levels. But is it really something at this point that threatens to choke off the AI boom because they can't finance things at where we are in the 10-year or the 2-year or the 30-year? Is there too much concern right now about it? I can't believe the Treasury saw fit to take that step. That almost is like, wow, we noticed this and we're worried about it. I'd ignore it at these levels.
First of all, it's good to see all three of you back together.
That's right. Thank you. We called it a wild threesome, and I don't mean that in any bad way.
But I agree with completely. I am not a fan of the Bessent twist. I didn't think the markets were unruly or needed that extra liquidity. And I don't think I agree with you completely, Joe. We've been at 4 3/4 before on the 10-year. That's not a choke point. Not saying that it could not get there at some point in the future, of course, but at a point where you have to panic in terms of financing. We've, as you said, through the years, I would say 40, 30 years ago, we would say, oh my God, how low interest rates are right now compared to what we experienced. But I think Friday, 10 o'clock, I think that's when Warsh is scheduled. I think that's a very important event. I do think the market wants to see the Fed, not give forward guidance. They're willing to accept that. What they want is, what criteria are you looking at? Are you looking at the 5-year inflation expectations? Are you looking at the Fed funds futures market? What criteria are important to you? And I do think that's the right function of the Fed to reveal to the market. And if Warsh does that, I think we could get a big rally there on Friday. I think, for instance, Wednesday we get the PCE report, and I think that's going to be a good one. Actually, I think it's going to come in at or even below expectations. So, I don't think there's really going to be much pressure. Let's face it, politically, I don't see Warsh raising rates.
Is it true? Is it true, or just a urban legend that the market will, by definition, test every new Fed chair? And if I were going to do that, if I were the market and I was diabolical, I'd keep going higher to see whether that's the way and is that what we're seeing? Is the market testing Kevin Warsh right now by creeping?
Well, I think that I think if Kevin disappoints on Friday and gives a kind of, bland, not informational speech, the market could begin to test again. Now, again, he has a chance to correct himself again in the September 16th Fed meeting, which is an important one with the SCP projections and all the rest. But there could be a little test if he disappoints on Friday. So yeah, in a way, and maybe one could even say there was a tiny mini test, when the 30-year poked above that 5% point. So I think that for this Friday speech is something we keep our eyes on.
Hey, Jeremy, when you say if he disappoints the market, how would he disappoint the market?
I think if he if he gives no criteria about what he's looking at, and just said, we have great discussions, and we have an interesting food fight, and we'll let the market. I think what's going to be important, will he comment on Bessent and the intervention in the 30-year? As we all know, he's been a big fan of let's let the market speak, and now we're going to get, there's been a lot of question about what has been his reaction? What is his true reaction to Scott Bessent? Were they communicating? Was this a surprise? Now, I'm not sure whether he's going to include that or not. And if I remember, there's no Q&A after the Jackson Hole speech. So, but that would be probably number one question that they would ask. But
the answer could come both ways, Professor.
I want the pure rates. Well, am I going to get the pure rates that the Fed is changing its maturity structure at this particular point? But I think what the market really wants is, you're not raising rates. You voted against it. Fine. There's just what criteria are you looking at?
Professor,
there's a whole number that can justify it, and they would feel on safer grounds. This is the criteria we look at, and you look at. We can be following this also along the way.
Professor, can you hear me? Professor, it's Andrew. Can you hear me?
Yes, I can, Andy.
So the question I have, it goes to what the Bessent twist is twofold. One is that the Treasury Secretary said that he had last week when he made this decision asymmetric information, that somehow he was in possession of information that the rest of the public was not, which is very possible. I hope, by the way, for all our cases, that is true and he is right. The question is, what is that information? Is that information whatever he's talked to Kevin Warsh about? Is that information this economic D-Day scenario today? Is this information about what the Bank of Japan is or isn't going to be doing sometime soon? And are we overplaying what Bessent has done as being important in the markets, or underplaying it?
I mean, honestly, manipulating the 30-year by a few basis points isn't a big deal. 10-year is the real benchmark. I mean, it's actually the 10-year over which the 30-year fixed rate mortgage is based, not the 30-year, and which all long-term debt is really based on. Was it the headlines? And it was world headlines poking above 5, and he was sensitive about those headlines, and there was a little bit of light issuance on the 30, so maybe he just said on that. But is there something deeper there? I would be worried if there was actually something deeper there that could cascade on the market in the next few months, next few weeks. By the way, I do think another thing that we should watch. This is a huge week. The full court press against Iran, and particularly China's reaction to it, because there's the amount of oil flowing and the refined goods flowing has really been cut down, and there's so many question marks about where is China getting all its oil, and how will it stand a full court press there, and could there be retaliation back on the Chinese side with rare earths or something like that? I think that's probably the biggest unknown. That I see, in addition to the Warsh talk, that faces the markets over the next 5 to 10 days.
I guess we've seen this tariff stuff before, huh? I mentioned we're surprised. Do you think maybe we shouldn't be saying, "Oh, this will work itself out"? I mean, we just talked about it, the $900 billion If Carney decides, look, the whole country doesn't want to be bullied by the United States, I'm going to take a tough stand here. Could it get out of hand and turn into something that becomes more of a problem for the markets?
Listen, Joe, I'm not a fan of Trump's tariffs, but here is a case where Carney reacted, I think, for domestic political advantage. From what I understand, the early polls are 3-1 Canadian in favor of what he did. The Canadians were very hurt and sensitive about the early bullying, if you want to say, of Trump on Canada, and they opposed the U.S. So, in a way, hey, I'm going to get back to you. I'm going to take a stiff, upper lip on that. So, in essence, this is one of the cases where really the walking away from that was probably not the right thing. Now, could it escalate as long as the politics are on Canada's side? And Canada's going to take the bigger brunt of it. I mean, given the size of its economy, well, the U.S. There's already a talk that what we have right now could cost them 40,000 jobs. So the pain point is there. Let's hope. I don't like using the 1930 smooth all-way tariff to get to 50%. My God, we all know that in the history of Republican politics, that's what caused the Great Depression. Let's hope it stays only on $20 billion of Canadian.
You weren't in Center City at all in the last couple of weeks. Did you see this Chucky guy, the guy in the Chucky mask?
Yeah, no, I do. I go back to Center City.
I wouldn't mess with you. He messed with Jamaica.
Move on her. I wish he did, and then get him
Jamaica
down.
Wilson. I guess he ran off like a little. Now he's headed for. Supposedly headed for LA.
I think he's headed to the West Coast.
Yeah, he's headed out to LA, where they'll just blend right in out there. That house. Professor Siegel, thank you. Appreciate it.
Thank you very much, guys.
Look around it.
Okay. Coming up, a pitfall in efforts to get California Paramount Skydance on the same page as the latter pursues a mega merger with Warner Brothers Discovery. We've got details on all of this developing story right after the break.
One hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
The AI boom is reshuffling the global equity market rankings, with Taiwan and South Korea leapfrogging past long-established markets. Taiwan has climbed past Canada and India to become the world's 5th largest equity market, while South Korea has moved into 6th place.
All this happened within the span of just a few months, because last December, they were in the 9th and 11th places respectively. Now, such a shift is not unprecedented, but what is unusual is the speed at which these two have been climbing.
But this reordering isn't necessarily being driven by broad economic growth. Instead, it's about 3 companies at the heart of the AI hardware supply chain.
It's the AI theme which is driving things. So we have this kind of perfect positive storm of industry fundamentals which are resulting in very, very rapid profit growth.
So what does this reshuffle tell us about how AI is changing global stock markets? And what are the risks?
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What do the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli. Closing Bell Overtime, CNBC.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's 2 winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
Welcome back to Squawk Box. California Attorney General Rob Bonta is now canceling a meeting with Paramount Skydance representatives that was scheduled for today. Bonta had told the New York Times that Paramount had misrepresented and leaked details of a meeting that his office held Friday with the company. Now, California and other states are suing to halt Paramount's more than $80 billion merger with Warner Brothers Discovery. Last night, the Wall Street Journal had reported that at today's meeting, Bonta was planning to ask Paramount to divest some of its cable channels and promise to keep its movie studio separate from Warner Brothers. That unto itself, the second portion of it, I think, is a non-starter for the Ellisons, which is to say the idea that you would somehow keep Warner Brothers and Paramount separate would be very, very challenging in terms of understanding the math of it. They also need to keep, as we've discussed, so many of the cable channels, even if they are not, quote unquote, strategic to the company, because they still produce an extraordinary amount of cash, which is used to pay down, or at least the plan, and based on what they've committed to so many of the lenders, a plan to pay down the debt. And so all of this becomes very, very complicated. Of course, the ticking fee starts in October, so there is a real urgency, at least on the part of Paramount, to try to push this along. It's also unclear whether actually Bonta would ultimately win. So there is an argument to try to settle. The question is, what does that settlement even begin to look like?
And it's not going to be a quick or easy settlement when you've got situations like Bonta canceling the meeting that was scheduled for.
Well, that's because this whole thing has become so political on all of it, on all sides.
From the start.
All right, when we come back in just a few minutes, former U.S. Trade Representative Michael Froman is going to be joining us. And later, don't miss our interview with U.S. Trade Representative Jamieson Greer. Stay tuned. You are watching Squawk Box, and this is CNBC.
Listen to CNBC on the move with the CNBC app. A lot of strong numbers this morning. Breaking news.
We've got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
I check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned. Sponsors disappeared. Fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange, and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giamatteo, only on CNBC.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Just before the dawn. Every road I take. Every mile I lose. Still leads me back.
The soaring cost of memory chips could soon lead to more AI-related price hikes. Bloomberg says that some NVIDIA customers have been told that they'll have to pay 15% more for servers with the company's advanced AI chips inside, with higher prices going into effect starting next year. The article says that firms building servers for companies including Microsoft, Alphabet, and Oracle have told their customers about these coming price increases. Those increases are planned for systems containing NVIDIA's high-end Vera Rubin and Grace Blackwell chips.
Coming up, former U.S. Trade Representative Michael Froman joins us on Washington, imposing new tariffs on Canada and Canada's eventual retaliation, we would imagine. And a reminder, you can get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We'll be right back.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
For me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. And I think CNBC allows our viewers to fulfill their passions. I could not imagine covering anything else.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC. Streaming on CNBC Plus.
Combat sports icon Ronda Rousey. She's conquered the UFC,
dominated the WWE, and now she's sounding off on both.
It's extremely oversaturated right now. There's too many fights.
San Francisco 49ers owner Jed York. He sat down with us to explain how he turned the team around and the critical lesson he learned. Plus, influencer Jesse Rydell, also known as Jesser, explains his simple ingredient for online success. This is CNBC Sport on the Record.
On market shaping industries. We are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Wind blows softly through the southern trees, like ghosts whispering old melodies, and every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance, slowly drawing near. Oh, hear my cry beneath this endless sky.
Trade talk breakdown. The U.S. now hitting Canada with 50% tariffs on $20 billion worth of goods. Canada vowing dollar-for-dollar retaliation starting September 8th. Doing this right now on this story and the latest out of Iran. Michael Froman, a former U.S. trade representative, now president of the Council on Foreign Relations. We'll start with Canada, and we'll just discuss it. Try to help us here, Ambassador. Do you think that these are talks that can get back on track? Do you think this becomes a true trade war, as the President of Canada has suggested? What do you think? What do you think went wrong? What are your first implications here?
Well, first of all, Andrew, I think it's important to keep it in perspective. This is a very deep and broad trade relationship, and the new tariffs represent just 5% of our trade in each direction. So $20 billion is irrelevant, more or less, from the U.S. economy, and it's only about 20% of Canada's exports to the United States. When these tariffs are implemented, Canada's exports to the U.S. face an average applied tariff of about 6%. Now, that's way up from where it was before the first Trump administration, when it was about 0.1%, but it's far below the kind of tariffs that China faces, for example, which are north of 20% on average. So, yes, it's significant in terms of what it says about the state of the relationship right now, but economically, it is not terribly meaningful. I think in terms of the dynamics, I think the U.S. has been pressing, this administration has been pressing other countries to align with our policy towards China, to adopt similar export controls, foreign investment screens, and external tariffs. And Canada has resisted giving up, which they view this to be a key part of their sovereignty, their capacity to engage with other countries on the terms that they want to engage in. And I think ultimately that became a sticking point. Hopefully over time we can get back to the table, and what's at risk is the broader USMCA, which is now subject to annual review. The U.S. is engaged with Mexico in a series of negotiations, but is not yet really engaged with Canada. And the Trump administration could take action there going forward.
The implication, though, for some of our even automakers, we were talking about Ford, for example, which manufactures there, are big. And so the question is, what kind of phone calls, you've been in this role before, what kind of phone calls are made yesterday? And does that force the hand of the U.S., or does the idea of Canada raising the rates on us force their hand effectively?
Well, I think ultimately we have more leverage than Canada does, but you're right, in particular sectors, whether it's energy or fertilizer or autos, there is a deep integrated relationship between the two. President Trump has said early on that he sees no reason why American automakers should be making autos in Canada when the price of labor is very similar on one side of the border or the other, and he would like to see them move back to the United States. Certainly in keeping these tariffs on autos, and that was one of the issues subject to negotiation. Right now there's a 25% tariff on elements of the auto trade. That is going to make it difficult for these factories in Canada to be economically viable. And so Canada was eager to see a reduction in those tariffs that had been imposed previously, but at the end of the day felt they didn't get enough from the United States to justify what the U.S. was asking of it.
Ambassador, the second issue is probably the more important one, at least in this particular moment, which is we are apparently D-Day is upon us, or at least upon Iran. We're going to hear more from the Treasury Secretary at 2 p.m. today. But what kind of sanctions do you think the U.S. could genuinely impose that could move the needle at this point?
So we're all eager to hear what the Secretary has to say this afternoon. Look, I think ultimately, if the goal is to bring Iran to its knees economically and ideally to force political change there, it's going to have to require cutting off their energy revenue. And you can do that really, I think, in three ways. One is to enforce the existing sanctions much more aggressively. So really go after the shadow fleet, get other countries to help us go after it, and prevent Iran from getting oil out of the region in any way possible. Two, and relatedly, is the blockade, and imposing a real blockade and holding it there for a significant period of time. At some point, Iran runs out of storage capacity, and if they can't get oil out of their wells and out of the Gulf, then they will have to shut in production. And that is very expensive. And given the status of some of their wells, some of those wells may never open. And then the third option, I think this is where everyone is eager to see where the administration is going, is secondary sanctions. It's sanctioning companies and countries that are facilitating the trade in Iranian oil. That means going after China. More than 90% of the oil coming out of Iran is ultimately going to China, directly or indirectly. And at a time when the administration's been very keen to have stability in the U.S.-China relationship, and we have a summit coming up in about a month, people will be watching to see how much pressure the U.S. is willing to put on.
That's what I wanted to
Chinese
ask you about. It seems like if China is the whole story, because the first two items on your list are things that either we could have done before and maybe even arguably should have done before, one of which effectively is a military option, which is really around the blockade as much as anything else. So the question is, do you believe that he is genuinely going to go and push China today in some way that they're going to say, sure, we'll do that?
Secretary Bessent's indicated that we're having conversations with China and that their interests are aligned with ours in terms of getting the Strait of Hormuz reopened. So we don't know what sort of quiet conversations the administration has had, but the question will be whether China's already importing about half of what it used to import from Iran in terms of oil. The question is whether you can really cut off those revenues, because those revenues largely fund the Revolutionary Guard. And if you want to create or sow dissent within Iran, cutting off the resources that such a powerful part of the Iranian system relies on is the key way of doing that.
My hope, and I don't know if it's your hope, but my hope is it appears that the Treasury Secretary is uniquely confident about his position insofar as he's writing op-eds, he's announcing press releases, press conferences, he's talking about his economic D-Day, that on the backside of whatever this announcement is, that there is real teeth to what he's really now promoted ahead of it.
Look, my sense
how often have you seen a member of the administration, I mean, maybe this administration is different, but go this far? And then the question, of course, is what is on the other side of it?
I think the secretary has a lot of tools at his disposal, and does seem confident that he'll be able to bring those tools to the table now. I think one of the challenges has been the lack of consistency in the president's own approach to this issue, sort of opposing sanctions, then licensing, being concerned about the price of oil and gasoline in the United States. And I think if the administration can pursue a consistent policy, whether it's the blockade or secondary sanctions, if their goal is to really try and bring Iran to its knees economically, that's what it's going to take. But the Iranians, I think, have been watching and seeing the position change for
That's the right? Thank you for joining us this morning. Appreciate it.
Thanks for having me.
When we come back, hot rods come to Washington. We've got the details on the IndyCar Freedom 250 right after this break. First, though, let's get to the AccuWeather forecast with meteorologist Bernie Rayno.
It's a great Monday weather-wise. Your AccuWeather forecast shows sunshine. Chicago, Detroit, New York City, Philadelphia, Washington, D.C. Spotty thunderstorms interior parts of New England. Hot and dry in Texas. Spotty thunderstorms Florida Peninsula. And it's hot also in the Rockies, and there will be a couple of thunderstorms around, but travel delays not many. Maybe in Miami, but along the East Coast, even in the Southeast, looks pretty good. AccuWeather for Business delivers proven superior accuracy with often earlier site-specific warnings that reduce false alarms and costly disruptions so your business stays best prepared. Visit business.accuweather.com.
You can master your strategy, but performance could be limited by your instrument. Precision trading starts with the right instrument. Over the past 3 years, Interactive Brokers clients outperformed the S&P 500 on average. Like returns, trading costs compound. Interactive Brokers is built to lower costs through smarter execution. Access stocks, options, prediction markets, and more across 170-plus global markets. The best-informed investors choose Interactive Brokers.
Streetlights shimmer from
Halftime Report, weekdays streaming on CNBC+.
I was studying molecular biology, going to grad school. I started investing a little money for my dad, and I got bitten by the bug. I was a stockbroker, and it's fun, but we all wished we could just follow the markets and talk. And my ambition was to be able to pay my bills and not have to constantly be selling. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China, U.S.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have two small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
Capitol was the site of the latest IndyCar race. President Trump waving the green flag to start the Freedom 250 Grand Prix after taking a quick lap around the course in his motorcade, maybe not quite as quick as the Indy cars. The race was 147 laps around the National Mall, starting in front of the Lincoln Memorial, and Kyle Kirkwood won the race, taking the checkered flag, which was waved by Transportation Secretary Sean Duffy. Hold that off.
Coming up,
It looked like AI.
it was pretty cool, right?
Yeah.
It was cool. Get up to 180 on those streets. Gotta slow down on the curve.
Who pays for all of this? That's my biggest question. Meaning how much of this is the taxpayer? How much of this is the race itself? Do the sponsors
all
pay
part
for
of
all
the
of
Freedom
it?
250.
I understand that.
250 celebrating for people that want to celebrate.
I get it. I also,
okay. All right.
I also don't want to celebrate $40 trillion of debt.
Yeah, you can just
So
end with don't want to celebrate.
I don't want to celebrate $40 trillion of debt
Full
like
stop.
I don't
Okay.
think you do either.
All right.
What happens to all those old AI processors when the chips aren't in use anymore? After a break, we're going to speak with a CEO whose job it is to answer that question. Squawk Box can right back.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
Listen to CNBC on the move with the CNBC app. A lot of strong numbers this morning. Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
A market shaping industries, supply chains, and global momentum. The China Connection, weekdays. This really is a business-first pivot. CNBC.com and the app anytime. Only on CNBC, connecting you with China.
Feels like searching for a place called home. Train wheels crying near the riverside like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue. While this whole world keeps breaking in two. These crossroads after midnight still pull me through the storm. Like distant thunder rolling.
Welcome back to Squawk Box. A video reportedly discussing investing in Perplexity. The Information now reporting this would be part of an equity round that would value Perplexity at more than $30 billion. It's more than 50% higher than its valuation just a year ago. two companies have been forming stronger business ties. The information reports that NVIDIA had previously considered paying the startup billions of dollars to license some of its technology and hire some of its staff. The question is whether that portion of the deal is also on the table. And if that's the case, what happens to Perplexity longer term? Does Perplexity ultimately become, I mean, there's some talk about whether Perplexity becomes part of NVIDIA longer term and what that could portend. There's also the idea that NVIDIA has become sort of the central bank of AI, and whether all of these deals to some degree are helping push up or at least maintain the valuations of the entire sector. So, for example, if Perplexity couldn't capture that kind of valuation, what would happen to the other valuations, and therefore how important some of this financing actually is?
The piece in the Journal on the front page, would Perplexity be part of that? I mean, is that what they'd use Perplexity to have this open weight model to compete with everybody else?
Potentially. I mean, the thing that's so interesting about Perplexity is it is basically the consumer version of, we keep talking about a picker. It's effectively a model picker. So right now, if you're on OpenAI or you're on Claude, you're just using that model, and oftentimes you're token maxed. Oftentimes you're using the wrong model for the use case. Meaning you're asking it for the weather, and you're asking, the highest sort of order model to tell you the weather, which the lowest order model should be telling you the weather. And so the question is, who is quote unquote picking when you put the prompt in? Who's picking which model you're using? Perplexity on a consumer basis is not just picking the higher end model or lower end model, but it's also picking whether you're using OpenAI, Claude, or an open weight model.
This sounds like, they're partnering with a different company. What's the name of this weird company? Poolside.
Yep, that's another one.
To build their own.
Well, that's and then
separate and distinct from doing something with Perplexity.
Potentially. So, a whole lot of folks involved here.
Our next guest is here to talk about financing in the AI world as well. This is all happening as chip makers rush to innovate and churn out newer, faster chips for hyperscalers. Older GPUs remain in circulation throughout that. NVIDIA's $500 billion financing plan depends in part on the company's chips retaining their value, since Jensen Huang has offered the hardware as collateral. Joining us right now with more on the residual value of GPUs is Shelley Lee. She is co-founder and CEO of Sprout. Sprout refurbishes, recycles, and retires IT hardware for enterprise companies. And Shelley, thanks for being here today.
Thanks for having me.
All right, I want to talk more about your company, and then we'll get into the value you see in GPUs, because you've got a pretty unique perspective on all of this. Sprout is a company that you started 12 years ago in your dorm room at Duke. Tell us about the genesis. What happened?
Yeah, we realized that there were just so many at the time in 2014, students and professors moving out of campus, and we realized that there was a huge boom of electronic waste happening throughout the industry, and there really wasn't a scaled, unified platform on which electronics could be recycled. So we really started in the consumer space, working on student laptops and teacher desktop systems. What we really moved into after Google and all of the other hyperscalers moved into public cloud was, wow, what is actually going on in all of these data centers way before AI, and how do we responsibly fix, maintain, redeploy, and then finally dispose and remarket of the equipment when that hyperscaler says, I'm done with it.
So you've been doing that with the data centers for a while. I know you've got Apple, NVIDIA, Microsoft, Dell, Google as some of your customers who do this. You got in this, I think, in part because of your dad's background, too.
Yep, that's right. In the scrap metal refining business, you learn a lot about the makeup of commodities and how that becomes ultimately what are the most powerful technology hardware today.
So what are you seeing at this point? Because now Wall Street is looking at this and saying, hey, we're going to treat these GPUs as an asset class that we can back with financing. That is highly dependent on how valuable these things are and how long their lifespan is, over how many years. What do you see right now in the front lines in terms of how long these chips last?
Yeah, most years what we do is really boring. We buy GPU racks when they become end of life from the hyperscaler. We fix them up to make sure that they're lovingly refurbished, kind of like an old car. And then we get them ready for the next buyer who doesn't need the latest and greatest, but certainly wants to dip their toe into AI. So maybe they're not running frontier models, but certainly they need the server to pull requests and do a lot of the lower level work that needs to be done and can be done on a 4-, 5-, 6-year-old server. So what we're seeing now is actually the largest wave of assets coming into the Sprout docks are actually 2020 Ampere generation A100 servers. I think that's a really big shock from the debate. Do these servers last 3 years? Do these last 6 years? The reality for us is the hyperscalers are not letting them go until about 6 years.
So 6 years is the lifespan right now, and then what happens to them? Do they go to zero, or when you're refurbishing, how much value goes back to the hyperscaler?
Yeah, the big debate on financing is it the total economic life of the product, which Amazon and Meta are saying between 5 and 6 years. But I think what a lot of the people who are looking at this debate are missing is what is the residual value on a 6-year-old server after you actually take it out of the data center. So just to give you an idea, we've processed roughly 46,000 systems to date of GPU hardware. Of that, about 13,000 of it is actually AI hardware. So that's Volta, Ampere, Hopper, Grace Hopper, and Blackwell. What we're seeing on Hoppers today, at 3.5 years after the first ones were installed, is that they're actually retaining about 60 to 70% of their value today. It's a very, very high number.
How much of that, though, do you think is a function of a shortage of new chips? So we were talking, actually, I think last week, about the whole idea of thinking of this in the context of cars. So, you know, during COVID, for example, when it was hard to get new cars, the value of used cars actually not only held their value, in some cases went up extraordinarily. The moment that new cars became available, for example, Carvana, which was selling used cars, lost some of its value. And whether that is a sort of applicable mental model for what's happening in the chip space, or you think something different is happening?
Yes, it's very much a supply-demand issue. We talk about this at Sprout all the time, where there has to be tension in the rope for prices to actually maintain the right pricing. So yes, there is an extreme shortage of actually GPUs coming out of NVIDIA and all of these very large chip makers. But at the same time, there is a tremendous amount of demand, not only at the frontier, but at inference, so some of these lower end models, to really, really ramp up demand in order to support consumption. So I think that it's a function of not only a lot of supply being not available at this time, but a tremendous amount of demand that we're seeing.
What do you think happens in a couple of years from now, assuming that we actually get to a place where the run rate on new chips is, you know, actually meeting the demand? What that does to the value of the older chips, and whether, when we think about it as an asset class, if that's the new sort of phrase, whether that makes sense in that context?
I don't think about it in 2-year terms or even 5-year terms, because the biggest constraint on silicon is actually not the ability to churn them out of the factory fast enough. It's actually constrained on the user side from these hyperscalers saying, man, we need gigawatts and gigawatts of power in order to support the new servers. And quite frankly, that is a 10, 20, even 30-year problem.
So power is the biggest constraint?
Power is the biggest constraint. Now, I'll tell you something that is a negative as far as the ability of these chips to maintain value, and that is that, I mean, truly, I think the debate is quite over, that 2 to 3 years is the life cycle of a chip. It certainly lasts for longer than this. One of the things that these big chip makers didn't intend for is making a chip that lasts 6, 7, 8, 9 years. And so what we're seeing now is, you know, these GPUs are made really, really well, but they're sitting in data centers that just absolutely run them to the ground. And so I might be holding a $20,000 H100 chip, but you know what? If there's a $150 component on there that actually can't be found anymore because it was retired 6 years ago, well, that $20,000 chip is not advanced hardware, it's scrap metal. And so what's really, really concerning is, well, there is demand for this product and there is very limited supply of both chips and power. But in the future, are we actually going to be able to maintain these systems for the longest life cycle that they were intended to be?
Shelley, this is fascinating, and we hope you'll come back and keep us updated on what you're seeing in the sector. We appreciate it. Thank you.
That was great. Thank you. Don't go anywhere. Hang tight. We can continue this in just a minute, but it's just a little after 7 o'clock right here on the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Sorkin, along with Joe Kernan and Becky Quick. I got a bunch of big stories to tell you about this morning. Perhaps the biggest over the weekend, the U.S. imposing new tariffs on Canada. That follows the collapse of those trade talks. 50% tariffs are now in effect on some $20 billion worth of Canadian exports. Those hitting products ranging from furniture to cement and dairy. Canada vowing to retaliate dollar for dollar. U.S. Trade Representative Jameson Greer, he's going to join us at 8:10 Eastern Time this morning. We're going to get to talk to him all about what happened to those talks over the weekend and potentially where they go from here. And the Trump administration getting ready to ramp up new sanctions against Iran. Treasury Secretary Bessent saying the U.S. will unveil, quote, the single greatest financial offensive ever. Iran's foreign minister dismissing the threat of new U.S. sanctions as a sign of desperation. And authorities urging about 90,000 people near Reno, Nevada to evacuate in the face of a wildfire that has already destroyed some homes. Officials say the Hawk fire was caused by humans, but haven't given details such as whether it was intentionally set or accidental. Authorities are urging residents to be prepared to stay away from the area for several days.
There's actually no such place as Nevada. But, you were asking about who's paying. Roger Penske, I guess Penske Corp covered, but there's a lot of sponsors for Freedom 250. But Congress did authorize $90 million for these Freedom 250
events,
security at the event. So I'm sure that was expensive. I want to have Roger Penske on. Did you see him? I think he's 89. We used to have him on all the time. He was affiliated with GE. He's a national treasurer. He's 89, and he went up and spoke, and he looks like he's about 69, and and we used to have him on all the time. So I think we should have him on. And I just checked to say I know 40 trillion. The Minnesota Leering Center just won the Quality Leering Center in Minnesota since 2019, $10 million in taxpayer money. So, a little celebration might be okay. Join us now, Sylvia Jablonski, Chief Investment Officer of Defiance ETFs. Sylvia, how are you feeling? The markets aren't going too badly this morning after what could be a trade war and what could be a contentious or a family fight on Friday. I don't know what we hear from Kevin Warsh.
Yeah, good morning, Joe. I think the markets are holding up pretty well given everything that's going on. But, what we can say is that all of this continues to just go on. A lot of this news isn't new, right? Here we are again having a tariff battle with another country, Canada in this case. Strait of Hormuz remains uncertain, but the market has kind of been used to that over the past year or so. And with Kevin Warsh, it won't be a big press day where we get a lot of questions to him, so he'll kind of choose what he would like to say, which, I think the market expects will be very little in terms of guidance. And so we'll have to see what happens. I mean, if you look at the overarching story here, though, we're coming to the end of earnings season, 50% blended growth rate for earnings, 85% of the names beat, best quarter since Q1 2021. And so the market is on pretty good footing here.
Let's talk about where interest rates are, because I just think that this is potentially what could cause someone to be a little bit nervous. And if you connect it to AI and funding AI and how much it's going to cost and what 10 basis points means when you're talking trillions of dollars, whatever it is, it almost, to me, it looks like it's like a thread on a sweater, and you could actually see where you start pulling on that. And whatever we're worried about in terms of valuation with this market and, circular financing and whether this is similar to 1999 in the tech bubble back then, could it all rest on whether the market tests Kevin Warsh, the bond market, and interest rates continue to go up despite what, maybe Treasury tries to do? And it just seems like that. Is that where the canary in the coal mine could be, in your view, Sylvia?
It could be, and I heard you discussing this with Professor Siegel earlier in the day and saying that 20, 30 years ago, these rates would have felt low, right? So it's hard to say where this all turns out. One thing that we do know is that AI is leading the markets. It's potentially leading GDP, and it's very much, the impetus for the tailwind that we've seen in stocks here. And the demand continues, the growth story is good there. I think it's really what makes this market a bull market. But if you get these 10 years going past 4.7%, and you now have all of this debt being issued, including by AI companies like NVIDIA, which is entering, bank territory, I think that, all eyes will be on this. And, the earnings could continue to justify valuations, But if you continue to see inflation, if you continue to see the 10-year rise, that is a risk to all of this. So it's something that we'll be watching closely for sure.
What else? Is the potential that something goes wrong and it goes even more wrong in Iran at this point, and this drags on, or trade tensions? I mean, they're all related. Maybe we get trade tensions with China based on what happens with Iran. We're going to talk about that later with Jameson Greer. But what keeps you up at night?
Yeah, all of this, the unknown is what keeps us up, right? I think if you have increased tensions around the world, whether it's with Iran, whether it's with China, whether it's with additional tariff policy and things like this, that could be the curveball to the market. Inflation could be the second curveball. I think those are the two biggest things that keep us up at night and keep investors worried. If you don't have that, then you have a situation where you have a lot of pricing to perfection and earnings have to deliver. And the biggest risk would be, earnings failing to deliver in following quarters. But the way that the trajectory is looking, it's looking quite positive for earnings. It's looking quite positive for the market. But to your point, there has been a lot of unknown that has come to fruition in the markets over the past years. We went years and years, decade really, without any kind of trouble. And then, you have Russia and Ukraine, you have trouble in the Middle East, uncertainty around China. So whatever happens there could certainly be a potential headwind in the markets. We'll have to wait and see.
Okay, Sylvia Jablonski of still defiant. It's good.
Still defiant.
Still defiant. Good to have you on. See you later.
Thank you.
Coming up, an exclusive interview with the interim CEO of Trump Media and Technology Group, Kevin McGurn. We're going to get into the business behind Truth Social, including a new data feed that has stirred up some controversy on Capitol Hill. He joins us next.
He's here.
One hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giamatteo, only on CNBC.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Don't miss the highlights of the PGA Tour. Catch the action from the PGA. The biggest hits and misses. Join us on the green. Saturday and Sunday afternoons, only on CNBC.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school, and I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
Shadows dance beneath whiskey burning slowly in my chest. Trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues.
Motion about it, lawsuits filed against the president alleging it's unconstitutional. Joining us right now in an exclusive interview, in his first TV interview since taking the helm of the company, is Kevin McGurn, interim CEO, Trump Media and Technology Group, and we're thrilled to have you at the table.
Thanks,
to
Andrew.
discuss all of this. We talk about your company all the time. You've now been in the job for about 4 months. Is this
4 months?
Is this what you expected?
You know, it's a really interesting job to have. We promised when I came into the role that we were going to be out here talking to folks like yourselves, talking to our investors, just generally talking to all of our customers and doing it a little bit differently and trying to get some recurring revenue into the system. And that's part of the Truth API.
Okay, so let's talk about the Truth API, because that's been sort of in the headlines almost every day in one way or the other.
Sure.
And really, the idea that the president, I mean, the controversy is this idea that the president of the United States is effectively, because his family owns part of this company, is monetizing his ability to make market-moving statements, and that companies effectively are paying to get access to those statements before the rest of the public.
Yeah. So let's start with the technology. The technology is a tried and true technology that's been in the social media system for quite some time, more than a decade. So all of your big platforms run APIs into high-frequency trading platforms, news and information services, prediction markets, you name it. So when I came into the role, I've been in the media business for almost 30 years. This was an obvious place to go. We have incredible data, we have incredible information, and it was in high demand. This was demand that came to us from the market. So we wanted to make sure that we satisfied that demand in the most brightly lit way. For us, when you have scrapers coming after your data on an ongoing basis against your terms of service, and you give them a product that they can pay for and do it in a legal way, all of these customers came and signed up.
The elephant in the room, you're avoiding the elephant in the room. The president decides what's going on, and then you can have it's almost like you have to do it. Which, Andrews, it's monetizing.
Yeah, no, I mean, the president is a shareholder, right? He's a
position.
minority shareholder. However, I have hundreds of thousands of shareholders. So I don't just have the opportunity,
But
I have
can
the
say
obligation.
there's going to be a settlement based on some tariff issue or something, and you're going to know before anyone else, and the market's going to go up 1,000 points.
I mean, here's what I would say. I think speed has been a part of information since its onset in the news space. It's the same reason why you have reporters on Air Force One. It's the same reason why you have a White House press room to get closer to the information.
So let me ask you a question. And by the way, my understanding is Twitter has an API that people access early as well, right?
As does Reddit.
And as does Reddit. So there are others that are selling this. And I think it's important that the public understands that. But they don't have a president who is a minority shareholder, and his name is not on the shingle. And so my question to you is, was there ever a thought where you said to yourself, you know, we're going to sell this product, this API product, where people can get access early, except for any post made by the President of the United States? That to me would be the one shift that would change the equation. Meaning, I look at what Elon's doing with Twitter, and if he's selling early access, to me, fine, as long as it's not market moving, by the way, on behalf of Tesla or something else that's going to change, you know, and somehow he's the beneficiary in that regard. Because it's the president and the public obligation, the question is, was there ever consideration about his posts in particular?
Yeah, I would say this. His information goes out all over the internet. It starts on Truth Social, it goes to Twitter, it goes to Reddit, and it goes to Instagram and TikTok. It's big on TikTok. We give a 50 millisecond advantage in that post, but that is the internet delivery, right? So all posts go out in real time. As soon as the president posts or any of our other creators post, it is public information. And it goes out in the internet, and if it's machine readable, machines are faster than people. That's why that little latency occurs. But it's a tried and true tactic. In fact, other services actually create even more latency. We do not. We put it out there in real time to all of our customers.
But the reason there's an advantage to it is that if you do have a machine reading it, you can figure it out.
That's exactly right. Yeah, it goes right into an algorithmic trading platform, and they start to look at context and figure out what their trades could be. And by the way, those trades could be right or wrong based on the context that they look at. And the other thing is that we want to license this not just to high-frequency trading platforms, but to retail trading platforms. So you take it from Wall Street to Main Street, and then go on to other types of information services like, some of the bigger names that you know. We just signed one of the largest financial data and information distributors at the end of last week. So we're super excited about that. We're going to go on to the AI world and license to large language models. And we're going to go into prediction markets as well.
I get a lot of Truth Social stuff sent to me by important people, but it's always on Twitter. I don't.
Yeah.
So it goes when the president is out of office. Why would anyone stay with Truth Social at that point? Talk about key man insurance.
Yeah, you've got the midterms coming up, which are a big part of how we think about the world. I think about media, and it starts with content, right? So you think about the term that's coming up, and we've got a lot of different folks coming into the House and into the Senate. These are platforms that have to exist. Let's not forget, 5 years ago, the president was deplatformed from all those services that you mentioned. So this has to exist.
Well, look at the pre-Elon Twitter.
That's right. That's right. Go back into the Twitter files, understand all of the things that were happening there, and that's why this was a necessity for the market.
Is Blue Sky viable? Is it making it?
I think all of these different services are probably viable. Honestly, I think they have to be there because there has to be balance, and no one service is going to balance you out.
As of about a week and a half ago, Dealbook had reported that there was about 10 companies, hedge funds and the like, that were buying this service.
Yeah.
So they were spending $100,000 a month. That's $1.2 million a month to you. How many are there as of today?
More than that. We don't disclose our customers. We let them go out there in the market and talk about it. But we're getting into the mid-teens now, and we're climbing.
And is that something when you think about, and this is it's a publicly traded company, so people want to understand the economics of your business. Is this something where if you're in the mid-teens, let's call it 15, I'll make that up for now.
Yeah.
Is this something where you say it's 30 by the end of the quarter? Do you think there's a marketplace for 100 of firms to be paying this kind of money? Is there 1,000 firms? What is the TAM for this particular product?
I like that question because the TAM actually fluctuates a little bit based on demand and the necessity for speed. Because not every price point is going to rise to that level depending on what you're using it for. If you're a news and information source like CNBC and you want a feed, we can give that to you. But we're probably not going to give it to you at that high price point. It's not worth that much to you, right? It'll be worth slightly less. And if you need a feed, let me know. I know a guy. The thing that I think about is total addressable market of data. And it's an enormous market. But our service is relative to its size and relevant to its importance. And for us, we're going to continue to look for other revenue streams as well. My goal here, I'm a growth and revenue executive. I'm supposed to put in recurring revenue into these publicly traded businesses. Hundreds of thousands of shareholders to serve. I think we're just starting. It's going to be fun.
Kevin, this obviously seems like a pretty valuable asset that you have at this point. If Donald Trump is no longer president, how much does that lose? How much do you lose in terms of the value for that data?
So I think the goal here is we've got an incredible brand. We have a license on that brand. I think that brand lasts well after the administration. I think there's business, politics, lifestyle that can be built out. I'm a content and distribution person, and I do think that we can build a big brand that lasts well beyond.
You think the hedge funds, though, would pay the same premium that they're paying right now?
On the data feed, I think we'll have to see what the demand looks like. It depends on who we bring into the service and what they're talking about at the time. My goal is to actually go around the world and get more people participating as their primary asset on Truth Social.
Ask you a different question about the risks presented in your company. I imagine if Democrats win the House and the Senate, and who knows about the presidency in the future, there will be enormous legal costs for your company because company's going to be hauled in front of Congress multiple times. And there's obviously all these lawsuits already. In terms of sort of thinking about what those risks are for the investors, what do you tell them?
First and foremost, we're not part of a lawsuit for this particular product, but we have had lots of legal, considerations in the past. We just settled. We actually announced it in our earnings report, our very first earnings call, part of the messaging that we want to have out there in the marketplace. We did just end and settle a bunch of litigation, so that will bring our costs of our capex down, for the next quarter. But I agree with you. It's a sad state of affairs. I don't know how else to describe it. It shouldn't be part of a public company's remit to constantly fight the American taxpayer in Congress.
Also, we talk about this as a media company, but there's a Bitcoin strategy going on underneath this company. There's a merger with a nuclear fusion company. In the offing or not? What is the state of play for everything else, so we understand where this all goes?
Yeah, so the nuclear fusion company, TA Technologies, is finishing their audits, and we're getting towards an S4 to file to complete a merger of equals. That'll be a $6 billion valuation merger. It's one of the mergers that I've worked on for quite some time. It's one of the reasons why I got this role. And then the Bitcoin strategy, we've been really diversifying our assets across a number of different big institutions that are running great strategies for us, and we're creating yield.
Can I ask you just a very personal question? When you decide to take this job, there are people out there in the world who say to themselves that the president and the president's family should not be involved in businesses that can be affected by the president and policies that he's putting in place. Bitcoin has been affected by the president. Nuclear energy policy is important. The media policy is important. I'm curious, just on a very personal level, what you think of that, the idea that the president shouldn't be involved in these things. By the way, some people who are fans of the president think unto themselves that just a company like this undermines the credibility of the president, meaning they're not even arguing about something else. They're saying, I wish he wasn't doing this because I think he'd have more credibility doing everything else.
Yeah, I would say two things. One, without this company, it would have been very hard to get elected. This is the thing that he used to actually speak to his constituents. And then secondly, he said it best. He could, one of his guys could start a cupcake factory and he could eat a cupcake and it would change the world and have cupcakes be the, be a conflict of interest.
Wait, there aren't Trump cupcakes?
You know what?
Already?
I'll work on that next. That'll be part of my thing.
I think you.
So I think having, holding office at the highest, the highest post in the land and having business interests is just a fact of life. I think we're modernizing the way people think about this. From my perspective, running a business from the media standpoint as well as running Bitcoin.
Do you think this is the future of politics?
I do.
You do. So that's a larger statement, meaning that every politician is going to effectively therefore be in business. The whole idea of conflicts of interest and trying to prevent conflicts of interest. I mean, what do you think about whether politicians should be able to buy or sell stock, for example?
It's, I'm not a lawmaker, so all of these things need to be litigated and figured out. Obviously, we're not doing anything illegal here. I think that's very clear. All of the coverage on this for the press has been, quite fair. Actually, when you get past the headlines, it's been pretty right down the middle. I'm actually okay with it. And coming on shows like this has been very supportive for us and actually a good marketing tool as well for new customers. I think running businesses and running the country are going to be a big part of the conversation as we go forward. Abraham Lincoln had two desks. He governed from one and he ran his business from the other.
Kevin, it's good to see you. We appreciate you engaging in the dialogue about all this.
Thank you guys for having me. I appreciate it.
Appreciate it. Thank you.
All right, when we come back, our Steve Leisman going to join us with some new details about the Treasury's plan to buy government bonds. Squawk Box will be right back in just a moment.
Before the lights go out, success on track starts long before the race. It's in every detail, every discipline, every process. While the team prepares to race, another team is already at work. Ecolab supports critical environments, from the factory to headquarters, protecting people, operations, and performance. We push together as one team. When world-class racing meets the best in science, nothing is left to chance. This is what the best looks like. Driving innovation and building a high-performance future that's better for people, planet, and business. The best of us, winning the right way.
Squawk Box, streaming on CNBC Plus.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Become a CNBC Pro. Go to cnbc.com/GoPro now.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Fast Money is America's post-game show.
Near all-time highs against the S&P.
We want to arm people with the information to make great decisions.
Valuations matter in a higher interest rate environment.
Fast Money, CNBC, streaming on CNBC Plus.
Our senior economics reporter, Steve Leisman, joins us right now with some new details about the Treasury's plans to buy government bonds. Steve, good morning.
Good morning, Becky. CNBC has learned that the Treasury could use its near $1 trillion general account to help fund its recently announced plans to increase purchases of government bonds on the long end. According to senior Treasury officials, using the Treasury general account, essentially its rainy day fund, would provide the Treasury with considerable firepower to influence long-term bond yields. That would address one of the market criticisms of last week's surprise announcement to double the size of buybacks on the long end to at least $4 billion. Treasury Secretary Scott Bessent said on CNBC last week such operations could be even larger, and the Treasury had a big toolkit, but the Treasury did not detail a funding plan. Market participants, they assumed the Treasury would sell short-term bills to buy the long-term debt. That could still be the case, and the officials would not say how much of the TGA would be used, but they were clear it could be available. 10-year bonds retreated from an initial rally when the plan was made public, in part because of skepticism about whether the Treasury's resources were too limited. Using the TGA could change that. Bessent has built up the TGA to around $950 billion compared with the stated goal under the Biden administration of around $550 to $600 billion. One downside is having somewhat less money on hand in the event of a new debt ceiling battle, but the next battle isn't until sometime in the first half of next year, and a small amount of TGA could go a long way, would not necessarily be of concern to markets. The Treasury officials countered criticism that the surprise announcement was a departure from the practice of being, quote, regular and predictable with bond auctions. They said no change had actually been made to the regular auction schedule, and markets have been given 3 weeks until the first enhanced buyback operation on September 9th. Treasury may not have to use much at all of the TGA to move the bond market. Even the threat could be enough, though markets could, of course, test Treasury Secretary Scott Bessent's resolve. Becky?
Steve, this is a senior Treasury official telling CNBC this, telling you this. Is this kind of the Hank Paulson school of thought where you wanted to let the markets know you have a big bazooka in your pocket so that you don't necessarily have to use it? Hey, there's a gun here and we'll shoot it if we need to.
Exactly. I think that's a nice analogy, Becky. And what's interesting to me is that the Treasury has always had this bazooka. It was kind of interesting to me that the markets didn't figure out they had it. I think it was a question of whether or not Treasury Secretary Scott Bessent would use it. And this, our reporting makes clear they would. It's already funded, right? The question is, do you want the TGA at 950? Do you want it $1 trillion? If you go down to 800, is that the worst thing in the world? I don't know. You have a debt ceiling battle that may happen, I think, as soon as February, but perhaps as late as May, depending upon how the finances work out. This has been there, and I was surprised last week Treasury didn't tell us it was part of what they were considering, but of course it was there. And I think it was, Becky, the idea that the Treasury sort of been very clear about wanting this thing near $1 trillion. But my reporting suggests with people in the market that 800 or 900 is not the end of the world.
Yeah, this is a don't test me moment. We know you don't fight the Fed. This is Treasury saying you don't fight the Treasury either.
That's a great way to put it. And what's interesting is, so they said they're going up from 2 to at least 4. The demand from the market at these auctions has been around 20 billion on offer. So there is a demand out there for markets to get liquidity for this. So the Treasury Secretary is actually meeting the market demand on this, liquefying the off the run, providing liquidity to off the run. That could help Treasuries on the run and modestly reduce. It depends on how much they want to use. So we'll see what happens if they give us a further announcement about perhaps how much of the TGA they would use. But this kind of makes clear to the market that there is a big toolkit out there, as the Secretary told us last week.
Hey, Steve, one other question, and we were talking about it earlier with Professor Siegel, this idea of asymmetric information that Bessent's talked about, that he knows something from last week when he made this decision that the rest of the market doesn't. What do you think that is?
Well, I've been puzzling over that, and I want to look at that word. I have the transcript of his interview up in front of me here. It wasn't exactly clear to me what he was talking about, but the thing is that the Treasury does have visibility about trade in the market that perhaps the market doesn't have. So I am interested as to what he's seeing. But the other thing he did say, Andrew, if you'll remember, was this idea that this is thin trading in the summer, and he wants to slow things down. I don't know that he wants to come up with a market price that's different from the one the market would arrive at on its own over time. But I think there was some concern of accumulating illiquidity in markets. I did look up, these off the runs didn't blow out much, but they have been relatively wide, so you could argue there was a need for liquidity. And I don't think the Treasury is going to stop the market from going where it wants to go. I think there's a question about the speed with which it gets there. And I think the asymmetric information is him saying, I can see the trades and it doesn't look all that rational to me relative to economic fundamentals.
That is a beautiful backdrop, Steve, and we are reminded that you're out at Jackson Hole for the other big news that we're waiting for this week. We look forward to lots of guests, lots of talk, and all of it leading up to Kevin Warsh's big speech.
Well, just to be clear, I'm in Aspen, Becky. I'm on the way to Jackson Hole at another conference right now.
Taking the slow
I wonder,
train there. Not bad.
That is not a green screen, Steve?
It is a green screen.
Yeah, because that's not
Joe, it is what you wanted. Like a lot of things in TV. Like a lot of things in TV, Joe, it is what you want it to be.
It is.
There you go.
In the whole world now,
yeah,
with AI now.
Exactly.
But that's not the Tetons, is it?
No, that's Ajax.
For a second, I was thinking, is that a different angle for the Tetons? So I wasn't listening either, I guess, where you were.
Well, it's beautiful, and it's a precursor of what is to come this week from out west with Steve and with Kevin Warsh, and we are looking forward to it. Thank you, Steve.
Thanks. Yeah.
When we come back after weeks of negotiations, the United States and Canada fail to reach a deal. U.S. Trade Representative Jamieson Greer will join us with more on what's next and the expected retaliation from one of our biggest trade partners. It's all coming up at 8:10 a.m. Eastern Time. Squawk Box will be right back.
Ambition doesn't always look like you think it might look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. I want to democratize access to that high-level information and help explain to every single person out there watching why what's happening in these complex markets matters for their lives today and in the future. That's what drives me. I love being part of this.
Edge just opened up in Europe with a French government cooperation agreement as well. How significant is that deal for Edge and for Abu Dhabi?
Europe is where the next budget summit. We would like to contribute to the security of Europe. We feel that we have a value. We feel that Europe have recognized this value by accepting us into Europe. These are facts. We have a very nice footprint in Europe, and this would have not been possible if the UAE wasn't accepted in Europe as a partner, knowing and trustworthy with NATO and the way we firewall things. Plus, you need another player in Europe. Even the big players today, we're working with them. There is always these collaborations, but they only start when you put your ego aside. There is always someone better than you, and you need to be on this learning curve forever.
A market shaping industries. We are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot, despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Coming up, the end of August, means tennis is coming to New York. Apparently, it's a big tournament in Cincinnati. U.S. Open Fan Week started yesterday. The main tournament begins next Sunday and runs until September 13th. The prize money topping $100 million for the first time. USTA CEO Craig Tiley is going to join us next with more on the Open and the business of tennis. Squawk Box returns in just a moment.
Interactive Brokers pays up to 3.14% on instantly available U.S. dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.14% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
Listen to CNBC on the move with the CNBC app.
A lot of strong numbers this morning. Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Be there for the opening bell.
Right here.
Squawk on the Street, CNBC.
The AI boom is usually told as a Silicon Valley story, but some of the biggest winners are thousands of miles away in South Korea. And their windfall is now spilling into an unexpected place, the housing market.
Before we saw this massive rally this year, people just like to invest in the housing market because there is no alternative for savings and investment.
From January to April 2026, home buyers used about 3.7 trillion won, or roughly $2.4 billion US dollars, from stocks and bond sales to fund purchases.
The government wanted to boost the stock market so that people could move away from homes into the stock market, but people are coming back to the property market with the money that they earned in the stock market, and it's also sort of this vicious cycle.
The danger is not that one stock market sell-off would immediately crash home prices. It's that the same wealth channel pushing stock gains into housing depends on confidence.
U.S. Open Fan Week kicking off here in New York. Joining us now first on CNBC is USTA CEO Craig Tiley. Craig, I lost my IFB. Maybe you can feed it to the floor. Here, plug this in. Or feed it to the floor. You can walk over here. Don't worry about it. No one needs to see me. Craig, it's good to see you, as I said. And I guess some of the most notable things, Sinner is out. Alcaraz is in. I don't think that matters to you because you've got the women, where that's the one sport where parity happened because it should have happened. It absolutely is maybe more compelling. People go to see the women play as much as they do the men, obviously. But does it matter? It's going to be a great tournament even without Sinner.
First of all, morning, we have seen it is now the world's largest sport and entertainment event, and this insatiable demand for our fans to come on out and watch the men, watch the women. We've got 22 days of unbelievable tennis, and it's fantastic to see, and particularly the American players coming off the Cincinnati Open with Coco Gauff winning and Francis Tiafoe in the finals. I think we're in for what's going to be a great 22 days of tennis. Starting today with the Fan Week started yesterday. Arthur Ashe Kids Tennis Day, we had a record crowd out yesterday, and it was free for everyone, and it was we're excited about what's ahead.
It's hard to imagine getting more people in there because the venues seem like they're always pretty crowded, but every year it goes up. So 2025, 1.14 million versus 995. I think every year it goes up, which is unbelievable, isn't it?
Well, it's why we've extended it this year. We've added the extra day, and we moved Arthur Ashe Kids Tennis Day to the start of the week. And this week is our qualifying. We've got the Mixed Doubles Championship, which is the second year of this great new initiative. New events, the Stars of the Open on Thursday night. And then, of course, we had a celebration to Roger Federer on Tuesday night this week. But this week's free for all of our fans. One of our objectives is this first week, 8 of the 22 days, to make sure it's free and affordable for our fans, and that's one of the reasons, again, why we have this insatiable demand. And there's so many things we've got planned on site for our fans, more than just the tennis, but it'd be the great food and other entertainment. And we'll continue to build that and provide our fans with an opportunity to not only experience the game, but experience everything else as it relates to the event.
You can see Djokovic in the front row for free, playing a top 10 player, right?
No, well, that you can, because again, it's, and I think I should have said this up front, is that the secondary market, we don't control the secondary market.
Oh, so you got it. So that's not possible.
But you can see Djokovic this week. You can see him play the Mixed Doubles Championship, playing with Arina Sabalenka, and that starts obviously Tuesday, Wednesday night. You can get access with a fans pass for free in Louis Armstrong Stadium. And you can spend the entire week and the entire 3 weeks watching Djokovic on the outside courts as well.
So these other things, pickleball, padel, you don't see that as a negative. That just expands the audience for regular tennis.
It does. These racket sports are good for the audience. They're good. You know, tennis has come out now in recent studies as the world's healthiest sport. You play the game of tennis, you're confirmed to add an extra 10 years onto your life. So we continue to promote tennis. It's not only a beautiful game to watch, but a great one to play. And we've got probably the best marketing platform to promote and grow the game. The U.S. Open presents that to all of our fans as well. So again, I think we're excited having a full field, and as you mentioned up front with Alcaraz back and having Serena Williams play this week in doubles and in mixed doubles, we're excited about that too.
So Becky, off camera, I just told you, I got back from Sea Island. We played every day. It was 100 degrees, and the real field was 115. And at high noon, we were hitting from a ball machine. And I said, if I survive this, then I don't need a stress test. You don't.
It's your own stress.
It's your own stress, because you can't dog it on tennis. There's just no way. The feet got to move, unfortunately. I try to reach, and that doesn't help. What is the drink? Craig, do you know? They got strawberries and cream over in Wimbledon, but there's a drink that I still have the cup. What is that thing?
It's a honeydew drink, which has become an iconic drink, a globally iconic drink that obviously everyone loves it. In fact, I think there's people that come on site just to get a taste of that. And this is one of the many opportunities that we do offer our fans. And back to your playing, it's a good example where tennis, the great thing about our game, men and women can play together. If you decide to run, you can run. If you decide to stand still, you can stand still.
No, it's hard.
You get
doubles, maybe. Doubles. Yeah. Andrew will be out there.
I always love going out, but I have a real question for you, Craig. And I don't know if you saw, Bill Ackman was on X.
You have a real question for him?
Well, no, I have a real question about the business of all.
Oh, okay.
The business of this, which is, Bill Ackman was online effectively slamming the price of tickets, saying it's absurd for a not-for-profit to have prices at these levels these days. I think he took some of it back, actually, after there was some commotion about
he's in the front row.
I agree, he's paying.
With Robert Redford.
But the question is whether there should be a different pricing scheme given that the U.S. Open is a not-for-profit. That is a question.
Well, I think, and that's a fair question. I think the first thing, again, the secondary market's a secondary market. We don't control that. And the reference made at the beginning was prices on the secondary market. Our entry price is a $65 grounds price, as you indicated. You can actually get on site if the stadium hasn't been full the 2 weeks. You can get on site for $25. And of course, this entire week, 8 days are free for our fans. But I think in your reference to not-for-profit, I think what's really important, we also, every cent that we generate, we invest back into the sport. We invest back into growing the sport, providing access across the United States for people to play the game. And that's why it's a critical platform for us. But we constantly do our best to provide enough opportunity that is free and affordable. And not being able to control the secondary price is one of our challenges.
Yeah, that's an issue. It's a big issue.
You'll go how many?
I'll try to go once or twice this year. If more, we'll see.
You know what happens? There's a film festival going on, and we used to go every year, and now we're sitting inside a theater. Anyway, Craig Tiley, thank you. Appreciate it. Did I get that right? I did, right? Yeah, it would have been so easy to like Meg.
I've been on the job 4 weeks, so we're getting it. So.
Okay.
Oh, wow.
Meantime, the U.S. Open, just another event to wager on, either using sports books or prediction markets, where you can get into the ongoing debate over regulating prediction markets with former New Jersey Governor Chris Christie, who's now advising the gaming industry. He joins us at 8:30 Eastern Time this morning. That's a conversation you don't want to miss. So we've got Chris Christie and Jameson Greer on Canada's tariffs coming up right after this.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school, and I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's gonna give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
There were definitely a few times when there was no money in the bank.
Before Careem became one of the defining startup stories of the Middle East, Mudassir Sheikha was trying to keep it alive from one funding round to the next. He'd left a safe consulting job, and he and his co-founder had each invested $50,000 US of their own money into the company. In the early days, Careem wasn't an app that magically matched riders and drivers. It was the founders calling drivers themselves in the early hours of the morning.
It was radically basic. all we had was a website.
And 7 years later, Uber, the rival Careem spent years fighting, agreed to buy the company in a landmark deal for the region.
To do a deal with our biggest rival, the company that we thought was trying to kill us, was just very, very difficult for the organization.
Smoke from my cigarette fades into the night. While neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest. Trying to calm a heart that never rests. Every passing train sounds lonely and low. Like memories from a
Shein announcing plans to go public in Hong Kong. The Chinese fast fashion giant filing for an IPO to raise about $1.8 billion. That would value the company at roughly $27 billion. Its valuation dropped sharply from earlier private fundraising rounds that had valued it at nearly $100 billion. If you remember, back in 2022, shares expected to start trading on September 1st. So we will watch that one with great interest.
And we're going to be talking more about the Chinese IPO market with venture capitalist Alex Harstrick of J2 Ventures. We'll get into what has become a pretty thorny issue here at home as well, building AI data centers. Squawk Box will be back in just a moment. From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently.
Are you heading into a record Q4?
We are gearing up for the biggest IPO of the year. Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
It's becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented.
This Bank of England decision certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
Coming up on the Tech Download, what keeps you awake at night?
Complacency. The threats are tremendous.
What does AI do to the threat landscape?
The adversaries are more sophisticated. We're kind of the quiet, operating system behind the scenes. We couldn't be, I think, better positioned.
Watch the Tech Download this weekend with BlackBerry CEO John Giamatteo, only on CNBC.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
It is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Among today's top stories, the Trump administration getting ready to lay out new economic penalties against Iran. In a Financial Times op-ed, Treasury Secretary Scott Bessent called today Economic D-Day. He is scheduled to speak this afternoon. Canada sees a low probability of resuming trade talks with the United States before the midterm elections here. That's according to a Bloomberg report. It says Prime Minister Mark Carney is designing an aid package for the country that could last through the remainder of the president's term if necessary. We'll be speaking with U.S. Trade Representative Jamieson Greer in just a few minutes. And CNBC has learned that the Treasury Department could use its near $1 trillion general account, essentially its rainy day fund, to try and help fund its recently announced plans to increase purchases of government bonds. That's according to senior officials who spoke with Steve Leisman. We will talk more about this with Leisman and Mohamed El-Arian a little later this hour, but basically this is just a warning to the markets that if you think this is a one and done or two and done situation, think again. They've got a lot of money backing this up.
Time the futures right now. Take a look at where we stand. About 57 points down on the Dow, and Nasdaq off about 143 points. The S&P 500 off about 20 points. Want to get straight over to Dom Chu with a look at this morning's pre-market movers. Good morning, Dom.
Hey, good Monday morning to you and to Becky and to Joe as well. We're going to start here with shares of Alibaba, which are right now just about 2.5% lower in the U.S. pre-market trade after closing 8% lower in Hong Kong action. The company pricing a more than $10 billion placement of newly issued shares for non-U.S. investors. Alibaba says it's going to use those proceeds to invest in artificial intelligence. Now, last week, the company did report a 75% drop in profits in its June quarter, with heavy AI spending weighing on some of those results. So Alibaba shares, you can see, off 2.5% in the U.S. trade there. We'll keep an eye on those. Next, we're going to check on some of the biggest steel and aluminum makers in the U.S., higher pretty much across the board after those trade talks between the U.S. and Canada broke down late on Friday. The nations had seemed poised to reach that deal that would cut existing 50% tariffs on Canadian steel and aluminum to 25%. With that now out of the picture, names like Nucor, Steel Dynamics, Cleveland Cliffs, Century Aluminum are all higher by roughly 3 to 4% in pre-market action so far. So keep an eye on the metals. And we're going to stay north of the border and look at shares of Canada Goose, which are right now down just about 4.5% pre-market. This is due in large part to a downgrade to underweight from equal weight over at Wells Fargo. The bank says the macro environment is against the winter coat maker despite recent investments to improve its product lineup. Wells expects current forecasts pointing to an historic El Nino event to dent sales there, and says that newly adopted tariffs now represent a 200 basis point, 2 percentage point gross headwind for margins on the full year basis. Those shares, you can see, are now down about 35% year to date. Now, for more on those and other top analyst calls of the day, just head over to cnbc.com/pro. Subscribers, as always, get all the access to detail and analysis around the big upgrades and downgrades each day, Andrew. So keep an eye on Canada Goose, down 4.5%. I'll send things back over to you guys.
Okay, Dom, thank you for that. Appreciate it. Becky?
Humanoid robotic company Unitree surged more than 5 times in its IPO price in Shanghai last week. That is well above the typical first-day pop for a Chinese IPO, which averaged 270% in terms of gains on that initial first day. Joining us right now with more on the Chinese IPO pricing and what it's telling us about AI competition from China is venture capitalist Alex Harstrick. He is co-founder and managing partner of J2 Ventures. And Alex, it's good to see you again.
Thank you for having me, Becky.
So you were watching that 500% increase on the first day, and you thought what?
So everyone's going to be focused on the stock price. The pop is monumental. And actually, you see this pretty consistently on Chinese IPOs on the STAR market, where the PRC has a little bit of a stronger take on what the debut pricing looks like, all the way back to the implications of who financed the companies in the first place. I think that's missing the deeper story. What we should be focused on here is, historically speaking, China gets a piece of technology from the United States. They manufacture it better, they make it cheaper, and then they dominate. We've seen that in electric vehicles, we've seen that in solar, now we're seeing it in robotics. We've been worried about American robot versus Chinese robot. But what if the implication that we're actually seeing is that Beijing is also making the financing around these companies when they go public much more efficient and much more competitive than the United States could ever replicate?
I mean, so even though we saw a 500% jump on that initial day, you think these companies are still undervalued relative to the companies that are here in the United States?
I think deliberately so. I think that is actually a mechanism because what the PRC is signaling via the public markets is the competition isn't in any one piece of technology, but in the industrial ecosystem that creates those technologies. So it's not robot America, robot China, it's American industrial ecosystem, Chinese industrial ecosystem. And we just don't have the same discipline and mechanism to be able to replicate that.
Do you think it's the same thing that they've done with, let's say, rare earths over this period of time, where basically they were funding all of this and making it too expensive for capitalist companies to compete, basically to put them out of business, and they're the only ones left?
Yeah, that's right. The Belt and Road Initiative is fascinating, right? Because it basically showed that China was focused on an entire ecosystem that America kind of took for granted, figuring that we had dominance in that. And that was telecom, which we did. When you look at it on every other category that moves downstream, and I think the broader implications of this are going to be for the AI race and the AI boom, China is slowly buying up all of the different components. And if it were not for chip dominance in the United States, we really wouldn't have a leg to stand on competitively.
What do we think for that? I mean, I think of Jensen Huang kind of doing the same thing that the Chinese government is doing at this point to try and fix the ecosystem.
Unquestionably. I mean, the problem with the United States, the benefit and the problem, is that we rely on private markets. The problem with private markets only is that private market companies build for venture capitalists. I would know this. I'm one of them. We love calling ourselves tall. We love higher and higher valuations. And then when the company actually IPOs, it usually dips because the public markets are saying there's absolutely no way this is justified. The Chinese are able to instill a lot more discipline because they have a lot more government intervention. I'm not making the argument that we should have more government intervention, don't worry, Joe. But what I am focused on is, if we are actually trying to build something for a sustainable future, what are the questions and strategies that we should be asking ourselves to make sure that we actually do that, as opposed to pumping and dumping whatever we think is in the national interest?
So what's the answer to your question you just posed?
Oh, I mean, I think a couple of things could happen. One, we need a lot more ferocity around demonstrable capabilities in these categories. So the way that we really won autonomy was we had the DARPA Grand Challenge. We came and we said, if you are a great company, come show me. We're doing the same thing for the Department of War in the Drone Dominance Grand Challenge. Similar thing, where China, by the way, is also outpacing the United States. We should have the same thing in robotics and the same thing in AI infrastructure. And that should be measurable outcomes. I'm not asking the CEO what they think or how good their PR person is. I want to see the tech in action, an American Olympiad, if you will, in America with American companies.
Is there anything like that that's been talked about for robotics and AI?
Well, yes, in China. They have
Nobody's really talking about that.
It's a little terrifying. And I think that's the problem is, again, we have these races that are largely PR oriented, especially when it comes to building in the patriotic interest. We're missing what China has, which is saying, come show me what you have, build for the consumer, deploy as quickly as possible, and then have demonstrable competitions to show dominance. This is where the U.S. government can intervene and can build something.
Are you speaking as a patriotic American? Are you speaking as an investor, or both? And which one is more important?
Yeah, well, patriotism always trumps investment. However, I wouldn't be the first venture capitalist to say I wish valuations were lower. That being said, I am one of the first venture capitalists to build an infrastructure fund, right? We raised about $100 million 6 months ago, strictly for the purpose of building in traditional infrastructure, not dissimilar to what Apollo and KKR and all of those folks do. That has none of the same return profile that venture capital does, but it is an observation that the future of what America needs, if we're going to scale these technologies, isn't going to be 25% net IRRs.
So what is the return profile on the infrastructure fund?
Still very good. We're not an RIA yet, so I can say this. We're targeting about 15% net, which is very competitive, but it's not going to be what you see in traditional venture.
What are you targeting in your venture fund?
So venture is 25% net.
So 25 net versus 15.
Yeah.
And how much you think long term, given this sort of big play in infrastructure, every venture firm effectively decides to get into the space this way?
Oh, man.
And the reason I'm asking is I just wonder whether we've lived through this whole sort of economic, sort of capital light cycle.
Yeah.
Where everybody's just software. And now we're moving into potentially, at least for some period, a sort of super heavyweight hardware CapEx mode.
Massively. And by the way, that's exactly why China is doing what they're doing. And that's why America should do what I'm doing. I hope every VC fund copies me. They need to learn actual math. They need to learn what a DCF is. But building an infrastructure fund is the best complement. You invent it using venture finance, which is what it's there for, and you scale it using infrastructure finance, which is what it's there for. But mixing the two is where you get these outcomes that end up getting crushed on day one.
Can I ask one more question on the infrastructure side?
Yes.
Given this sort of, we keep talking about this asset, this new idea that all of this infrastructure becomes sort of this new asset class.
Yeah.
Do you have a view about chips and the length of their duration and how valuable they're going to be in 10 years from now or 15 years from now?
Unquestionably. First of all, the Sprout CEO is fantastic. We're invested in a company that's a complement to that called Phoenix Semiconductor. Same observation. The infrastructure fund builds specifically in the state of New Mexico. The state of New Mexico has a very active economic development department. Absolutely fantastic. They give amazing incentives to building real technology there. When you're talking about chips and AI infrastructure, that is the future. We actually don't have enough physical inputs to build these kind of things. And moreover, the technology we're dependent on, F-22, F-18, tanks, planes, automobiles, that's using legacy stuff that you actually need to pull out of, in some cases, a literal dumpster to be able to create in the future. The fancy stuff is great. We focus on the fancy because that's what all these new companies are building, and they're raising money from people like me to do it. But the things that we're dependent on a daily basis, I would estimate about 60% is just the old stuff. And we need the old stuff to work every single day. And exactly to Shelley's point, the old stuff is being worked to death. And we don't really have a mechanism, not sustainably in America, to be able to create that unless you literally resurrect it from the ashes. And that will be built here.
Alex, this is a longer conversation. We'll have you back, but thank you very much.
Thank you.
Appreciate it.
But coming up, U.S. Trade Representative Jamieson Greer on the new round of Iran sanctions, plus the breakdown in talks we saw with Canada. That's next and later. Former New Jersey Governor Chris Christie on the efforts to regulate the prediction markets. That's at 8:30 a.m. Eastern Time. Squawk Box returns in just a moment.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Fast Money is America's post-game show.
Basically near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked, I get it. People say they overpaid, I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC. Streaming on CNBC Plus.
Bartender wipes the dust
As you know by now, U.S. and Canada trade talks collapsed, and new U.S. tariffs are kicking in over the weekend. Canada now preparing its own retaliatory levies. And joining us now, Jamieson Greer, U.S. Trade Representative. We'd love to hear, Mr. Ambassador, exactly what happened in your view. And I know you'll give an absolutely objective analysis of both sides and what went on. But how would you characterize the breakdown in talks? What caused it?
Well, thanks, Joe, and thanks for having me on. And to your point, I will be as objective as possible, and I don't want to characterize anything that the Canadian senator did. That's kind of their thing. Just remember how we started with all of this. The Canadians over a year ago, they prohibited the sale of American wine and spirits in their stores. They put limits on how many autos could go into Canada. And even before that, they restricted the sale of U.S. dairy into Canada. So lots of new and long-standing issues with Canada. After about a year of asking them to eliminate these, they said no. So we proposed some very tailored tariffs covering about 5% of what they send us. So pretty low amount in the grand scheme of things to have our own tariffs on those to counter out that retaliation. The Canadians came to us about a month ago. They said, we'd like to negotiate. We didn't ask for it, but we said, okay, we're happy to move forward in good faith, and we did, and they did. We progressed to a point Tuesday night where we had enough agreement among the parties to announce that we had found the way to a deal. Then we set about to finalize it. And then in the last hours, I think there were things that the Canadians just, they wanted more. We offered them the best access to the United States of any country in the world. Obviously, there's always going to be tariffs, and there's going to be that protection for American workers and companies. That's the president's trade policy. That hasn't changed. But we sought to accommodate the Canadians by giving them, by cutting tariffs in half on steel, on aluminum, and extensively reducing them on autos and even on things like softwood lumber, accommodating some element of that. Things that are sensitive for the Canadians. They wanted more. I don't know if it was political for them. It certainly doesn't make economic sense, but perhaps for political reasons. They have some by-elections coming up. I don't know, but they came in and they wanted more, and we weren't prepared to do that.
So many ways to approach it. You can see the markets today basically unchanged, even though the headlines in every paper are that the U.S. and Canada are spiraling towards a trade war. Maybe a year and a half ago, that would have caused more consternation. I think in the back of people's minds, Jameson, that we think this is just another negotiating step along the way to arriving at something. Are the markets wrong about that, or is that how you view it at this point, that an agreement will be reached pretty soon?
Well, Joe, I think the markets understand that this affects a very small amount of trade. Ultimately, I know the Canadians use histrionics like trade war and all these kinds of terms. We don't do that. I mean, the United States, again, we're set on our trade policy. The Canadians asked to come and negotiate with us a month ago, so of course, if people ask, we do. So we don't have any issue proceeding with our trade policy as planned, and I think the market understands that. I think the market knows that at the end of the day, this is 5% of imports from Canada, 0.06% of our overall consumption in this economy. So there's no possible way it can really affect U.S. well-being, right? I mean, we've been having great prints on inflation the past couple of months, going down in June and staying flat here. Real wages for manufacturing workers going up. So we're on the right trajectory. The fundamentals are good, and I don't think this is going to affect anything. And that's why I think the markets are shrugging it off.
The affordability issues, I think that's a red herring as well in terms of this. I can't imagine. But can you confirm that Prime Minister Carney, it was a heavy and medium duty truck, not easing to? Was that the straw that broke the camel's back when the U.S. wouldn't lighten up on those tariffs? And some of that is Ford. I mean, the Journal points out you're really just cutting off our nose to spite our face in terms of Ford in this regard.
I think the thing to keep in mind is the only reason Canada has auto production in the first place, and we've talked about this before, in the 60s, Canada did a very Trumpian thing, and they came to the United States and they said, if you're going to sell into the Canadian market, you have to build here. And there was an auto pact, and at the time, the U.S. economy had a ton of leverage. They didn't think too much about the future of deindustrialization.
And so they moved some plants to Canada. For a long time, for weeks, I've essentially been telling the Canadians, I'll see what I can do to deliver some results for you on a handful of these tariffs that are important to us for national security reasons. We don't change them lightly. They're very important to the president. They're very important. They've driven reindustrialization. And so we were able to come back with a package, and they said, well, we want the scope of that to be more. It's not just cars, it's not just passenger trucks, it's not just SUVs, it's not just pickups. We want the heavy.
Midnight blue. Delta moon hanging low above the river tonight. Silver reflections dancing in the pale light. Old wooden porch creaking underneath my feet, while distant thunder rolls through the summer heat. My cigarette burns slow beside this rocking chair. Southern wind moving softly through the air, and every lonely cricket singing in the dark feels like another memory inside my heart. Delta moonlight blues, soft and low tonight, like an old forgotten prayer floating through the night. Oh Lord, hear my soul trying hard to stay whole. Every road I choose leads back to these blues. Gather slowly over county lines, like old regrets buried deep in time. My guitar hums with a worn-out sound, like a tired man still drifting around. Oh, radio playing from the room inside, songs about lovers who never survive. And somewhere far beyond the riverbed, another lonely night begins again. Delta moonlight blues rolling through my veins, like muddy southern water after endless rain. to an old forgotten tune. Dust blows softly through this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blues running through my soul, like an old black river nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blues. Old bartender says the night's still young, but these tired lungs have sung enough songs. Train whistles echo somewhere far away, like ghosts begging me to stay. My guitar strings hum with a cracked old sound, like a worn-out man still drifting around. And every note beneath this southern sky feels like one more slow goodbye. Dust and bones blues, heavy as the rain, like old scars hiding deep beneath the pain. Every road I ride, every town I choose, still leaves me stranded with these dust and blues. midnight train rolling through the rain, steel wheels crying like human pain. Coffee grows colder beside my hand as I watch the storm move across the land. Cheap motel glowing beside the road, another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, rolling through my soul like an endless highway with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Every passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light starts looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned, and every chord beneath the moonlight sky feels like one more long goodbye. Lonely train blues tonight, slowly drifting on like the whistle of a train just before the dawn. Every road I take, every mile I lose, still leads me back to these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues keep pulling me down slow, like muddy southern water where broken dreamers go. Oh Lord, hear me tonight underneath this pale moonlight. Every road I choose leads back to these blues. Dusty boots walking through an empty town. Every lost soul keeps looking down. Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Through the southern trees, like ghosts whispering old melodies, and every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance, slowly drawing near. Oh Lord, hear my cry beneath this endless sky. Every dream I lose turns into these blues. Neon signs glowing through the midnight rain. Every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox humming in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon whiskey road, take me far away, past the empty bars, memories that stay. Oh Lord, home. Every road I choose turns into these blues. Cold wind whispers through the motel screen about all the things that could have been. Train tracks shining underneath the storm like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. And every chord beneath the southern sky feels like one more long goodbye. Neon Whiskey Road, stretching through the night like a lonely river, disappearing out of sight. Every dream I lose, every town I roam, still searching for a place this heart can call home. Rain falls gently on a Delta town tonight. Street lights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall. of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pine wood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face.
Welcome to China in Focus. I'm Tiffany Meyer. Our top story, a cross-border network under fire, the U.S. sanctioning entities in Russia, Iran, and China. Officials say they provided support to Iran's military. Tesla, SpaceX, and China. A new report raises questions about a potential merger, while CEO Elon Musk pushes back. We'll explain what's behind the report and the growing trend of companies separating from China operations. China's economy is showing new signs of weakness. Factory activity fell in July as demand declined, while ongoing trade tensions with the U.S. and Europe create more challenges for Beijing. And former White House Chief Medical Advisor Dr. Anthony Fauci refuses to answer questions before Congress about the pandemic's early days. We examine Beijing's cover-up and the role played by the World Health Organization. The Treasury Department has sanctioned 6 people and companies in China, India, Russia, and Iran. The sanctions target companies acting as sales agents for Iran's Mahan Air, along with a front company tied to the Islamic Revolutionary Guard. The Treasury says the airline Mahan Air has helped the Islamic Revolutionary Guard Corps, or IRGC, provide travel for the Quds Force, which the U.S. has designated as a terrorist organization. The Treasury adds it also facilitates military training and helps transport drones and weapons. Treasury Secretary Scott Bessent says anyone providing logistics, financial, or commercial support to the IRGC or Mahan Air is helping sustain a terrorist enterprise. The sanctions block any property or financial assets those entities may have in the U.S. 2 companies from the city of Shanghai and a Chinese executive are on the sanctioned list. One company helped coordinate the shipment of electronics from China to Iran. The other represents Mahan Air in China. The sanctioned individual serves as a director at both companies. A report suggesting Elon Musk is laying the groundwork to combine Tesla and SpaceX is getting a sharp denial. But even as Musk calls the report fake news, it highlights how Tesla has quietly prepared for the growing tensions between the U.S. and China. The Wall Street Journal on Thursday reported that Tesla spent the past few years organizing its U.S. and China operations so they could be separated if geopolitical tensions escalate. According to the report, executives have discussed several options for Tesla's China business. Those include making it a separate company, selling it, or even shutting it down ahead of a possible merger with SpaceX. Musk pushed back on X, calling the story absurdly fake news and saying the idea has never even come up in a discussion. However, the report suggests the planning wasn't only about a potential merger between SpaceX and Tesla. It says Musk wanted Tesla prepared in case tensions between the U.S. and China disrupted supply chains or access to critical technology. It also notes that keeping the businesses separate could help avoid regulatory hurdles. That's because SpaceX is a major U.S. defense contractor, while Tesla operates one of its largest factories in China. Tesla wouldn't be the first company to separate its U.S. and Chinese business operations. Starbucks recently sold a majority stake in its China operations a couple months ago. And Yum Brands, the parent company of popular fast food chains Pizza Hut and KFC, spun off its China division a decade ago. Meanwhile, in 2023, venture capital giant Sequoia split off its China business, citing increasingly complex geopolitical tensions. China's manufacturing sector is showing new signs of weakness. Factory activity declined in July, highlighting the challenges facing the world's second largest economy. China's National Bureau of Statistics reported Friday that the country's manufacturing PMI fell to 49.2. A reading below 50 means factory activity is shrinking. It marks the lowest level in 5 months as new orders fell and businesses saw weaker demand. It's also worth noting that the Chinese regime has a history of hiding actual statistics, so the true number may be even lower. One possible reason behind China's economic slowdown is continued trade pressure, including tensions with the U.S. and other European countries. The data also shows Beijing is still struggling with weak consumer demand, a worsening property market, and higher production costs. Meanwhile, China's services and construction activity also declined, reaching the weakest level since late 2022. Economists say the latest numbers could increase pressure on Beijing to introduce more measures to boost spending and investment. After Dr. Anthony Fauci refused to answer questions before Congress on Wednesday, President Trump is accusing him of protecting China during the pandemic. NTD's Washington correspondent Jack Bradley takes a look at the CCP's cover-up and the role played by the World Health leaders.
Amid Dr. Anthony Fauci's refusal to answer questions on Capitol Hill, President Trump explicitly calling out Fauci for always trying to protect China during the pandemic response.
I disagreed with him on a lot. I would have had to close down the whole country if I listened to him.
In a newly leaked diary, Fauci wrote while he was leading the U.S. response to COVID, he said
that you had great concerns about the World Health Organization because it depends greatly on China and, as you stated, often bows to them.
The WHO took China for its word at the start of the pandemic that there was no evidence of human-to-human transmission of the virus.
There is no reason for measures that unnecessarily interfere with international travel.
That allowed for outbound international flights from China to continue, while the CCP was locking down domestic travel at home. That's as Chinese authorities silenced early warning signs of the pandemic, forcing Wuhan doctor whistleblower Li Wenliang and at least 7 other doctors to sign statements admitting that they made false comments, even though Li later died of COVID. China then blocked WHO investigators from accessing Wuhan for more than a year, and then refused to hand over raw data, lab records, and blood samples.
We are asking actually China to be transparent. The raw data was not shared.
President Trump then withdrew from the WHO during the pandemic.
Chinese officials ignored their reporting obligations to the World Health Organization and pressured the World Health Organization to mislead the world when the virus was first discovered by Chinese authorities.
And instead of demanding transparency from Beijing, Fauci publicly defended the WHO's move.
The WHO is an imperfect organization. The world needs a WHO.
Upon retaking office, President Trump immediately withdrew from the WHO once again. Jack Bradley, NTD News, Washington.
Apple shareholders rejecting a proposal calling for more transparency around the company's exposure to China. But the questions it raises about supply chain risk and geopolitical uncertainty aren't going away. To discuss it, NTD's Steve Land spoke with the counsel for the organization behind that shareholder proposal, Paul Kamenar, counsel to the National Legal and Policy Center.
Paul Kamenar, thanks so much for joining us in studio.
Thank you for having me.
Paul, talk to us about this China entanglement audit. The fact that Apple, so much backlash within the company to not want to reveal its ties to China and the risks that it might pose to its investors is sort of uncanny. Why do you think that is, and what do you hope that this audit would ultimately achieve?
Well, yeah, thank you for having me. Yeah, the National Legal and Policy Center made a proposal under our Corporate Integrity Project because we own some shares in Apple. And the purpose is to have Apple and other companies as well disclose the kind of ties they have with Communist China. And this policy that we're looking at, this China entanglement audit, is just simply one to say, look, tell the shareholders what kind of involvement do you have with China in terms of 90% of your products are made in China. And what you're doing there is working with the Communist Party there and subsidizing not only their economic warfare that they're using against the United States, but also repressing human rights, political rights. They have, China, we all know, has forced labor camps and so forth that go after minority groups like the Uyghurs, the Falun Gong, etc. And Apple and other companies are complicit in that. And so all we're just saying is, look, tell your shareholders what you're doing and how this affects the shareholders at a reputational risk of the company, because also there's a financial risk. Because if China decides to pull the plug or do some kind of economic backfire to what Apple is doing, that could have obviously a ramification on the value of Apple. But again, the larger issue is transparency, to have this out into the public.
It seems like a very responsible thing to do. As you fully disclosed, the National Legal and Policy Center is, shareholder in Apple. And so this was a shareholder-created proposal. Apple's board voting against it, giving existing tariffs and geopolitical tensions. How vulnerable do you think Apple's shareholders are to a lot of the things that you just laid out?
Well, I think they are very vulnerable, and especially when you got 90% of your products coming from China. Now, Apple tries to do a whitewash of saying, well, we're diversifying. We have something that the production done in India or Vietnam, etc. But as we look into it more, that's basically a sham, because they're basically all connected to the dictates of what's coming from Communist China.
One thing we often ask ourselves when we have these discussions about the CCP and dark money and proxies is accountability. Talk to us about FARA, the Foreign Agents Registration Act, and are we enforcing it? Are we leaving something on the table? Is it tight enough? And is it a good method to target some of these things?
Well, that's a good point. The Foreign Agents Registration Act requires foreign agents to register with the Department of Justice to say, here, I'm being paid by this foreign entity or even a company, it's not necessarily the government itself, to do their lobbying here in Washington, D.C. So we filed a complaint against actually Hunter Biden with the Department of Justice because he was getting money from China, an energy company, and then trying to meet with folks in the State Department, etc. And we said, well, that's a violation of the Federal Foreign Agents Registration Act. But there has been a couple prosecutions on this relating to China. I was glad to see that. For example, in 2024, a Chinese operative here in California went after Shenyang, the dance troupe sponsored by Falun Gong, saying that, this organization should not be a 501c3 nonprofit. And he went to the IRS saying you should revoke their tax-exempt status. And it turns out he also gave a bribe to one of the IRS agents. And the government said, well, wait a minute, you're not doing this as some good government citizen. You're actually a front for the Communist Party in China, and therefore you violated the Foreign Agents Registration Act. He was tried, he was convicted, and was given a 20-month sentence. Fast forward to a couple months ago, in New York, the government also indicted and convicted another Chinese agent for operating out of what's called a Chinese police station in New York, which actually is a cover to basically target and harass those dissidents here in America who opposed the communist China. And he was convicted. Not sure what the sentence was, but those are two examples. And what this does is expose to the American people the kind of pernicious influence that the Communist Party of China is having here in America.
Paul Kemenar, counsel to the National Legal and Policy Center. Greatly appreciate you joining us.
Thank you. My pleasure. Anytime.
The European Union's biggest push yet to compete in the global AI race, the EU has opened bids to build up to 7 massive AI gigafactories, dramatically expanding Europe's computing capacity. Tens of billions of dollars are expected to be invested. The move aims to reduce Europe's reliance on the U.S. and China. President Trump has criticized the EU's tech regulations, while China has tightened exports of critical minerals used by the industry. The project is backed by $11.5 billion in public funding. Officials hope to attract at least $23 billion more from private investors. The gigafactories would give Europe greater capability to train and run advanced AI models, reducing its dependence on cloud providers and data centers in countries like China and the U.S. While Europe seeks AI independence, the gigafactories will initially rely heavily on advanced chips from American companies like NVIDIA and AMD. On the software side, the EU wants to ensure all systems comply with the bloc's standards on privacy, safety, and ethics, which are in some respects stricter than those in the U.S. Coming up, a controversial embassy project moves forward. Britain's High Court says Beijing can build in the heart of London. That's despite local residents protesting and calling it a spy base in London. In baton attacks, water cannons, and combat jets, China is expanding military patrols around Scarborough Shoal after violent confrontations with Philippine forces. How the U.S. is responding. More on that after the break here, China in Focus. Welcome back to China in Focus. I'm Tiffany Meyer, turning now to London, where Britain's High Court ruled that the government lawfully approved a massive new Chinese embassy. The decision rejects a legal challenge from local residents. They argued the facility could limit protests and be used to monitor Chinese dissidents. The embassy project was approved in January. It would become China's largest diplomatic mission in Europe, located near London's financial district and critical communications infrastructure. Supporters say British intelligence agencies have reviewed the plans and national security risks can be managed. Critics warn the facility could become a base for Chinese espionage and surveillance operations. They point to Beijing's history of targeting dissidents overseas. The ruling comes as Britain seeks closer economic ties with China, despite ongoing security concerns. Tensions escalating in the South China Sea. Beijing has deployed guided missile frigates and combat jets to conduct aggressive patrols near Scarborough Shoal. It comes just days after a violent clash injured Philippine sailors in contested waters.
Chinese state media released footage showing off warships and fighter jets in the region. China's Coast Guard says it has also stepped up law enforcement patrols. Beijing says the patrols are aimed at protecting what it calls its sovereignty, but the waters are also claimed by the Philippines. A 2016 international arbitration ruling found no legal basis for China's sweeping claims in the South China Sea, but China rejected that ruling. This show of force comes on the heels of a hostile incident where Chinese personnel attacked Philippine Navy troops with wooden batons and blasted vessels with high-pressure water cannons. Washington is firing back. Secretary of State Marco Rubio criticized Beijing's actions, reaffirming that Washington stands firmly by its treaty ally, the Philippines. A U.S. Navy aircraft carrier strike group has also arrived in the region to reinforce a free and open Indo-Pacific.
Meanwhile, Beijing is increasing pressure on Taiwan, expanding its reach beyond the Taiwan Strait. Taiwan is condemning China's latest Coast Guard patrols off its eastern coast. Taiwan says the patrol is a political operation designed to undermine regional stability and challenge its sovereignty. Taiwanese officials have dispatched their own vessels to monitor the Chinese ships. To discuss the conflicts between China and the Philippines, we spoke with Rick Fisher, Senior Fellow at the International Assessment and Strategy Center. Rick Fisher, thank you so much for joining us. Great to have you back on the show.
Tiffany, thanks for having me back.
So the latest with the tensions around the Philippines, Beijing has deployed JL-10 jets and a Type O-54B frigate. What do these tell you about the type of operation and message that China is sending?
China is showing the Philippines and the world that it can send second-tier platforms to enforce its illegal claim to Scarborough Shoal, which, if they get away with it, Tiffany, will cement China's control of the South China Sea and its chokehold over the Asian maritime commercial arteries.
And all of this just comes days after that violent clash that injured Philippine sailors, and the USS George Washington had sailed through the area as well. What do you make of the timing here of China's operations?
Well, yes, the United States has deployed significant force to the South China Sea, luckily, to just follow the Chinese aggression against the Philippines around Second Thomas Shoal in the first week of the month. Unfortunately, the United States has been undertaking this kind of top tier force signaling to China for probably close to 2 decades, and it has not resulted in convincing China to stop its incremental aggression against the Philippines and, for that matter, Taiwan. As a consequence, the United States is beginning to take a new tack. In the last week, the United States has announced that it is going to help the Philippines build a new pier on the island of Palawan, which is on the front line of the contest over Second Thomas Shoal in the southern part of the South China Sea. The United States has not yet taken an active response to Chinese aggression against Scarborough Shoal in the north. Both are necessary because if China takes control of both locations, that will complete its control of the South China Sea. I'm very interested in seeing where the Coast Guard cooperation with Philippines leads. Essentially, we're going to have to start bumping the Chinese ships. We're going to have to be physically pushing them out of the way in order to make our point. Yes, that's an escalation. It could lead to gunfire, but the United States is more than capable of being patient in that sense and simply amassing the ships necessary to push the Chinese aggressive Coast Guard out of the way.
So that would be the escalate to de-escalate, as some like to say, it sounds like. And then given that the U.S. and the Philippines are mutual defense treaty allies, where if, the Philippines is attacked, we would have to respond. How fragile or is this area?
Well, it is on the knife edge. The Chinese are very serious. They want to control the South China Sea in order to protect their nuclear ballistic missile submarines, their second strike capability. They want to protect their aircraft carriers. They're going to be basing many of them on Hainan Island. And they also want to protect their space access from Hainan Island. They have a major space base, and that is the one that they will use to go to the moon, to go to Mars, to try to dominate the Earth-Moon system. So China has great incentives for controlling the South China Sea and conducting this current aggression against the Philippines. The United States, however, has every interest in stopping this aggression from succeeding and in containing all the force that China is putting on Hainan Island, which is not about the defense of China, it's about the domination of the world and then the Earth-Moon system.
That's all for today's China in Focus. I'm Tiffany Meyer. If you have any feedback on the show or have something you'd like to see us cover, send us an email at chinainfocus@ntd.com. I'd love to hear from you. For on-the-clock original news coverage, visit us at ntd.com or download our NTD app. Thanks for watching. See you soon. Welcome to China in Focus. I'm Tiffany Meyer. Our top story, China's GDP growth hit a more than 3-year low in the second quarter. A closer look at the engines driving the country's economic growth and which one is failing to fire. $35 billion for Welcome to China in Focus. I'm Tiffany Meyer. Our top story, a cross-border network under fire. The U.S. sanctioning entities in Russia, Iran, and China. Officials say they provided support to Iran's military. Tesla, SpaceX, and China. A new report raises questions about a potential merger, while CEO Elon Musk pushes back. We'll explain what's behind the report and the growing trend of companies separating from China operations. China's economy is showing new signs of weakness. Factory activity fell in July as demand declined, while ongoing trade tensions with the U.S. and Europe create more challenges for Beijing. And former White House Chief Medical Advisor Dr. Anthony Fauci refuses to answer questions before Congress about the pandemic's early days. We examine Beijing's cover-up and the role played by the World Health Organization.
What are Treasury buybacks or yield curve control? Why are they doing it? Will they work? What are my predictions for interest rates moving forward? I'm going to go over all of that in one.
The Treasury Department has sanctioned 6 people and companies in China, India, Russia, and Iran. The sanctions target companies acting as sales agents for Iran's Mahan Air, along with a front company tied to the Islamic Revolutionary Guard. The Treasury says the airline Mahan Air has helped the Islamic Revolutionary Guard Corps, or IRGC, provide travel for the Quds Force, which the U.S. has designated as a terrorist organization. The Treasury adds it also facilitates military training and helps transport drones and weapons. Treasury Secretary Scott Bessent says anyone providing logistics, financial, or commercial support to the IRGC or Mahan Air is helping sustain a terrorist enterprise. The sanctions block any property or financial assets those entities may have in the U.S.
During this time frame,
2 companies from the city of Shanghai and a Chinese executive are on the sanctioned list. One company helped coordinate the shipment of electronics from China to Iran. The other represents Mahan Air in China. The sanctioned individual serves as a director at both companies. A report suggesting Elon Musk is laying the groundwork to combine Tesla and SpaceX is getting a sharp denial, but even as Musk calls the report fake news, it highlights how Tesla has been prepared for the growing tensions between the U.S. and China. The Wall Street Journal on Thursday reported that Tesla spent the past few years organizing its U.S. and China operations so they could be separated if geopolitical tensions escalate. According to the report, executives have discussed several options for Tesla's China business. Those include making it a separate company, selling it, or even shutting it down ahead of a possible merger with SpaceX. Musk pushed back on X, calling the story absurdly fake news and saying the idea has never even come up in a discussion. However, the report suggests the planning wasn't only about a potential merger between SpaceX and Tesla. It says Musk wanted Tesla prepared in case tensions between the U.S. and China disrupted supply chains or access to critical technology. It also notes that keeping the businesses separate could help avoid regulatory hurdles. That's because SpaceX is a major U.S. defense contractor, while Tesla operates one of its largest factories in China. Tesla wouldn't be the first company to separate its U.S. and Chinese business operations. Starbucks recently sold a majority stake in its China operations a couple months ago. And Yum Brands, the parent company of popular fast food chains Pizza Hut and KFC, spun off its China division a decade ago. Meanwhile, in 2023, venture capital giant Sequoia split off its China business, citing increasingly complex geopolitical tensions. China's manufacturing sector is showing new signs of weakness. Factory activity declined in July, highlighting the challenges facing the world's second largest economy. China's National Bureau of Statistics reported Friday that the country's manufacturing PMI fell to 49.2. A reading below 50 means factory activity is shrinking. It marks the lowest level in 5 months as new orders fell and businesses saw weaker demand. It's also worth noting that the Chinese regime has a history of hiding actual statistics, so the true number may be even lower. One possible reason behind China's economic slowdown is continued trade pressure, including tensions with the U.S. U.S. and other
understand what
European
actually
countries.
drives
The data also
interest
shows
rates
Beijing
at the
is still
long
struggling
end of
with
the
weak
curve.
consumer
So what we
demand,
can do
a
is go
worsening
through a
property market,
process
and higher
of
production
elimination.
costs.
The first thing
Meanwhile,
we can
China's services and
eliminate
construction
is
activity also
this
declined,
guy,
reaching the
Scott
weakest level
Bessent.
since late 2022.
That's right.
Economists say the latest numbers could increase pressure on Beijing to introduce more measures to boost spending and investment.
Go back to QE
After
1,
Dr.
2,
Anthony
and
Fauci
3
refused to answer
and
questions
see what
before
that
Congress
did
on
to
Wednesday,
10-year
President
Treasury
Trump
yield.
is
Because
accusing
remember,
him of protecting China during the pandemic. NTD's Washington correspondent Jack Bradley takes a look at the CCP's cover-up and the role played by the World Health leaders.
Amid Dr. Anthony Fauci's refusal to answer questions on Capitol Hill, President Trump explicitly calling out Fauci for always trying to protect China during the pandemic response.
I disagreed with him on a lot. I would have had to close down the whole country if I listened to him.
In a newly leaked diary, Fauci wrote while he was leading the U.S. response to COVID, he said
that you had great concerns about the World Health Organization because it depends greatly on China and, as you stated, often bows to them.
The WHO took China for its word at the start of the pandemic that there was no evidence of human-to-human transmission of the virus.
There is no reason for measures that unnecessarily interfere with international travel.
That allowed for outbound international flights from China to continue, while the CCP was locking down domestic travel at home. That's as Chinese authorities silenced early warning signs of the pandemic, forcing Wuhan doctor whistleblower Li Wenliang and at least 7 other doctors to sign statements admitting that they made false comments, even though Li later died of COVID. China then blocked WHO investigators from accessing Wuhan for more than a year, and then refused to hand over raw data, lab records, and blood samples.
We are asking actually China to be transparent. The raw data was not shared.
President Trump then withdrew from the WHO during the pandemic.
Chinese officials ignored their reporting obligations to the World Health Organization and pressured the World Health Organization to mislead the world when the virus was first discovered by Chinese authorities.
And instead of demanding transparency from Beijing, Fauci publicly defended the WHO's move.
The WHO is an imperfect organization. The world needs a WHO.
Upon retaking office, President Trump immediately withdrew from the WHO once again. Jack Bradley, NTD News, Washington.
Apple shareholders rejecting a proposal calling for more transparency around the company's exposure to China, but the questions it raises about supply chain risk and geopolitical uncertainty aren't going away. To discuss it, NTD Steve Land spoke with the counsel for the organization behind that shareholder proposal, Paul Kammerer, counsel to the National Legal and Policy Center.
Paul Kammerer, thanks so much for joining us in studio.
Thank you for having me.
Paul, talk to us about this China entanglement audit. The fact that Apple, so much backlash within the company to not want to reveal its ties to China and the risks that it might pose to its investors is sort of uncanny. Why do you think that is, and what do you hope that this audit would ultimately achieve?
Well, yeah, thank you for having me. The National Legal and Policy Center made a proposal under our corporate integrity project,
or are they lower?
Because we own some shares in Apple. And the purpose is to have Apple and other companies as well disclose the kind of ties they have with Communist China. And this policy that we're looking at, this China entanglement audit, is just simply one to say, look, tell the shareholders what kind of involvement you have with China in terms of 90% of your products are made in China. And what you're doing there is working with the Communist Party there and subsidizing not only their economic warfare that they're using against the United States, but also repressing human rights, political rights. They have China, we all know, has forced labor camps and so forth that go after minority groups like the Uyghurs, the Falun Gong, etc. And Apple and other companies are complicit in that. And so all we're just saying is, look, tell your shareholders what you're doing and how this affects the shareholders with a reputational risk of the company, because also there's a financial risk. Because if China decides to pull the plug or do some kind of economic backfire to what Apple is doing, that could
in the
have
United
obviously a
States,
ramification
which is basically a
on the
combination
value
growth
of
and
Apple.
inflation.
But again, the
And you
larger
can
issue
see that there's
is
an extremely
transparency
strong
to have this
correlation,
out into the public.
regardless
It
of
seems
what
like a
debt
very
and
responsible
deficits are
thing to
doing,
do, as
regardless of
you
what the central
fully
planners are doing,
disclosed.
regardless
You know,
of what the dollar is
the National
doing.
Legal
It
and Policy
really
Center
doesn't
is,
matter
you know,
over
shareholder
the long
in
run.
Apple, and so this was a
no one
shareholder
that's being
created
intellectually
proposal.
honest can argue
Apple's board
that
voting
interest
against
rates
it,
over the past,
giving existing
40, 50,
tariffs
60, you can
and
go back as far as you
geopolitical
want,
tensions.
aren't
How
really driven
vulnerable do
by
you think
this dynamic.
Apple shareholders
So then the big
are
question
to a
becomes
lot of the things that you
why?
just laid out?
Well, I
This
think they are
really
very
doesn't
vulnerable,
make any sense. It's
and
counterintuitive.
especially when you got 90%
Because
of your
if they
products
are just
coming
giving us this
from China.
deluge
Now,
of supply
Apple tries to
that
do
you
a
would think would
whitewash and saying, well, we're
completely overwhelm
diversifying.
demand.
Or have
Or
something that
if they're adding
the
additional
production
demand
done in
that
India
otherwise didn't
or
exist,
Vietnam, etc.
how
But
is this
as we
possible?
look into it more, that's basically a sham because
this
they're basically
cannot
all
impact
connected
this.
to the dictates of what's
And
coming
the
from
reason
communist
is
China.
because
One thing we
supply
often ask ourselves when we have these discussions about the CCP and dark money
Now, I
and
know a lot of you
proxies
right
is
about now are saying to
accountability.
yourself,
Talk to us about FARA, the Foreign Agents Registration Act, and are we enforcing it? Are we leaving something on the table? Is it tight enough? And is it a good method to target some of these things?
Well, that's a good point. The Foreign Agents Registration Act requires foreign agents to register with the Department of Justice to say, here, I'm being paid by this foreign entity or even a company. It's not necessarily the government itself to do their lobbying here in Washington, D.C.
But he almost looks like he's
so
Amish.
we filed a complaint against actually Hunter Biden with the Department of Justice because he was getting money from China Energy Company and then trying to meet with folks in the State Department, etc. And we said, well, that's a violation of the Federal Foreign Agents Registration Act. But there has been a couple prosecutions on this relating to China. I was glad to see that. For example, in 2024, a Chinese operative here in California went after Shenyang, the dance
to the government,
sponsored by Falun Gong, saying that, this organization should not be a 501c3 nonprofit. And he went to the IRS saying, you should revoke their tax-exempt status. And turns out he also gave a bribe to one of the IRS agents. And the government said, well, wait a minute, you're not doing this as some good government citizen. You're actually a front for the Communist Party in China, and therefore you violated the Foreign Agents Registration Act. He was tried, he was convicted, he was given a 20-month sentence. Fast forward to a couple months ago in New York, the government also indicted and convicted another Chinese agent for operating out of what's called a Chinese police station in New York, which actually is a cover to basically target and harass those dissidents here in America who oppose the Communist China. And he was convicted. I'm not sure what the sentence was, but those are two examples. And what this does is expose to the American people the kind of pernicious influence that the Communist Party of China is having here in America.
Paul Kamenar, counsel to the National Legal and Policy Center. Greatly appreciate you joining me.
Thank you. My pleasure. Anytime.
The European Union's biggest push yet to compete in the global AI race. The EU has opened bids to build up to 7 massive AI gigafactories, dramatically expanding Europe's computing capacity. Tens of billions of dollars are expected to be invested. The move aims to reduce Europe's reliance on the U.S. and China. President Trump has criticized the EU's tech regulations, while China has tightened exports of critical minerals used by the industry. The project is backed by $11.5 billion in public funding. Officials hope to attract at least $23 billion more from private investors. The gigafactories would give Europe greater capability to train and run advanced AI models, reducing its dependence on cloud providers and data centers sectors
go from
in countries
2
like
to
China and the
10%.
US. While Europe seeks
Well, now,
AI
all of a
independence, the
sudden,
gigafactories will initially
this guy
rely
has
heavily
got
on
to
advanced
make
chips
a
from
much,
American
much
companies like
different
NVIDIA and
calculation.
AMD.
Well,
On the
he
software
makes the
side,
same
the EU wants to
calculation
ensure
as far
all
as risk
systems
reward,
comply
but
with the bloc's
much
standards on
different
privacy,
inputs.
safety, and ethics,
So if you
which
guys
are in some
watching this
respects
video
stricter than
were the
those in the US.
Amish bankster,
Coming up, a
would you do?
controversial embassy project
If you
moves
could get
forward.
10%
Britain's High Court says Beijing can
basically
build in the heart of
risk-free
London.
from a 10-year
That's despite
Treasury
local
yield,
residents
or
protesting and
lend
calling it
out
a
to
spy
corporation
base
that
in
could
London.
Go bust at 8%.
And baton attacks, water
And
cannons,
remember,
and
nominal
combat
GDP right
jets.
around
China is
6%,
expanding military
which
patrols
includes
around Scarborough
inflation
Shoal
expectations.
after violent
You're gonna buy
confrontations
the
with Philippine
10%
forces. How the
Treasury
U.S.
yield
is
all
responding.
day
More on that
long.
after the break here.
In fact, not
China
only are
in
you going to
Focus.
do it, but every single other
Welcome back to
bankster
China in Focus.
out there
I'm
is gonna
Tony
do
Meyer,
it.
turning
And
now
most
to
likely,
London, where
every
Britain's
hedge
High
fund
Court
manager,
ruled that the
every
government
pension
lawfully
fund,
approved
a
a
lot of
massive
retail
new Chinese
investors,
embassy.
they're gonna do the
The
exact
decision
same
rejects
thing
a legal
because
challenge
the
from
risk
local
reward
residents.
makes
They argue the
sense.
facility could
So
limit
what
protests
happens?
and be used
You
to
get all
monitor
of this
Chinese
additional
dissidents.
buying
The embassy
or
project was
additional
approved in
demand.
January. It would become
Because you
China's
had
largest diplomatic
additional
mission in
supply
Europe, located near London's
drove
financial
rates
district
up
and critical
created this
communications infrastructure.
distortion to begin
Supporters
with.
say British
So then you get
intelligence
all the
agencies
buying,
have reviewed
which
the
brings
plans
rates
and national
right back
security
down.
risks can be managed.
Right, let's say right
Critics
here
warn the
to,
facility
let's just
could
say,
become a base for Chinese
7%,
espionage and
which is
surveillance
more in
operations.
line
They point to
with where
Beijing's
they
history of
historically
targeting
are.
dissidents overseas. The ruling comes as
GDP
Britain seeks
or
closer
growth
economic
and
ties with
inflation
China,
expectations.
despite ongoing
And
security
in this
concerns.
example, the debt
Tensions
has
escalating in the
exploded,
South
the
China
deficits
Sea.
have
Beijing
exploded,
has
all
deployed
of
guided
these
missile
things,
frigates and combat
which
jets to conduct
short-term,
aggressive
temporarily
patrols near Scarborough
create
Shoal.
this
It comes
noise,
just days
like
after
we
a
said
violent
before,
clash
but the
injured
market
Philippine sailors
is gonna
in
see
contested
that
waters.
as an opportunity
Chinese state
and bring
media
it right
released
back down
footage
in
showing
line,
off warships
and
and
that's
fighter
why
jets
you
in the
see
region.
strong
China's
correlation
Coast Guard says it has
between
also stepped up law
nominal
enforcement
GDP
patrols.
and the 10-year Treasury,
Beijing
and
says
you
the
see
patrols
no
are aimed at
correlation,
protecting
almost
what
an
it
inverse
calls its
correlation
sovereignty.
between
But the
that
waters
10-year
are also
Treasury
claimed
yield
by the
and the
Philippines.
debt in the
A
United States
2016
or the
international
deficits as a
arbitration
percentage
ruling
of
found no
GDP.
legal
And
basis
that's
for
also
China's
why
sweeping
whatever
claims
this
in the
guy
South
does,
China Sea.
as far as
But China
buybacks,
rejected that
yield
ruling.
curve control,
This show of force
QE,
comes on the
or whatever
heels
you
of
wanna
a
call it,
hostile incident
doesn't
where Chinese
work
personnel
at
attacked
all.
Philippine
So now let's
Navy
get
troops
into my
with wooden
prediction.
batons
Where
and
are
blasted
interest
vessels
rates
with
headed in
high-pressure
the
water
future?
cannons. Washington
So
is
that
firing
one,
back. Secretary of State
sorry,
Marco Rubio
but I'm gonna give you a
criticized
little bit of a
Beijing's
cop-out
actions,
answer.
reaffirming that Washington
predict
stands
that
firmly
interest
by
rates
its treaty ally,
are gonna
the
go wherever
Philippines. A U.S.
growth and
Navy
inflation
aircraft carrier
expectation.
strike group has also arrived in the region to
How's that
reinforce
for
a free and
definitive
open
prediction? No,
Indo-Pacific.
Just kidding, just kidding.
Meanwhile,
I
Beijing
think
is
that
increasing
if we
pressure on
fast
Taiwan,
forward 1
expanding
year,
its reach beyond the
most
Taiwan
likely
Strait.
interest
Taiwan
rates
is condemning
will
China's latest Coast Guard
But
patrols
this
off its
assumes,
eastern
of course,
coast.
that oil
Taiwan says
stays
the patrol
right
is a
around
political
80, 85
operation
a
designed to
barrel.
undermine
We
regional
don't have
stability
further
and challenge
escalation
its sovereignty.
in the
Taiwanese
Middle East.
officials
At the
have
end of the
dispatched
day,
their own
that's
vessels
what's
to
driving
monitor the
everything
Chinese
right
ships. To discuss the conflicts between China and the Philippines, we spoke with Rick Fisher, Senior Fellow at the International Assessment and Strategy Center. Rick Fisher, thank you so much for joining us. Great to have you back on the show.
Tiffany, thanks for having me back.
So the latest with the tensions around the Philippines, Beijing has deployed JL-10
Interest
jets
rates
and a
are
Type O-54B frigate.
on
What do these
U.S.
tell
government
you about
debt, which has everybody asking, are we witnessing the death of the dollar?
The 30-year yield making a 19-year high, and for all the wrong reasons.
It feels like things ain't looking great for the dollar right now, Guy.
The US dollar's dominance is being tested.
But the key question we should all be asking ourselves is not if the dollar dollar will lose reserve currency status. But when will the dollar lose reserve currency status? I'm going to do my best to answer that question for you in 3 simple, fast steps. Step number 1, there is no disputing the fact global central banks are holding fewer and fewer dollars and fewer dollars denominated assets. Let's look at a chart from the end of 2025 or so, all the way back to 2000. On the left, we go from 50% up to 70%. This is the U.S. dollar percentage of FX reserves for global central banks. And you can see back in 2000, way above 70%. And since that time, it's pretty much gone straight down to a point now where we're right around maybe 52, 53%, with the exception of some volatility right around 2014, 2015. But the bottom line is the trend is straight down. But it's not just central banks holding fewer dollars. It's also the fact that they're holding fewer treasuries. Editor, go ahead and throw up that chart that we have of the amount of gold these central banks are holding versus treasuries. And you can see the trend line looks like we're going right back to where we were in 1980, where the overwhelming asset was not U.S. treasuries denominated in dollars, but gold. I like to focus on macro here, but in the macro analysis today, we obviously have to include geopolitics. What's going on in the Middle East, the Straits of Hormuz, more specifically with oil. So this begs the question, how long is the petrodollar going to actually last? And for those of you who don't know, the petrodollar, basically an agreement that the United States had with Saudi Arabia that they would sell their oil for dollars, going all the way back to the beginning of the 1970s. I believe. So a lot of people argue that this creates artificial demand for dollars because to get that oil, you got to have the dollars. But if these countries start settling for that precious commodity in a currency other than the dollar, this could lead to the dollar declining as far as its use globally, and it could lead to the death of the dollar. And let's not forget the latest news where Scott Bessent is opening up all of these swap lines to try to prevent countries from selling dollar assets, namely U.S. treasuries. And at the end of the day, what is a U.S. treasury? It's simply a longer dated dollar that pays you an interest rate. So when you look at the massive decline in FX reserves, also you look at the decline in treasuries versus gold, you look at the decline of the petrodollar and some of these emergency measures that Scott Bessent is having to implement with these swap lines, you have to start asking the question, well, when will the dollar lose reserve currency status? Because it sure looks like the wheels are in motion for possibly imminent decline of King Dollar.
Step number 2, to determine when the dollar is going to lose reserve currency status, I think we have to step back first and try to define what a reserve currency actually is. And for me, personally, I think most of you would agree with me, the reserve currency, or the dominant currency of the world, is the one that people use the most. It's pretty simple. So going back to step number 1, is it true that these central banks and governments are holding fewer dollars? It is absolutely unequivocally true. But at the end of the day, does that matter? Maybe, maybe not. So let's look at some charts and data to determine how much the United States dollar or other currencies are actually being used in the global economy, not necessarily held by a central bank. So we'll start by looking at the world share of international payments via SWIFT. Now, I realize there's other ways to settle interbank, but SWIFT is by far the largest one that we have in the world. So the blue bars represent the United States dollar. And I think what's very interesting is one of the arguments, and I think it's a valid argument that you hear for the dollar losing reserve currency status, is what we did in 2022 to Russia when they invaded Ukraine. We froze all of their accounts. So all these other countries, they don't want to do business in dollars, they don't want to hold dollars because they're worried about the United States, well, taking their money. And it is a very valid concern, but the proof is in the pudding. And if you look back to 2022, the percentage of global transactions that were settled in dollars, right around 40%. So what is it today? Have we seen a massive decline? Actually, the opposite of that. We have seen the dollar usage actually go up to a point today where it is over 50%. And the data gets even more shocking if you go back to 2012, which is the beginning of this chart, and And back then, as we all know, the dollar was the global reserve currency, but it only had a 30% share of global transactions. So again, 2012, 30% share of global transactions on SWIFT. Today, over 50%. Now let's go over to the most recent BIS report. This is the Bank of International Settlements. And they've got a fantastic chart. This is the foreign exchange market turnover by currency and currency pairs. And you can see if we go back to 2022, it's represented by this blue bar. So the United States dollar was used in 88.4. I gotta use my glasses there. 88.4% of the transactions. But today, it's actually gone up to the point where it's at 89.2. Now, if you guys are paying attention, you're going to add all these numbers up and say, wait a minute, this is way over 100%. That's because there's two currencies in each transaction. And we look at the main currency pairs for these transactions, and it's no surprise that the dollar is on one side of every single one of them. The main one is the dollar euro, we've got dollar yen, we've got dollar pound, and dollar, basically all the emerging markets combined. But we're not done there. Let's go over to another website where they've got some very recent data here from June 23rd, 2026. They say when excluding payments within the Eurozone, the USD's share of international payments rises to approximately 75%, further emphasizing its centrality outside the Eurozone. The Euro's share correspondingly decreases, reflecting its regional concentration. So you see what they're saying there? They're saying when you omit the Eurozone, the amount of global transactions increases even more as far as percentage of dollar settlement. And then, as you would expect, the percentage of euros goes down outside of the Eurozone quite substantially. In other words, what's happening is when you exclude the United States, you exclude the Eurozone, and then you look at which currencies are being used globally for settlement, the percentage share that the dollar has goes up even higher, showing that it's even more dominant, not necessarily with central banks, as we pointed out in step number 1, but with corporations, with entities, with individuals in the real economy. They go on to highlight the fact in trade finance transactions, the United States dollar dominance is even more pronounced, accounting for 82.5% of total transaction value. So if we're defining a global reserve currency by simply what central banks are doing, then it is no doubt the dollar is losing reserve currency status. But if we actually define a reserve currency based on which one is being used the most in the real world, we can see with the data that the dollar is being used more and more and more.
Step number 3. So we've broken things down into two separate categories. I like to think of them as reserves and transactions, and more so reserves for the government entities, not necessarily in the private sector. But to answer the question, when will the dollar lose reserve currency status, I've got to actually give you two separate answers based on these categories. But before we get there, let's kind of understand why. Right? I always like to ask, well, why? Why is the dollar being used in transactions so much? And why is the dollar being used less and less and less as far as reserves for these central banks? The first thing you have to understand, we'll start with a central bank. The ECB right here in red. So we've got their balance sheet, assets on the left, liabilities on the right. And here, let's use a huge mega multinational corporation in the real world, the private sector. Toyota, same thing, assets on the left, liabilities on the right. Okay, cool. So we all know, or should, that a central bank really can't go bust. So let's say their liabilities are all their local currency, euro. So euro, bank reserves, and on the asset side, they've got some dollars, and now they've got a lot of gold. Well, what happens if the gold loses its value? Let's say it gets cut in half or something. Well, then they have negative equity. Now, does this mean they just go bankrupt and they're solvent and they just go away and we don't have to deal with the ECB anymore? Absolutely not. You see, they can have negative equity. They could have this. They could have no assets and all liability. And they're still going to be there. They can't go bust. Now, it's completely different, obviously, for Toyota. So what happens is they have to match up their liabilities and assets. Because if they have dollar liabilities, let's say, and they have gold, let's just say the gold was here, and it disappears because the value of the gold goes down. Now all of a sudden, they have negative equity, but that could mean they actually do go bust. So when you actually zoom out and look at these two entities as proxies for what the government's doing and then what the private sector is doing, you see that they have completely different incentives. In other words, Toyota cannot do what the ECB is doing. The private sector cannot do what the government is doing because they actually have a balance sheet and they can actually go bust. So going back to those priorities that are much, much different, what is the ECB or any central bank, what is one of their main priorities? Well, access to their assets. And this is when you go back to 2022 and look at what happened when Russia invaded Ukraine and the United States froze Russian assets. All of a sudden it sends a message to all of these central banks that, hey, you might want to hold fewer dollars, or you might want to hold fewer dollar-denominated assets, or assets with less counterparty risk, i.e. gold. And the central banks can do that because, once again, they can have negative equity. Now let's go over to the other side, the private sector here, and ask what is their main priority or some of their main priorities. Number one by far, there isn't even a close second place, is utility. Because at the end of the day, why do we use currency? Well, because it's a lot easier than bartering. So the main reason we use it is for that utility. But then we have to ask the question, what is a currency? In today's day and age, it's actually a platform. It's like a financial platform, very similar to YouTube. And more on that in just a moment. But when we look at what gives a currency utility, or what gives a dollar financial system utility, we got to look at the apps. So the reason I say apps is because I want you to look at a dollar or euro or yen or yuan financial system as a phone. Okay? Just like the one you probably got in your hand, or you could have in your hand right now. And each phone has apps. Some of them have a lot of apps. Some of them have very few apps. Just like a financial system. Some of them have a lot of features. Some of them have very few features. So it gives the dollar financial system a ton of utility. Are these apps? So you say, George, okay, I get the analogy. What are the actual apps? Okay, let me give an example of something that Toyota could really use. First of all, corporate paper market. Very deep, billions and billions and billions and billions of dollars. So if Toyota needs very quick funding, they know that they can get that funding almost immediately in dollars. Can they get that funding in Colombian pesos? No. Could they get that funding in Chinese yuan or South African rand? No. Okay? So also a bond market. So when they take their profits, they don't want to leave at the bank. So what if the bank goes bust? So what they can do is take those profits and they can put them into the U.S. Treasury market. Not because they have to, but because they want to. Because they can collect, let's say, a 4% interest rate. They can just roll over that debt. They can have the ultimate liquidity. And they're not taking a lot of FX risk because they have a lot of dollar-denominated liabilities. Well, let's keep going. The swap markets, and I don't want to get too in the weeds here, but this allows a mega multinational corporation like Toyota to go ahead and hedge their balance sheet among many other things. So interest rate swaps, FX swaps are what I'm referring to. So it's just like that smartphone in your hand compared to a flip phone. Back in the day, you had X flip phone versus Y flip phone. Wasn't that much of a difference. All you could do is call someone. But nowadays, that smartphone gives you so much more utility than a flip phone ever could. And it's because of all these apps. So the main point here is one of the main priorities for these central banks and their reserves is access. And the main priority for everyone in the private sector, especially these huge multinational corporations and banks, very, very important, is utility. And I know a lot of you right about now saying, George, okay, I get what you're saying with the analogy, it makes a lot of sense. But the United States is weaponizing the dollar. And therefore, even if it has this utility, at some point, the risk outweighs the reward. And I totally agree with this. But what you have to understand is the degree of risk relative to the degree of utility. Let me put it to you this way. We'll stick with this iPhone or smartphone example. So all of you watching right now, or I'm going to say 99% of you, probably have a smartphone. And you all know that smartphone is spying on you. Everybody knows this. Now, is a flip phone spying on you? No, probably not. So why don't you guys use a flip phone? When you know that what you have in your hand right now is pretty much listening to every single thing that you say, spying on you to use that by the government potentially against you in the future. The reason why none of you will give up your smartphone, even though you know the downside of it, is because it has so much more utility than that flip phone that won't tattle on you, the big daddy government. Okay, now what I want to do before I give you my prediction as to when the dollar will lose reserve currency status is I want to go through a real world example to make sure that we're all on the same page. What we were talking about earlier is kind of an oversimplification and it's out there in the abstract. But what I want to do is take that concept and now turn it into something real and concrete. Okay, so we're going to stick with the same entity, Toyota, right here, but instead of looking at the assets and liabilities of the balance sheet, this time we're going to look at kind of the income statement, if you will. So we've got revenue on the left, we've got expenses on the right. So Toyota is selling a lot of cars to these individuals, the average Joes and Janes in Colombia, COP, the Colombian peso, in South Africa, say the South African rand, and in the UK, so the British pound. So they're receiving all of these different currencies. There's a problem because their inputs are denominated in dollars. So let's just assume for a moment they have to import rubber from Malaysia, copper from Chile, chips. I don't know if India makes computer chips, maybe Taiwan, but it doesn't matter. Dust and bones, blue. The example. You get it. So they're being invoiced in dollars from the entities, the producers in these countries that are providing them all of the inputs for the cars that they then sell to these other markets to get the foreign currency. And right off the bat, you can see the problem. Let's assume they keep all of these currencies in just a multi-currency account. We'll say they do that with HSBC or something like that, or even hold the bonds that are denominated in these currencies. They still would have an FX risk. And what I mean by that is if the value of these currencies goes down relative to the dollars they're being invoiced in, the burden of their inputs, in other words, basically their expenses, are going to increase, and they can't take that risk. So what they're going to do is, as soon as they get this currency, they're going to immediately turn it into dollars. So they're going to take XYZ currency, turn it into dollars, so they don't take that FX risk, because the dollar can't go down versus the dollar. But now they've got another problem. See, they can't just hold billions and billions and billions of dollars in a checking account, because what guitar strings cost, and they actually would like to get an interest rate on that money while they're waiting to deploy it. So they're going to take the dollars, and remember, initially they took foreign currency, that goes into dollars, they take the dollars, that goes into U.S. Treasuries, because they don't have that counterparty risk of a bank failing, and they get an interest rate above zero. When you say, George, whoa, time out here. Why don't they just take the foreign currencies and turn them into yuan, or maybe the new BRICS currency, or the Indian rupee, or the Russian ruble, or something, because we know that Toyota and everyone else out there hates the United States, they hate Donald Trump, they hate the fact that we have all these massive exploding deficits. That's the truth. They hate the fact that we have all of this debt, 40 trillion in debt. So at a certain point, they're not going to trust the bonds anymore. They're not going to trust the dollars, and therefore they're going to want to take these foreign currencies and turn them into yuan because that's safer. Okay, well, let's just think that one through. So first and foremost, you would have to have a bond market denominated in yuan, which they do, but it's very difficult to access and it's very illiquid. It's not like holding the treasuries, which you can immediately sell for that liquidity you need based on what your needs are from your expenses, your balance sheet, etc. And you still have the problem that those Chinese sovereign bonds are denominated in yuan that can fluctuate, the yuan can fluctuate in value relative to the denomination of your inputs, which is still dollars. And then you might say, well, George, all of these countries are going to start invoicing in yuan because they hate Donald Trump and they hate the deficits and they hate the U.S. having $40 trillion in debt. Okay, that's fine, but remember, all of these companies, all of these producers have inputs as well, and they're all invoicing these producers in dollars. So what you would have to have is the entire ecosystem, the entire supply chain, let's say, of Toyota and all of its suppliers somehow just immediately switch to Chinese yuan overnight. And we haven't even gotten the toughest part of that switch, which would be the infrastructure and a lot of the features that I talked about earlier. So now let's get into that. Assuming Toyota chose to hold Chinese government debt because they just trust it more, denominated in yuan.
Cheap motel glowing beside the road. Another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, soul like an endless highway with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light starts looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned, and every chord beneath the moonlight sky feels like one more long goodbye. to these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues keep pulling me down slow, like muddy southern water where broken dreamers go. Oh Lord, hear me tonight underneath this pale moonlight. Every road I choose leads back to these blues. Dusty boots walking through an empty town. Every lost soul keeps looking down. Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Through the southern trees, like ghosts whispering old melodies, and every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance, slowly drawing near. Oh Lord, hear my cry beneath this endless sky. Every dream I lose turns into these blues. Neon signs glowing through the midnight rain. Every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox humming in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon whiskey road, take me far away, past the empty bars, memories that stay. Feels home. Every road I choose turns into these blues. Scream about all the things that could have been. Train tracks shining underneath the storm, like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. And every chord beneath the southern sky feels like one more Neon whiskey road, stretching through the night like a lonely river, disappearing out of sight. Every dream I lose, every town I roam, still searching for a place this heart can call home. Gently on a Delta town tonight. Street lights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pine wood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Street lights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight, under neon glow and candlelight. Smoky Delta night, burning like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase, still leaves your shadow in this empty place. Cold wind blowing through the Delta night, rusty street lamp barely shining light. Old six-string crying by the motel sign, like a broken prayer lost somewhere in time. River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name, through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and fear? Every road I ride leaves another scar inside. watching lonely shadows slowly pass. Jukebox humming low in smoky air, playing songs for souls beyond repair. Moonlight falling on these worn-out boots, while silence hangs beneath the roof. And every chord I play tonight alone feels like searching for a place called home. Train wheels crying near the riverside like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue, while this old world keeps breaking in two. These crossroads after midnight still pull me through the storm, like distant thunder rolling before the night is gone. Oh Lord, stay near tonight beneath this fading light. Every dream I knew turns back into the blue. Standing at the crossroads, late at night alone, cold wind blowing through flesh and bone, street lights trembling underneath the rain, like tired hearts learning how to break again. Oh, black guitar hanging by my side, full of songs I've always tried to hide. Every mile behind me feels the same. Every broken town still knows my name. Crossroads, midnight blues, calling out my soul like a dark old river, too deep to control. Oh Lord, hear my prayer floating through the southern air. Every road I choose leads into these blues. Smoke drifts slowly through the neon light, while lonely strangers drink away the night. Bartender says some wounds don't heal, and tonight I finally know how that feels. Train tracks humming underneath the storm, like tide ghosts trying to stay warm. And every note my guitar Delta moon hanging low above the river tonight. Silver reflections dancing in the pale light. Old wooden porch creaking underneath my feet, while distant thunder rolls through the summer heat. My cigarette burns slow beside this rocking chair. Southern wind moving softly through the air, and every lonely cricket singing in the dark feels like another memory inside my heart. Delta moonlight blues, soft and low tonight, like an old forgotten prayer floating through the night. Oh Lord, hear my soul trying hard to stay whole. Every road I choose leads back to these blues. Rain clouds gather slowly over county lines, like old regrets buried deep in time. My guitar hums with a worn-out sound, like a tired man still drifting around. Oh, radio playing from the room inside, songs about lovers who never survive. And somewhere far beyond the riverbed, another lonely night begins again. Delta moonlight blues rolling through my veins, like muddy southern water after endless rain. Every dream fades slow, like smoke beneath the moon. Still singing these blues to an old forgotten tune. Dust blows softly through this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blues running through my soul, like an old black river nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blues. Old bartender says the night's still young, but these tired lungs have sung enough songs. Train whistles echo somewhere far away, like ghosts begging me to stay. My guitar strings hum with a cracked old sound, like a worn-out man still drifting around. And every note beneath this southern sky feels like one more slow goodbye. Dust and bones blues, heavy as the rain, like old scars hiding deep beneath the pain. Every road I ride, every town I choose, still leaves me stranded with these dust and blues. Midnight train rolling through the rain, steel wheels crying like human pain. Coffee grows colder beside my hand as I watch the storm move across the land. beside the road. Another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, rolling through my soul like an endless highway with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Every passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light starts looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned, and every chord beneath the moonlight sky feels like one more long goodbye. Lonely train blues tonight, slowly drifting on, like the whistle of a train just before the dawn. Every road I take, every mile I lose, still leads me back to these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues keep pulling walking through an empty town. Every lost soul keeps looking down. Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Wind blows softly through the southern trees, like ghosts whispering old melodies. And every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance, slowly drawing near. Oh Lord, hear my cry beneath this endless sky. Every dream I lose turns into these blues. Neon signs glowing through the midnight rain. Every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox humming in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon whiskey road, take me far away, past the empty bars, memories that stay. Feels home. Every road I choose turns into these blues. Scream about all the things that could have been. Train tracks shining underneath the storm, like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. And every chord beneath the southern sky feels like one more stretching through the night, like a lonely river disappearing town tonight. Streetlights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pine wood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Streetlights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase still leaves your shadow in this empty place. Cold wind blowing through the Delta night, rusty street lamp barely shining light, old six-string crying by the motel sign, like a broken prayer lost somewhere in time. River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and feel every road I ride leaves another scar inside. Bartender wipes the dust from empty glass, watching lonely shadows slowly pass. Jukebox humming low in smoky air, playing songs for souls beyond repair. Moonlight falling on these worn-out boots, while silence hangs beneath the roof. And every chord I play tonight alone feels like searching for a place called home. Train wheels crying near the riverside like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue, while this old world keeps breaking in two. These crossroads after midnight still pull me through the storm, like distant thunder rolling before the night is gone. Oh Lord, stay near tonight beneath this fading light. Every dream I knew turns back into the blue. Standing at the crossroads, late at night alone, cold wind blowing through flesh and bone, street lights trembling underneath the rain, like tired hearts learning how to break again. Oh, black guitar hanging by my side, full of songs I've always tried to hide. Every mile behind me feels the same. Every broken town still knows my name. Crossroads, midnight blues, calling out my soul like a dark old river, too deep to control. Oh Lord, hear my prayer floating through the southern air. Every road I choose leads into these blues. Smoke drifts slowly says some wounds don't heal. And tonight I finally know how that feels. Train tracks humming underneath the storm, like tide ghosts trying to stay warm. And every note my guitar softly cries feels like one more beautiful goodbye. Crossroads midnight blues hold me till the dawn, like a fading echo of an old sad song. Every dream I chase, every love I lose, still leaves me standing in these midnight blues. Delta moon hanging low above the river tonight, silver reflections dancing in the pale light. Old wooden porch creaking underneath my feet, while distant thunder rolls through the summer heat. My cigarette burns slow beside this rocking chair, southern wind moving softly through the air, and every lonely cricket singing in the dark feels like another memory inside my heart. Delta moonlight blues, soft and low tonight, like an old forgotten prayer